idea is today we will do the international taxation, that is the 30 marks topic. We will finish. First, I will discuss the provision, then we will do the question. Okay. So, international taxation, majorly, the major chapter is non-resident taxation, and second one is transfer pricing, then double taxation relief, and then authority for advance ruling. Again, that is a theory chapter. Main problem chapters is these three: NR taxation, transfer pricing, and double taxation relief. And tomorrow we will do go to the domestic taxation area. In that we will do capital gain, TGBP, set off, assessment of company, partnership law. Day after tomorrow we will do the other areas, that is charitable trust, real estate investment trust, alternate investment fund, that virtual digital asset, digital taxation, all those topics. Okay, it's a plan. So I will try to solve all these questions in the classroom itself. Okay, that is your plan. So first, straight away go to the area non-resident taxation. So the first question is actually related to the residential determination of residential status of a company. So determination of residential status of a company. See, residential status, as you are aware, individual, HEF, partnership firm, LLP, all persons residential status we have to find out. But for CF final point of view, the most important area is residential status of a company. So first I will explain the provisions of residential status of a company, then we will go to the question. Before that, why we are studying the residential status? Residential status of a assessee is very important because to determine the taxation principle, we have to know the status of the assessee. If assessee is a resident, global income is taxable. Resident means individual and HEF. There are two subcategories: resident and ordinarily resident, resident but not ordinarily resident. If you are resident and ordinarily resident, global income is taxable. Global income means Indian income as well as foreign income is taxable in India. But if your status is resident but not ordinarily, all the Indian income anyway it is taxable, obviously, because there is nothing to do with the residential status. If it is Indian income, definitely you have to pay tax in India. Unless it is covered in section 10 exemption, no need to pay. Otherwise, you have to pay. Regarding foreign income, the taxability depends upon residential status. So if you are resident but not ordinarily resident, regarding individual and HF, because for all other persons there is no such as a category of ROR and RBNOR, that is only for individual and HF. RBNOR status, only two foreign income is taxable. One is foreign business income if the business is controlled from India. And second one is foreign professional income if that profession is set up in India. Ultimately, the profession is started in India, but related to that profession, you got a client in abroad and you visited there, do the work, receive the fees. That is known as foreign professional income, but the profession is set up in India. Only these two foreign income can be taxed in India in respect of RBNOR. Any other foreign income cannot be taxable in India. This is the rule for ROR and RBNOR. So when it is come to a company, we can classify company into Indian company and the foreign. Indian company means a company registered as per Indian Companies Act 2013 or 1956 or prior to that law, any law prevalent in India. As per that law, if a company is registered in India, that is Indian company. Indian company is always resident. So further there is no test. You can go to foreign company. Foreign company, whether it is resident in India or not, section 6 says only one sentence. As per section 6, which says that if the place of effective management of the company is in India during the previous year, then that foreign company can be said to be resident. If the place of effective management is outside India, we can say it is a non-resident. So what is place of effective management? Act says place of effective management means it is a place where key managerial and commercial decisions which are necessary for the conduct of the business of the company as a whole in substance are made. That means the key decision taking place, that is known as the place of effective management. In simple words, the place where the real decisions of the company is taken. Usually board of directors are taking decisions at their board meeting. With this sentence, practically we cannot apply the residential status test for foreign companies. So further they issued a circular. So that circular details the rule for finding out place of effective management or the residential status of a foreign company. But that circular, there are two circulars, circular number 6/2017 and circular number 8/2017. This new circular further describes or explains how to find out the place of effective management of a foreign company. So this is known as POEM guidelines. So these POEM guidelines applicable for a foreign company only if the turnover of that foreign company is more than rupees 50 crore. So there is question will arise, what will happen if the turnover of that foreign company does not exceed 50 crore? Then by default, it will be treated as non-resident. So if the turnover of a foreign company is more than 50 crore, but that it is a foreign company registered or incorporated in a foreign country, then how we will find out the place of effective management, what is the POEM guidelines, and how we will find out the residential status. That is explained. So they are saying first we have to find out whether the active business of that foreign company is outside India or whether the active business is in India. That is known as ABOI test. Active business outside India or not. See, active business outside India means the main business of that company is outside India. Active business outside India, not outside India, means the main business sometimes may be in India. So first we should find out that. Then we will decide how to find out the POEM. So before going into POEM test, first we should find out active business outside India test. So whether the active business outside India or not, how we will find out that. So that's it. First we have to see the following 4 conditions. All these following 4 conditions are satisfied. We can say that active business outside India. So what is the first condition? The passive income of that foreign company should be less than or equal to 50% of total income of that foreign company. Total income of that foreign company. So inside that total income, passive income is also included. So that passive income as a percentage of total income of that foreign company should not be more than 50%. It should be less than or equal to 50%. Remember, in all the other 3 tests, they are using the word less than, less than, less than. But in the first test, they are using less than or equal to 50%. Second, third, fourth, comparison is with respect to items in India compared to its total. But in the first item, passive income less than or equal to 50% of total income. There nothing says regarding India. They are not using that word. So first we should find out the total income of that foreign company. Out of that foreign income, what is the passive income and what is the percentage of that passive income compared to the total income. So if that is less than or equal to 50%, we can say the first test is satisfied. See, all these 4 tests are cumulative, compulsory, mandatory. All these 4 tests should be satisfied. Any one test failed, active business is not outside India. Then the POEM guidelines will be different. Determination of residential status will be different. But if active business outside India test is satisfied, then it will be different. So there are basically 2 areas to find out. So which rule we should apply. See, if the active business outside India, to find out the POEM, the simple test is body meetings. Number of body meetings. If majority body meetings held outside India, POEM outside India, that is non-resident. If majority body meetings held in India, then we can say that POEM in India. So if POEM in India, resident in India. Okay. Now, what is passive income? So passive income they are defining. Basically passive income, active income. What's the difference? Active income means actively we have to carry out certain operations. From that we should get the income. That is active income. Passive income means you see non-active operations, simply invest in and you will get the return. So that is passive income. So passive income they are saying number 1 royalty, number 2 dividend, number 3 capital gain, number 4 interest. So interest will be active income if the business of that foreign company is banking business or financial institution. So it should not be a bank or financial institution, then only interest can be classified as a passive income. If it is a bank or public financial institution, interest is active income. So, okay. So interest, capital gain, dividend, royalty. And one more item that is actually an active income, but they are included in passive income. That is buying and selling of goods from and to associated enterprise. So this foreign company has an AE or multiple AEs. So purchase from one AE and selling to another AE. So both sides AE should be involved. Purchase from AE and sale to AE. Purchase and sale of goods. From that income is earned. That should also be classified as a passive income. If purchase from AE and sold it to unrelated party, not passive income for this purpose. Purchase from unrelated party, sold it to AE, not passive income. Purchase from AE, sold it to unrelated party, not passive income. So passive income, purchase, both to purchase and sale, AE. That is in real terms, actually it is an active income because buying and selling of goods is active income. But for this purpose, they are classified as passive income. and royalty, dividend, capital gain interest, whether or not associate enterprise are involved. So even though associated may be with the AE, that income earned from royalty, dividend, capital gain interest, or may not be from AE, from unrelated party, does not make any difference. So this is passive income. So this passive income should be less than or equal to 50% of the total income of that foreign company. Remember, we are analyzing the details of a foreign company. So usually this foreign company incorporated in a foreign country. In that country, there may be a law, tax law. Then the total income computed as per the tax law prevalent in that country should be taken. And if it is a tax haven country, there is no tax law. Okay, then go to the books of accounts and take the income as per the books. So sometimes this foreign company may be located in a tax haven country. There may not be a tax law. In that situation, take the books of accounts, income as per the books. So if there is no tax law, take the books of accounts, income as per books of accounts. Otherwise, the total income as well as the passive income should be taken as per the tax law prevalent in that country. Okay, this is the first test. So passive income should be less than or equal to 50% of total income. Once again, remember, less than or equal to. In all other three tests, there is no equal, less than, less than, less than. So here less than or equal to. And second thing, remember, passive income may be received from India. Passive income may be received from foreign country. Doesn't matter. Doesn't matter. See, find out the total income of that foreign company. Out of this total income, what is a passive income? Okay. There is no geographical condition in passive income test. And second test, assets situated in India. Yeah. So second, third, fourth, remember, they are, it's specific to comparison of India with the total. India with the total. So assets situated in India should be less than 50% of the total assets of that foreign company. Less than, equal to, condition violated, less than. And third, number of employees situated or resident in India. Either employees stayed in India or employees may be resident in India as per residential status test of the income tax act. That should be less than 50% of total number of employees. So it's only a number. So first one is figure in amount, second one in amount, third is number. So number of employees situated in or resident in India should be less than 50% of the total number of employees. And last one, to such employees, what is the salary paid in India? That should be less than 50% of the total salary expense or payroll expense of that foreign company. So if all these four tests satisfied, all four satisfied, we can say active business of that foreign company outside India. So if active business outside India, how we will find out the point? Simple rule. Take the total number of board meetings carried out during the previous year. So if majority board meetings held outside India, that foreign company is a non-resident. If majority board meetings held in India, poem could be said to be in India, accordingly resident in India. So this is the rule. But in that case, there is an exception. Sometimes all these four tests is satisfied. Active business outside India. But that foreign company has a parent company in India. So foreign company, the subject, see the present company we are selecting to find out the residential status is a foreign company. But that foreign company has a ultimate parent company or holding company. That holding company is actually located in India, or that is a resident company. So Indian company is the parent company. Subsidiary company is a foreign company. We are going to find out the residential status of that foreign company. The problem is it satisfied all the four tests, active business of that foreign company outside India. But the ultimate decision making of that foreign company's decisions are taken by Indian parent company. Indian resident company is ultimate decision making. There is a board of directors for that foreign company, but they are just look like puppets. They are not taking any active decision. Ultimate final decisions are taken by the Indian parent company. They are simply executing that. So in that case, we can say no need to see any board meeting, something like that. Because ultimate parent entity is located in India and that parent entity is the real decision maker. Then that foreign subsidiary company will be treated as Indian resident. So that's the second part they are saying. Even though active business outside India test is satisfied, all the four tests are satisfied. Do not go for board meeting criteria. Just look this. If de facto decision making authority is not board of directors, but Indian parent or Indian resident, then poem is in India. See, merely because the parent company is Indian company, subsidiary is a foreign company, do not say that it is a resident company. That foreign subsidiary is an Indian resident. Do not say like that. We should see whether the actual decision making is also exercised by the Indian parent. Then we can say that foreign subsidiary is a resident. So this is active business outside India satisfied cases. active business outside India is not satisfied. Okay, if active business outside India test is not satisfied, that is all these 4 tests is not satisfied, any one test is violated, then we cannot take the board meeting concept. You should look into the matter, really who is taking the decisions of that company, and that person's while taking decisions where they are situated, if where they resided, or where at the time of taking decision where they located. So their location should be taken. If their location is outside India, the poem is outside India, accordingly residential status is non-resident. So if they are taking decisions from India, then poem will be in India and that foreign company will be resident. So we are not really looking into the number of board meetings, but we have to check whether the decisions are taken by from India, whether this decision taken from India, or the persons who is taking the decisions from where they are taking the decision, their real location should be taken. So in that cases also, if really the board of directors are taking the real decision, then look at the location where those directors are located at the time of participating in the board meeting. So we have to see that. So there is nothing to do with the number of board meetings. The number of board meetings will be considered only here. That is, if all the 4 conditions of active business outside India test is satisfied. Otherwise, we will not look into that. Okay. In all other cases, we will look into this criteria. That is, identify persons who actually make the key managerial and commercial decisions. Determination of place where these decisions are in fact made. That is, the location of the persons at the time of taking decision must be taken. So this is the rule for active business outside India and correspondingly poem guidelines. And now, passive income we discussed, and assets means whether movable or immovable, all type of assets will be considered. But if it is a depreciable assets, then we have to take the average of opening WDV and closing WDV as per the tax law. And if there is no tax law in that country, then we have to take the books of accounts. So WDV as per books of account, no average. Average we have to take only if depreciated value available as per the tax records. Value of asset for depreciable assets, average of opening and closing value as per tax purpose. Suppose if there is no tax law in that country, take the value as per book. For non-depreciable asset, definitely we will take the book value. And number of employees means average number of opening and closing number of employees should be taken. And not only the permanent employees, if we take some employees on a contract basis, only for some particular work, they are not joining into PF or something like that. So they are not real fixed employees. Just for some occasional purpose, we are taking some employees, but they are doing the job similar to the permanent employee, then they should also be taken into the number list. So regular, not only the regular employees, but casual employees should also be considered. And payroll means salary, wages, bonus, pension, social cost and other compensation. That means including perquisites. Including perquisites, total payroll cost must be considered for comparison purpose. And in practical sense, for active business outside India purpose, we have to consider 3 years weighted average data. Current year, preceding 2 years. Total 3 years average data must be taken for all these 4 tests. But in practical purpose, it's like that. But for examination purpose, they never asked for CA final examinations any average data. Question will say all the data given is average. They assume it is average figure. They never asked like that. But if they are asking, because we cannot predict, right? It is Institute of Chartered Accountants of India, right? It's a mystical institute, right? We cannot predict that, but they never asked. Only they give the current year data. And some questions they will say assume all the data will be taken as the average figure. And if poem, sometimes there will be a very rare situation. Poem may be in India and poem may be outside India. For example, active business outside India test is satisfied. All 4 tests satisfied. Then plainly we will take the condition of board meeting, right? Total board for number of board meeting happened during the previous year 24-25 is only 4. 2 board meeting held in India and 2 board meeting held outside India. Then what will happen? Because equally distributed. So majority board meeting outside India, poem outside India. Majority board meeting in India, poem in India. So what will happen if it is equally distributed? Poem in India and outside India. So they are saying then there is only one way. We have to see the weightage of the decisions taken in that board meeting. If majority or the dominant test we have to apply. Majority test or predominant test. So identify the decisions. Okay. Identify the importance of the decisions or weightage of the decisions. If majority of the decisions are taken at the board meetings held outside India, then poem outside India. Suppose 2 meeting in India, 2 meeting outside India, majority board meetings are taken at the meetings held in India, then poem in India. So they are saying if poem in India and also outside then presumed to be in India, it was mainly or predominantly in India. So if it is predominantly outside India, it is a poem outside India. Okay. For exam purpose, practical application, they never asked a question from this topic that is equally distributed. Theoretically they asked, but problem they never asked. It's a practically highly disputable because we are saying these are the major decision. Department will say no, that is not the major decision. This is the major decision. Disputes is possible because it's an open area, not any certainty because judgmental, right? So this is the main provision regarding poem guidelines of a foreign company. And department should not take any arbitrary decision that poem is in India based on these following points. Merely because these happened in India, a foreign company cannot be said to be resident in India. So that guidelines are because of the foreign company wholly owned by an Indian company. Parent company is India. That is the reason, sole reason why department is saying that subsidiary foreign company is resident. No, that is not acceptable. That is acceptable only when here parent is India, Indian company or Indian resident, and that Indian parent company or resident is the ultimate decision making. Then we can say, okay, fine, that foreign subsidiary is said to be resident in India, even though it is a foreign company. Otherwise, it should not be a solved merely because foreign company is a so wholly owned subsidiary of Indian company. That is not a sole reason to conclude that residential status is in India. And second, foreign company has a permanent establishment in India. That means, simply speaking, a fixed place of business like a branch, factory, office, warehouse, godown. So a fixed place is located in India. Merely because of that, foreign company cannot be said to be resident in India. One or some of directors reside in India. Oh, no, that's not a criteria, right? At the time of taking board decisions or board meeting where it is held and where they participated, that should be seen. Okay, merely because they residing in India, that is not a sole reason. And the last one, local management in India pertains to support functions which are preparatory and accelerated in nature. That is, sometimes there may be a office in India for a foreign company to look after the day-to-day affairs and local management activity. They are not taking the core decisions. Simply the day-to-day affairs they are controlling from India. So merely because that poem cannot be said to be in India, because place of effective management means it is a place where key managerial and commercial decisions which are necessary for the conduct of the business of the entity as a whole in substance are made. So that decision should be core decision. That decision should affect the existence of the company. So it should be core decision, right? So day-to-day decisions are not relevant. So merely because that foreign company has a local office in India which will look after the primary functions of the company, that is not a sole reason to describe that subsidiary or that foreign company is a Indian resident. That is not accepted. So that is they are given in the guidelines. And if all these primary factors are not helping to find out the place of effective management, you can go to the secondary factors, because we couldn't find out the board meetings, we couldn't find out the real persons who are taking the decisions, we couldn't find out the location of the persons who are taking the decision at the time of that meeting or at the time of taking decision. So primary factors won't help. Okay, go to the secondary factors. If all other details are not available, then go find out where the substantial activity of the company carried out. That should be taken as the poem. And if that is also not available, find out from where the accounting records of the company are keeping, right? Usually it will be head office. So that can be taken as the place of effective management. This is the last resort. Last resort. If only all other details are not available, then we can find out use the secondary factors to find out the residential status of a foreign company. And this one also I will explain, then we'll go to the question. See, what will happen if a foreign company, because of the poem guidelines, it become resident in India? What is the impact? So the impact is very heavy, right? As we know, always the income tax provisions are created to support the government, right? Not to support the assessee. So there will be a very interesting situation arise. What is that? By incorporation, it is a foreign company. Because of the poem guidelines, it is resident. It is not an Indian company, not incorporating in India. It is a foreign company. But because of the poem, it is resident. It is resident. So the situation is foreign company but resident. So what will be the tax rate? So the tax rate, they are clearly mentioning the tax rate will be applicable to a foreign company, will be applicable to it. So even though it is a resident, tax rate of a foreign company will apply. That means 35% for our assessment in 25-26, right? 35% tax rate will be applied for the income taxable in India. For the foreign company, which is resident in India, but it is a foreign company. By virtue of the POEM guidelines, it become resident. Rate of tax continue to applicable to a foreign company, 35%. And the second major impact, it is a resident, right? Even though it's a foreign company, by virtue of the POEM guideline, resident, right? So global income is taxable in India. So income earned from any foreign country will be taxable in India. At that time, there will be another issue arise because foreign company have foreign operations and it has foreign income. Because of resident, POEM guidelines resident, will be taxable in India. But all those foreign income will be represented in foreign currency. So it should be converted into INR and it should be taxable in India. So what we will do? They are saying usually for converting the foreign income into Indian income, into INR, we have to apply rule 1115. So that rule 1115 should be applied. So for PGBP income, last day of the previous year, 31st March 2025, what is the telegraphic transfer buying rate of the SBI? That rate should be applied. So for house property income, last day of the previous year, what is the telegraphic transfer buying rate of SBI notified? So that rate should be applied to convert into INR. But regarding capital gain, the last day of the month, preceding the month in which transfer took place. Dividend income, last date of the month preceding the month in which dividend is distributed or declared. So likewise, salary also, in which month the salary due or received, preceding month, the last day, what is the telegraphic transfer buying rate of SBI? That rate should be applied to convert. So that rule should be applied to convert that foreign income into INR in respect of a foreign company which becomes resident in India due to the POEM guidelines. And the next issue is very dangerous issue. They are saying, okay, resident, right? You are a foreign company, right? So all foreign income would be taxable in India. Okay. So what about foreign losses? So no doubt, foreign losses can be claimed in India because foreign income includes foreign loss also. For the purpose of taxation purpose, income includes loss also. So foreign income will be taxable in India. Likewise, foreign losses, you can take it here. But they put a restriction. You are a foreign company, right? Yeah. POEM is in India, right? Yeah. So you are a resident, right? Yeah. Okay, do one thing. Take the foreign losses and set off that foreign losses only with the foreign income, if any, taxable in India. That will not be permitted to set off against Indian income. This is a very, very interesting rule because normally foreign losses we can set off against Indian income or foreign losses with the foreign income as far as you are a resident. But a foreign company, because of POEM, become resident in India, they will not permit that set off of foreign losses with Indian income. So they are saying as if it is not a resident foreign company, what would have been the impact? That should continue. So if it is not a resident foreign company, only foreign income will be taxable. Sorry, Indian income will be taxable in India. Indian losses will be permitted to set off. So that will continue. So that is another dangerous restriction. And now the next issue. If foreign income is taxable in India because of POEM is in India, so what about the foreign taxes paid there? Because in all those countries we would have been paid a tax because of incorporation there. So source is there. So all those countries will be taxed if it is a tax country. So what about the double taxation relief? They are saying no problem. All those tax paid in that foreign country, you can take a double taxation relief in India, either as per section 90 or 91. If there is a double taxation avoidance agreement between India and that foreign country, go to section 90 along with the double taxation avoidance agreement article 23A and 23B. Go there, find out tax credit method and claim the credit. And if there is no tax, the double tax avoidance agreement prevalent within that country, okay, then go to section 91. For the residents, if there is no DT agreement, we can claim that unilateral relief, that is a double taxation relief under section 91. That you can claim. But either section 90 relief or 91 relief, you must follow FTC rule, that is foreign tax credit rule, rule 128. So as per that FTC rule 128, you can claim a relief. So relief is possible. So what about losses incurred in a foreign country? If you take it in India, okay, they are saying it cannot be set off with Indian income, but that foreign loss you can set off with the foreign income, right? Got it. But if there is excess foreign loss after setting off with the foreign income, or if there is no foreign income, only foreign losses, that we can carry forward to India, right? Yes, you can carry forward. You can claim it in here and you can carry forward. So how we'll find out the time limit? Because usually business losses we can carry forward for maximum 8 assessment year from the end of the first assessment year in which such loss was computed. And if it is owning and maintaining racehorse loss and speculative loss, only 4 years is permitted. regarding unabsorbed depreciation, we can carry over infinite period. So what is the rule here? So they are saying, okay, find out in which year this foreign losses is first time incurred outside India. So maybe that is in 2022, 23 or 21, 22. Okay, from that year you have to count 8. If already 4 years is expired there, then remaining 4 years only will be allowed to permit to carry forward in India. So regarding loss, set off and carry forward, this is the rule. Set off restricted only with the foreign income. But Indian losses you have, you can set off with Indian income. But foreign losses allowed to set off only with the foreign income. Remember, this is not the universal rule. This is the rule only with regard to a foreign company which becomes resident in India due to POEM. For all other cases, resident and ordinarily resident, normal cases, foreign losses we can set off with Indian income. Foreign losses can be set off with any income, as far as you have to keep that set of rules. That is section 70 to 80. There are certain rules are there, right? So this should not be set off against this. So that rules you have to keep. Otherwise, you can set off with any income. But for this particular foreign company, they restricted that conditions. And now, the next point is, if the foreign company's loss is carry forward, this is the rule. Remaining period only you can carry forward. And the next issue is, what about the depreciable asset WDV? Because usually under the income tax law, we are computing depreciation on WDV method, and each and every year it's like a chain of transactions, because last year closing WDV, this year opening WDV, something like that. So what about the foreign assets located outside India? Because all those foreign assets we have to compute income in India and compute depreciation in India. Because if the foreign company's POEM is in India, the entire total income of that foreign company taxable in India. So all those foreign countries' income should be computed in India as per the Indian tax law. So depreciation should be computed as per section 32. So how we will find out the depreciation? So they are saying, go to that country. If there is a tax law prevalent, yes. Okay, if that as per that tax law, there is a closing written down value available as on 31st March 2024, yes. Then take down it to India as opening WDV as on 1/4/2024 and continue depreciation here as per section 32. So what will happen if there is no tax law? Okay, then take the WDV as per books of accounts prepared in that country. Take the closing WDV as the open WDV to current year and continue. So this is the rule. So whether additional depreciation is available if there is any eligible plant and machinery acquired and installed, and the company is not opting for 115 BAA or BAB, and it is an eligible plant and machinery, and the company engaged in manufacturing, yes, possible. Additional depreciation also you can claim, no problem. Regarding TDS provision, they are saying the rate of tax applicable to a foreign company only will apply. Even though it is a resident, TDS rate will apply as per the TDS rate applicable to a foreign company. And when there is a confusion, that is sometimes a provision of income tax law simultaneously applicable for a single transaction, two provisions will be applicable sometimes. For example, it is a foreign company, at the same time it is a resident. There is a provision which says that for resident, this is the rule. For foreign company, this is the rule. So there is a confusion because it is at a time it is a foreign company, at the same time it is a resident. So what we will do? So it's the last clarification, that is generally, unless there is any specific provision, the provision applicable to a foreign company shall continue to apply to it. Provisions applicable to a non-resident, not applicable. Provision specifically applicable to resident, applicable. So this is the rule regarding if any general provisions applicable, there is no specific rule is saying, then what we will do. So this is the rule. So this is the points connected to impact analysis. That is, if a foreign company become resident in India due to POEM guidelines, then what would be its other impact? So that impact we discuss. The major impact is all the foreign income would be taxable in India. And foreign losses you can take it here, but set off permitted only with the foreign income. Otherwise you have to carry forward. By taking carry forward, the period only remaining period should be considered. So we should find out the original year in which such a loss is incurred in the foreign country. From there, count 8. So remaining period only will be allowed to carry forward in India. Now we can go to the question. So how we will find out the residential status of a foreign company? This is the first question. Okay. So Simran Private Limited holds 55% of shares in Al Kubar Limited, a company incorporated in Dubai. Al Kubar Limited has its offices in India also. Details pertaining to Al Kubar Limited for the year ended 31st March 2025 are as stated below. Actually, Simran Limited holds 55% shares in Al Kubar Limited. So here the parent company is Simran Limited, that is an Indian company, because Simran Private Limited means it is an Indian company. But Al Kubar Limited is the associate here, that is a foreign company. Merely because an Indian company holding 51%, a subsidiary holding, that doesn't make that subsidiary is any resident. We cannot say like that. We should apply the test only. Otherwise, they should say Simran is the ultimate decision maker. So details of Al-Kubar for the year ended 24-25 in crore, right? Fixed assets after considering depreciation for tax purpose, 1,500, 650. For Indian company, for in India, they have 1,500 and in Dubai, they have 650. Other assets, value as per books of account, 800, 1,900. Intangible assets is also there, 225, 1,075. Income from trading operation, the above figures include income from transactions where sales are to AE. That is not a passive income. Income from transactions where purchase are from AE, not a passive income. Income from transactions where sales or purchases are to and from AE. Yeah, that is passive income. Interest and dividend from investments, passive income. Number of employees in India, 70, 90, unskilled and skilled, 530. Okay. Number of employees 70 and 90. Out of the 70 unskilled employees, out of the above mentioned total employees resident in respective country, in India 5 and in outside India 30. Dubai 30. Okay. Payroll expense on employees 940,250. Payroll expense on unskilled employees out of the above mentioned above, that is 415. And number of board meetings held 3 and 4. So this is the basic details. The question is determine the residential status of Al-Kubar Limited. See, simply looking into the data, we can say that number of board meetings in India is 3, number of board meetings outside India is 4. So we can say that it is non-resident. No, we cannot decide like that, because first we should go to the ABOA test. If active business outside India test, all the 4 tests is satisfied, okay, then fine. We can go to find out the board meeting route. So first test, the passive income of the foreign company should be less than or equal to 50% of the total income of the foreign company. So here, what are the passive income? So here the passive income is this one. This is the passive income, and interest and dividend 560 and 320. This is also passive income. So income from trading operations is 730,000, 1370. So this 730 and 1370 includes ABC. So interest and dividend income is separate. So what is the total income of the foreign company? That is 730 plus 1,370 plus 560 plus 320. This is the total income of the foreign company. That is this 730, this 1,370 plus this 560 plus 320. This is the total income of the foreign company. Out of which, what is the passive income? So passive income here is 45 plus 80 passive income, because it is income from transaction where sale or purchase are to and from AE. 45 plus 80 plus and interest and dividend 560 plus 320. So what is the percentage? Into 100. Passive income total divided by total income into 100. We'll get the percentage. 33.72. So anybody has any doubts in this calculation? Total income, out of the total income, passive income is 33.72%. The first condition is satisfied. The passive income of the foreign company is less than or equal to 50% of the total income. Remember, nothing to do with India. First condition doesn't say that Indian passive income. No. Passive income of the foreign company should be less than or equal to 50% total income. That is satisfied. And second test, value of assets in India should be less than or there is no equal to, less than 50% of the total assets. So fixed assets after considering depreciation for tax purpose in India, that is 1,500, and intangible asset 225, other assets 800. So 1,500 plus 225 plus 800. These are the assets located in India, divided by total assets. Total assets means 1,500 plus 650 plus 225 plus 1,075 plus 800 plus 1,900. So what is the percentage? 41.06%. Yeah, second condition also satisfied. value of assets in India is less than 50% of total assets of the company. Here remember, comparison, value of assets in India only. Don't consider other assets, right? While computing the total assets, we should consider India plus Dubai, but percentage purpose, Indian assets should be less than 50% of the total assets of the foreign company. Second condition satisfied. So, and the third condition, number of employees located in India, situated in India, or resident in India should be less than 50% of the total number of employees of that foreign company. So, here, number of employees in India is, number of employees, this is 70. Right? Whether skilled or unskilled doesn't matter. That is only to give some confusion to the students, right? We should simply find out the number of employees in India. Okay, so that is number of employees situated in India is 70, and what is the total number of employees? That is 70 divided by 70 plus 90. So what is the percentage? 43.7. Yeah, something percentage. Okay. That condition, third condition is also satisfied. Number of employees residing in India or stayed in India less than 50% of the total number of employees of that foreign company. And the fourth condition, payroll expenditure, payroll test. So here the payroll test, that is payroll expense on employees. This is, we should take only the first figure, that is 940. So 940 divided by 940 plus 1250 into 100. So what is the percentage? That is also 40. 2 point something. Okay, fine. You should, for exam purpose, you should write the exact percentage. 2 digits you have to, 2 decimals you have to write. Yeah, that condition also satisfied. So all the 4 conditions of active business outside India is satisfied. So we can say that active business is outside India for this Al-Kubar company. So we can go to the POEM guidelines. As per the POEM guidelines, if active business is outside India, to find out the POEM, find out the number of board meetings. If majority board meetings held in India, POEM in India. Other parties they are not saying, right? If majority board meeting held in India, POEM in India means if majority board meeting outside India, POEM not in India. So here total number of board meetings held in India is 3. Number of board meetings held outside India is 4. So total board meetings is 7. Total board meetings is 7. Out of 7, only 3 board meetings is held in India. So majority is outside India. So POEM outside India. POEM outside India. Accordingly, as per section 6, it is a non-resident. This company is a foreign company, is a non-resident. Since it is non-resident, it is good. Only Indian income is taxable. If they give the other details, we can say that they are not asking about that, just asking for residential status. In rare cases, for your first question, compulsory question, there is a possibility they will give the details of a foreign company. Along with that, they can give the POEM guidelines, and after finding out the POEM guidelines, you should find out the residential status. Then you should compute the total income of the company. In that case, if the POEM is in India and also that foreign company has a suppose they have a place of fixed place of business in India, that is P in India. In that case, there will be match book profit based on book profit minimum. Alternate tax provisions can also be applicable. So they can make it a lot of complicated provision. They can add on a single question if they want to. Generally, they are asking the computation of total income and tax liability of a domestic company as a compulsory question. In rare cases, they asked. I think 2 times they asked the compulsory question of a foreign company. Compute the total income and tax liability. So we can expect that. In that case also, sometimes question does not say it is a resident or non-resident. They will simply say it is a foreign company. Then they can give these details. Then we should go to there and find out the residential status and then come back and find out the total income. There is a possibility. Okay, just I'm saying a hypothetical scenario. First question is over. We can go to the second question. So the second question is purely related to purely a non-resident taxation provision. See, what we studied now is residential status of a foreign company, right? There are a lot of other tests for individuals and HEF. Sometimes they can ask for CF final also, they can ask residential status of an individual. In very short, in a brief way, I can tell you the residential status determination of an individual. Okay, simply I can say. Basically, there is a universal test. Whether you Indian citizen or foreign citizen, for all individuals there is a universal test, 182 days. If any individual stayed in India during the previous year for 182 days, then we can say he is a resident. Okay, if that is failed, usually we will go to the second test. The second test is previous year 60 days, preceding 4 years 365 days. 60 plus 365 satisfied, we can say the second condition, an individual can be said to be resident in India. Again, there is a problem. Indian citizen leaves India for employment outside India or as a crew member of Indian ship operating in international traffic. We cannot apply 60 plus 365 days test. Indian citizen leaves India for employment or as a crew member of Indian ship. We cannot apply 60 plus 365 days test. Number 2, Indian citizen or person of Indian origin. Person of Indian origin means either that individual or any of his parents or any of his grandparents born in undivided India. That is known as person of Indian origin. Indian citizen or person of Indian origin normally outside India comes to India during the previous year for a visit, not for permanent settlement, for a visit. He will come and he will return. In that case also, in the year in which he visited India, we cannot apply 60 plus 365 days test. In case he failed 182, we cannot apply second test. In these two cases, there is no 60 plus 365 days test in simple words. But we can apply universal test 192 in all cases. Now, the first cases, that is Indian citizen leaves India for employment outside India or as a crew member of Indian ship, no other test, only 192. Only 192. Indian citizen or person of Indian origin comes to India during the previous year for a visit. They failed 192. We cannot apply 60 plus 365. But their Indian sourced total income exceeds 15 lakhs. Then we can go to a special test. That special test says previous year 120 days stay and preceding 4 years 365. 120 plus 365 satisfied. Such persons will be treated as a resident but not ordinarily. Normally ROR, RB, NOR additional test we should apply, but here no additional test. Always they will be treated as resident but not ordinarily. In case of Indian citizen or person of Indian origin comes to India during the previous year for a visit, they failed 192. We cannot apply 60 plus 365, but their Indian source total income exceeds 15 lakhs. We applied 120 plus 365 and satisfied. RB, NOR, resident but not ordinarily resident. Sir, what will happen if Indian source total income does not exceed 15 lakh? Non-resident. While taking Indian source total income, all Indian income must be considered and 2 foreign income should be considered. 2 foreign income means foreign business income if the business is controlled from India and foreign professional income if the profession is set up in India. These 2 foreign income should be considered for the limited purpose of calculating that 15 lakhs. Act uses the word Indian source total income. So should be careful. Salary computed, HP computed, PGBP computed, capital gain computed, IFOS computed, clubbing set off, GTI, 80C to 80U chapter 6A, total income. But if the question specifically says he doesn't want to go with the default tax regime, he want to opt out, then only we should claim chapter 6A. Otherwise, you are aware, for 115 BSc assessees, they can claim only limited chapter 6A reduction, 80C CD subsection 2. 80CCH subsection 2 and 80JJAA. Only these 3 is possible. All the chapter 6 are not possible for 115 BSc default tax regime assessees. So if the act use total income, remember, computed after claiming chapter 6 everything. And now there is another interesting test. That is, you are an Indian citizen. Okay, you are an Indian citizen, but you are not liable to pay tax in any country. So we can take interpretation in 2 ways. Number 1, you are not resident in any other country. And number 2, another interpretation, you are located in a tax haven country. Maybe Bermuda Island, Gibraltar, Cyprus, to some extent Singapore, Hong Kong, Netherlands and Antilles. Such type of country. We can say tax haven country. So, but you are an Indian citizen, right? You are an Indian citizen. You are not satisfying any of the test. 192 failed. No 192. No 60. 60. Usually we cannot apply 60. 192 not satisfied. No other test is satisfied. But you are an Indian citizen. You are not liable to pay tax in any other country. That means you are not resident in any other country. Or we can say you are located in a tax haven country. Your Indian source total income, as early, same as early we discussed. That is Indian income plus 2 foreign income total exceeds 15 lakhs. If these three conditions are satisfied, even though you never visited India during the previous year, you will be treated as deemed resident but not ordinarily. Section 6 subsection 1A. So section 6 subsection 1A applicable only for Indian citizen, not liable to pay tax in any other country, and their Indian source total income exceeds 15 lakhs, but he is not satisfying any of the basic conditions to find out residential status. Okay. If these three conditions are satisfied, you will be treated as deemed resident but not ordinarily resident. 6 subsection 1A. For exam purpose, remember one important thing. We will apply section 6 subsection 1A only if failed all other tests. But do not jump into this test first. So this is the last resort. If all other tests failed, but these three conditions satisfied, Indian citizen, even person of Indian origin is not covered. Only Indian citizen, not liable to tax in any other country, Indian source total income more than 15 lakhs. Even though he never visited India during the previous year for a single day, but still he will be treated as deemed resident but not ordinarily resident. So targeting high net worth individuals, right? Very rich people. They purposefully try to avoid residential status in any country. In India, they will stay for 20-30 days, then they will go to Hong Kong, they will stay for 2 months, 3 months, then they will go to Singapore. They may have private jets, okay? Simply do like this. So they won't be resident in any other country. So to target those people, they created this provision. But even though they made the provision resident but not ordinary resident, not much more utility, because if you are RBNOR, only Indian income, only 2 selected foreign income can be taxed. Not all the foreign income. One is foreign business income controlled from India and foreign professional income set up in India. All of the foreign income cannot be taxed. So by creating that deeming provision, not much more utility. Okay. So residential status part is over. Remember, the most important thing is if you are resident, global income is taxable in India. So if global income is taxable in India, definitely there is a possibility of double taxation. Because of residential status, you are taxing a foreign income in India. In that country, it is their income. Because based on the source, it is foreign income. So that country will definitely tax there. So India, based on residence rule, taxing here. So there will create double taxation. This is known as economic double. There are 2 types of double taxation: economic double taxation and jurisdictional double taxation. This is known as jurisdictional double taxation. That means for the same person, same income, taxed in 2 different countries. India is taxing based on residence principle for residents, and the foreign country is taxed based on a source principle. They are taxing there. So double taxation. So in those situations, you can claim relief. Number 1, if there is a double taxation avoidance agreement as per section 90, by using foreign tax credit rule 128, you can claim relief in India. And if there is no double taxation avoidance agreement with that country, but you are resident, there is a double taxation arises, go to section 91 and you can claim relief under section 91. Here also calculation as per rule 128 of the foreign tax credit rules. Remember, this second relief, that is if there is no double taxation avoidance agreement, this relief is available only for residents. For non-residents, they can use the benefit of double taxation avoidance agreement only. If there is no DT agreement, they won't get relief through section 91. Section 91, unilateral relief is created only to get advantage for residents only. So non-residents will get only DTA relief. And now, this is a major impact of residential status concept, and obviously rate of tax purpose, you know, if it is an individual and you are resident, you can claim section 87A rebate. If you are non-resident, 87 rebate is not available. If you are a resident, unexhausted basic exemption limit can adjust against long-term capital gain, even 111A short-term capital gain, even 112A special long-term capital gain. You can adjust the basic exemption limit if there is any balance. Basic exemption limit, you are aware regarding normal default tax regime, what is the basic exemption limit? That is 3 lakhs, and in opt-out, 2,50,000. If you are resident and senior citizen, you will get 3 lakh and 5 lakh basic exemption in opt-out. In default tax regime, there is no senior citizen concept, right? And now, if you are resident only, you will get some of the chapter 6 reductions: 80 QQB, 80 RRB, 80 DD, 80 DDB, 80 TTB, these 5, and one more is there, 80U. These 6 chapter 6 reduction available only if you are resident. So rebate, 87 rebate, only residents. Unexhausted basic exemption adjusting against a flat rate taxing long-term capital gain and 111A short-term capital gain, you should be resident. Opt-out, to get the extended basic exemption limit for resident, senior citizen and very senior citizen, you should be resident. Then only you will get that benefit. So in PGBP 35D preliminary expenditure deduction available only to residents. So for residents, there are a lot of other advantages also. So disadvantage for a resident is global income will be taxable in India. Foreign income will be taxable in India. So residential status has a lot of importance in a lot of areas, right? That you should be keep in mind. One more amendment you should keep in mind. If you are resident, individual or HEF, you are making a transfer of a long-term land and a long-term building after 23rd July 2024, there is an option. You can claim indexation benefit only for the limited purpose of taxation, tax rate. After 23rd July 2024, you are resident, transferred a land and building, and you want to claim indexation benefit. Remember, you won't get the exemption benefits, right? Tax planning benefits not available. 54B, D, ECF, those benefits won't be available because this is only for the limited purpose of reducing the tax rate. So at the time of computing tax liability, you can choose this option. Without indexation, rate of tax, new rate of tax 12.5, or with indexation 20%, only for that purpose. So after claiming, after 23rd July 2024, you transferred a land or building, you are resident, you claimed indexation, resulted in a loss, you cannot set off that loss, you cannot carry forward that loss. So to get the benefit of that amendment also, you should be resident. Now, now we are going to find out the NR taxation, major provisions of taxing income. Okay. So for non-resident assessee, the major provision regarding the taxation principle is section 115A, 115AB, 115AC, and 115AD. So that is the major area. So majority of the foreign non-residents income is governed under section 115A. So as per section 115A, if a non-resident received income by way of royalty, fees for technical service and dividend, it will be governed by 115A. But there are certain specific dividends which will be governed under other provision. That is, for example, 115AB, mutual fund dividend governed under 115AB. GDR, Global Depository Receipt and Bonds, governed by 115AC. And foreign institutional investors, 115AD. So other than AB, AC, AD, generally, normally a non-resident getting dividend from Indian company, whether listed or unlisted, it will be governed by section 115A. Royalty, 115A. Fees for technical service, 115A. So 115A mainly covers interest, royalty, fees for technical service, dividend. Interest is also covered. Okay. Now we are discussing royalty and fees for technical service. So first of all, to get royalty and fees for technical service, there must be an agreement between Indian entity and that non-resident. That is for the between the payer is Indian resident or government, and payee is non-resident because payee is getting the income. So payee is non-resident. So there must be an agreement between these two parties. First condition. Number two, this non-resident should not have a fixed place of business in India. If he has a fixed place of business in India for the purpose of providing the technical service and to provide these intangible assets like trademark, patent, copyright, franchise, license, etc., because for that he is getting royalty. To provide these services, if he opened an office in India and maintained books of accounts in that office, and that books is audited by a chartered accountant, then it is not governed by section 115A. Then such a royalty and FTS will be governed by section 44DA. We can say 115A gross basis taxation and 44DA net basis taxation. Net basis taxation means all expenses you can claim, even depreciation on the assets used in Indian permanent establishment can be claimed, everything can be claimed, or even you can show a loss. General provisions of PGBP income will be computed as per 44DA. But to attract 44DA, the main condition, non-resident should have a permanent establishment in India, and the services should be rendered along with or through that permanent establishment. Books should be maintained, audited by chartered accountant, and agreement with the client should be entered after 31st March 2003. If all these four conditions satisfied, net basis taxation. Any one of these conditions not satisfied, 115A gross basis taxation, no expense, no chapter 6A, and flat rate. It will be flat rate 20% tax. But under 44DA, not flat rate taxation, depends upon status of the non-resident. Net income taxable. If it is a non-resident individual, slab rate. If it is a foreign firm, 30%. If it is a foreign company, 35%. But that is applied on net income. Or sometimes maybe loss, no need to pay tax. So the income will be less under 44DA. But under 115A, expense not allowed, and chapter 6A also not allowed. But set off is possible if you have any other loss, but chapter 6A not possible, expense is not possible. Even any expense incurred for generating such a royalty and FT is also not allowed. And it will be taxable at a flat rate. This is the provision. Yeah. Yeah, under 115A, I told it not available, right? 115A, royalty and FTS, chapter 6 is available. Regarding interest and dividend, chapter 6 are not available. This is correct. Chapter 6 is available, but for example, ATG, if they have ATG donation, normally foreign company will have ATG only because all of the chapter 6 are not possible, right? Life insurance, premium, medical, that's not available. ATG will be there, that is possible. Chapter 6 reduction available, but under 115A, dividend and interest, total 4 income in 115A, for dividend and interest, chapter 6 also not available. Expense also not available here, and flat rate 20%, subject to DTA. Subject to DTA means if that non-resident country, he is a resident in a country, and that country and India has a double taxation avoidance agreement, and if double taxation avoidance agreement provides for a lower rate of taxation than 20%, that can be applied. Or if double taxation avoidance agreement says that not at all taxed in India, then it cannot be taxed in India. So subject to DTA. But there is no such word in 44DA, because under 44DA, if you have a permanent establishment in India and the business income is computed as per PGBP provisions, double taxation avoidance agreement will not provide for a lower rate of taxation. DTA agreement won't reduce the tax liability in India. Only in gross basis taxation, DTA agreement will come into play. And if there is no agreement, see, there are a lot of conditions, right? There should be an agreement. Agreement should be entered on or after 31st March 2003, and all other conditions are common. Book should be maintained, 44DA. If no books is maintained, 115A. No PE, 115A. So these are the provisions. And if there is no agreement or agreement is not approved by government, then as per the general provisions of the income tax law, income should be computed. That means if the non-resident does not have a does not have an agreement with the Indian entity, or even though there is an agreement, that agreement is not approved by central government, in that situation, 115A will not be working. In that case, it will be treated as a normal income of a non-resident. As per normal provisions, it will be calculated. Expense can be claimed, but rate of tax will be status of the assessee. This 20% gross basis taxation possible only if there is an agreement between non-resident and Indian entity or Indian government, or that agreement should be approved by central government. Or in some cases, there may not be a specific agreement, but that agreement will comply all the conditions of industrial policy mentioned by the central government. In that situation, it is equal to an agreement. So either they should say there is an agreement, or they should say agreement approved by central government, or they should say in the question agreement is as per the industrial policy. Any one of these indications should be given, then only 115A. Otherwise, we should go to the general provision. Expense can be reduced from the royalty, and remaining income will be taxable at a normal rate applicable to that non-resident. If the question is silent regarding agreement, students has an option. Either you can put an assumption, it is assumed that agreement is entered, and go to 115A. Or if you take an assumption there is no agreement, then you can take as per the normal provisions of the income tax law. This income can be taken either to PGBP or IFOS, because royalty and FTS, either you can take in PGBP or IFOS. You can claim expense, and net income, normal rate. If it's a foreign company, 35. If it is a non-resident individual, slab rate. If it is a foreign firm, 30. If the question say PE, books of accounts, audited, and agreement after 31st March 2003, yeah, go to 44DA. So 44DA typically like PGBP. So all the expense can be claimed. Even the assets kept in that permanent establishment, we can claim depreciation. If for the PE office you are paying rent, you can claim it as expense. If there is a employee and you are paying salary, you can claim. Every expense you can claim from the royalty income and FTS, net will be taxable. This is a provision regarding royalty and FTS. Now, what is a provision regarding interest income? So, interest, there are a lot of rates. You have to by heart it, because the different criteria is there. If the interest is received from infrastructure debt fund, corresponding TDS will be deducted by IDF in India at 5%. The TDS section is 194 LB. Rate of tax is also 5%. It is known as concessional rate of tax, 5%. because normally the interest is taxable at 20%, but if it is from IDF, 5%. And if the interest is issued by non-resident unit holder from a business trust, that is the real estate investment trust or infrastructure investment trust located in India, and a non-resident subscribed to the units of this business trust, and for that units they are getting interest. Or it may be received by business trust from SPV, that is business trust invest the money in special purpose vehicle, which will be an Indian company. Main object is real estate development, and SPV will give the interest income in return for the investment made by trust in the SPV. The SPV, that is Indian company, will give interest income to trust. Trust cannot take that income, they should distribute to the investor. The ultimate investor is non-resident unit holder. So in that case also, this interest income will be covered under concessional rate of tax 5%, TDS rate is 194 LBA. Third one, Indian company took a loan from foreign company or a non-resident, and there is a specific loan agreement approved by central government, or Indian company issued a rupee denominated bond RDB, and from that non-resident is getting interest 5%. So the payer is either Indian company or a business trusted or rupee denominated bond, but it is either by way of loan or RDB, and agreements should be specifically approved by central government. That is 5%. In all other cases they are saying, and in between there is a very concessional rate of 4% is there, but there is a specific period is mentioned. That period you have to by heart. In NR taxation, the most complicated area is interest, because different dates and conditions will confuse. So by heart. So Indian company or business trust or any long-term bond or rupee denominated bond, the period is 1/4/2020 and 30th June 2023. The bond should be issued, or the long-term bond or RDB should be issued between this period, plus that bond is listed on a recognized stock exchange located in International Financial Service Center, that is the GIFT City, Gujarat. So if these two conditions are satisfied, between this period 4%, but after 30th June 2023, the rate will be 9% for the interest received. And in all other cases, if the loan is given to an Indian entity but not covered in all these 3 or 4 category, and the debt is incurred in foreign currency, then 20%. In all these cases, debt must be incurred in foreign currency. That is, the non-resident should give the loan amount in foreign currency. If it is given in Indian currency, remember, these provisions not applicable. 115A not applicable. Normal provisions of the IT Act, that interest can be taken as income of the non-resident because it is accrued in India. Expense can be claimed. Balance net interest taxable at the normal rate. And from the interest income, we cannot claim Chapter 6A deduction. Only Chapter 6A possible is 80LA. 80LA is a specific deduction available to unit located in IFSC, International Financial Service Center. All others won't get 80LA. So no other Chapter 6 available. And 30 to 37 expense, or even if you show the interest income under IFOS, you cannot claim expense under 57. If you show this income under PGBP, you cannot claim 30 to 37. Any of the expenses are not possible. And only this income, and the payer properly deducted TDS, and the rate deducted is not less than the rate under section 115A. 115A rates are 5, 4, 9, 20. So at these rates, TDS is deducted by the payer from India, and the non-resident does not have any other income. Then no need to file ITR by the non-resident. There is a very important point you have to keep in mind. They are saying only this income and tax deducted by payer and TDS rate not less than the rate under 115A. See, sometimes the rate prescribed under double taxation avoidance agreement may be lower than 115A rate. So if that non-resident is giving tax residency certificate and all other conditions satisfied, then the payer will deduct the TDS at the rate prescribed by DT agreement, if that is more favorable to non-resident. Sometimes that rate may be 2% or 3%, less than 5. In that case, the payee must file ITR. So they are saying the TDS rate is not less than the rate under 115A. So the TDS rate should be as per 115A. Then only this exception from filing ITR will be available to the non-resident. And this is the provision regarding this interest income. Okay, and now the next one is dividend income. So dividend income, as we discussed, a flat rate 20%, expense is not possible. Chapter 6A not possible. Only this the dividend income, and dividend from that dividend income TDS is deducted as per section 115A rate. Then the payee need not file ITR. And the next point is loss set off. In all these three areas, if the non-resident has any other loss in India, eligible loss in India, they can set off, no problem. No restriction for loss set off, because loss set off is prescribed under chapter 6 of the income tax law. They are saying chapter 6A not possible. They are not saying chapter 6. So chapter 6 is possible. That is, loss set off is possible. Rate of tax normally for dividend and royalty and FTS flat rate 20%. For interest, there are 4, 5, 9 and general rate 20%. But regarding interest, there is a common rule. The debt must be incurred only in case of foreign currency. So if the debt is incurred in, that means if the non-resident is given the debt in INR, Indian rupee, then this concession rate for interest is not available. These are the main provisions of non-resident in brief. And there is another important area, capital gain. So capital gain area we can discuss separately, because if the non-resident can invest only in units of mutual fund or shares or debentures. A non-resident cannot make investment in immobile properties in India. So capital gain will be only shares or debentures or units. A non-resident cannot purchase land or building or other tangible fixed assets in India because of FEMA restrictions. A US citizen cannot buy property in India, right? So only non-resident's capital gain means your mind should be capital gain from shares or debentures. Share may be listed or unlisted. Debentures, mutual fund, RDB or bonds. Only this, securities. That we'll discuss separately. Okay. Now we can go to that particular question. Okay. That second question. So Cherry Limited, a non-resident German company, has the following income in India during the year ended on 31st March 25. Okay, it's a foreign company, non-resident. They're clearly saying non-resident. Dividend income of rupees 12,50,000 from XY Limited, an Indian company listed on recognized stock exchange. So whether the Indian company is listed or not, nothing to do with the dividend provision. Whether listed or unlisted, only one provision, 20% flat. But if DTA says that a lower rate, that can be applied. Normally 20%. So this 12,50,000 will be taxable at a flat rate of 20%. 8% debentures of rupees 20 lakh received from X Limited, an Indian company, on October 1st, 2024, in consideration of providing technical know-how, date of payment of interest being March 31st every year. So you should read carefully the second sentence, second part, in consideration of providing technical know-how. So already this Cherry Limited provided some technical know-how in India to the Indian company, that is X Limited. In return, the fees is received by way of debentures. So there are two income. Number one, fees for technical service, or as it is know-how, we can say royalty. Both are interchangeable, no problem. But royalty or fees for technical service, domestic taxation, no difference. So this is first of all fees for technical service or royalty, 20 lakhs. So that should be taken. That's a separate income. And then from this debenture, definitely they will get on 31st March interest. But these debentures are, they are saying issued on 1st October 2024. So for the first year, they will get interest only for 6 months. October, November, December, Jan, Feb, March, 6 months. So two income, interest income from debentures and royalty or fees for technical service by way of 20 lakhs for providing technical know-how. Two income is there in the second adjustment. And what is the tax treatment? Debentures of X Limited issued in India. So non-resident not subscribed the debt in foreign currency. They subscribed the debt in INR, because these debentures are issued as a consideration for their technical know-how. So foreign currency does not flow into the country. Non-resident simply came here and provided the technical know-how and he get debentures. So this debt is not in foreign currency, it is in Indian rupee. So this 8% interest from debentures for 6 months will be taxable at the normal rate. Okay. We cannot apply the specific rate. Okay. And for regarding technical know-how, they are not saying regarding any permanent establishment or something like that. They are not mentioning that there is any agreement for providing royalty or technical know-how. Nothing says regarding industrial policy or something like that. So we can say that two views are possible. The primary view, there is no agreement between Indian entity and foreign company. So it will be treated as a general category and normal rate applicable to that company, it will be taxable. Or if you take an assumption, you can put a note. It is assumed that there is a specific agreement between X Limited and Cherry Limited for providing this technical know-how. And that agreement is approved by central government. Or that agreement is as per industrial policy. Okay, then you can take 115A. Definitely 44DA not possible because there is no permanent establishment, something like that. So two views are possible. I think in the suggested answer they are taking the view of no agreement. So normal rate. Normal rate means 35%. Third, dividend received rupees 5,50,000 on global depository receipts of Y Limited, an Indian company issued under a scheme of central government against the initial issue of shares of the company and purchased by Cherry Limited in foreign currency through an approved intermediary. If you see GDR, you must keep in mind it is definitely section 115AC. So GDR income, income by way of return from GDR as well as capital gain from GDR is governed by section 115AC, flat rate 10%. So this dividend from GDR will be taxable at a flat rate of 10%. All the conditions mentioned under section 115AC has been satisfied here. That is, the debt must be incurred in foreign currency. That is one of the conditions they are saying regarding a GDR. So that condition is satisfied here. And for 115AC, any non-resident bonds or GDR subscribed, expense is not possible. Chapter 6A not possible. If only this income and the payer deducted TDS, now need to file the ITR. TDS will be deducted by the payer under section 196C. And foreign currency fluctuation not applicable, indexation benefit anyway not applicable, and long-term capital gain tax will be 10%. If it is after 23rd July, long-term capital gain tax rate will be 12.5%. And income, that is return, 10% flat, 10% flat. Here it is dividend from GDR. So interest or income, dividend income, both are same rate, 10%. So this should be taken, concession rate of 10% should be taken if the return from GDR. So 115AC section is applicable in that particular adjustment. And then they are saying business income of 8 lakh from a unit established at Mumbai. So Mumbai is in India. Directly they are carrying out business in India. It is absolutely an Indian income. It will be taxable at a normal rate. It is not a special item. It is not interest. It is not dividend. It is not royalty. It is not FTS. It is not capital gain. Business income, normal rate. So business income of 8 lakh will be taxable at a normal rate of 35%. So foreign company's rate of tax is 35. Income by way of royalty other than referred to in section 44DA amounting to 10 lakhs received from Z Limited, an Indian company, in pursuance of an agreement approved by central government. As per double taxation avoidance agreement between the two countries, such royalty is taxable at the rate of 25%. Okay. 115A domestic law rate of tax for this particular royalty is 20. DTA agreement rate is 25. So whenever there is a conflict between double taxation avoidance agreement and domestic law, whichever provision is more beneficial to assessee can be applied as per section 9D subsection 2 of the income tax law. So DTA will override income tax law if it is beneficial for assessee. But here it is not beneficial because DTA rate is 25, normal rate is 20. So 20 is better. So we should take 115A 20 rate for that particular income royalty. See, because in the fifth adjustment they are clearly saying in pursuance of an agreement, definitely we can say that in the second case technical know-how, there is no agreement. So that is why the primary most apt assumption will be there is no agreement in second case. Okay. And how the income will be computed. Dividend income, they are saying dividend income. If they are saying dividend income, it should be treated as gross. There is a general rule when the non-resident received income from India. If they say received income, definitely the payer will deduct TDS. So the income received will be net of TDS. But if they are saying dividend income, interest income, gross, or they are saying dividend earned, income earned, gross. So otherwise it is net. So first item dividend income, that is we can say take it as gross. Second, 8% debentures received from X Limited, 8% debentures of 20 lakhs. So that 20 lakhs is gross. Interest also will be, we can compute directly gross. Third one, you should remember, dividend received. Dividend received. So dividend received means it will be after deducting TDS. As per 115 AC, the TDS rate will be 10% plus cess. Whenever we are deducting TDS for the payment made to non-resident, we have to apply education cess and surcharge if applicable. So here surcharge is not applicable because the amount does not exceed crores. So we have to deduct the TDS with the cess. So this 5,50,000 is after deducting TDS of 10.4%. So we have to gross up. Gross up amount must be taken for dividend. Business income, they are saying business income. Okay, it's gross. Income by way of royalty amounting to 10 lakh received from Z Limited. Received. So that is also again net of TDS. So we have to gross up. So this income should be gross up. Okay. So I will show the presentation. Okay, how it should be presented. So if you feel any confusion regarding taking an assumption, always the better we use put a not. Okay, put a not. It is assumed that like this. But if wrong assumptions are made, definitely it will be a problem. They won't give you the credit. You should put an assumption, right? So this is a solution. Business income from a unit established in Mumbai, 8 lakhs. It is gross. Dividend income, they are using the word dividend income. So then we can directly take as gross, 12,50,000. Fees for technical service, it is assumed that no agreement is entered into. So that 20 lakhs should be taken. Remember, 20 lakhs instead of getting as fees, they are getting debentures. So that represents fees. So 20 lakhs. And interest on debentures, that debentures was issued on 1st October only. So for the current year, they will get only 6 months interest. So 80,000. That's also gross. Because we know the debenture, face value of debentures. So simply apply 8% for 6 months, that's gross. Dividend received from GDR. They're clearly saying dividend received. Received means definitely the payer has to deduct TDS. So the what amount they will receive is net of TDS. So we have to take the gross amount. Gross. So TDS will be 10.4%. That is 10%, 115 AC GDR tax rate, 4% cess. So 10.4 reduced, balance 89.6. So gross amount will be 6,13,839. Royalty income received, again received. So this royalty clearly saying agreement is entered and approved by central government. So 115A, flat rate 20% plus cess. So 20% plus 4% cess. So 20.8 will be the TDS rate. So grossing up 1262,626. So this is the gross total income. Out of which, remember, first dividend income from XY Limited Indian company, which will be taxable at a flat rate of 20%. Business income 35% normal rate. Dividend 115A 20%. Fees for technical service, as there is no agreement, this 20 lakhs will be taxable at 35% normal rate. Interest on debentures 80,000. Money incurred in Indian currency, not foreign currency. Debt is not incurred in foreign currency. So 115A cannot apply. Normal provision 35. Dividend on GDR 115 AC 10%. Royalty income 115A 20%. This is a tax rate. And the total income exceeds 50 lakhs, but it is a foreign company. For foreign company, surcharge will be applicable only if the total income exceeds 1 crore or 10 crore. So here no surcharge, just tax, compute the tax, add health and education cess. Question asked for tax liability only. So as the question asks for tax liability, you just calculate tax and cess and add it. Do not reduce TDS. If the question asks for tax payable or refund, if the word used is payable or refund, we should reduce TDS. If the question asks about tax liability, before reducing TDS, we should double line the answer. So this is the tax calculation. So dividend income of 12,50,000, 20%, section 115A. Dividend on GDR 115A 10%, royalty income 115A 20% as per agreement. FTS no agreement, and it is as per it is received by way of debenture. The main problem is there is no agreement. So 35%. Interest on debentures also 35%. Because reason is that is incurred in Indian currency. And the business income also 35%. Add health and education as a tax liability. So TDS, yeah, we are not reducing. This is the reason because question asks only tax liability. If the question asks for tax payable or refund, then we will reduce the TDS. So here, if the question asking for tax payable, we will reduce the dividend from TDS from this particular that is royalty TDS and dividend on GDR. These two TDS we will reduce. Any doubts? Clear? So NR taxation, when you study the major topic of NR taxation, we can classify into three areas. Number one is residential status, especially foreign company POIM guidelines, all those related topics, impact analysis, impact notification if a foreign company becomes resident in India because of POIM. That's the one area. And the second area, little bit more important. The second area is 115A, AB, AC, AD. AD meaning especially foreign institutional investors and their computation of total income and tax liability. If they want to ask a question from 115 AD, 100% it will be a problem. Already study material contains some foreign institutional investors problem is there. So that you can practice. That only is enough. With capital gains provisions also. So remember, 112 long-term capital gain, right? We are studying under capital gain, special long-term capital gain, listed equity shares and equity-oriented units of mutual fund and units of business trust. Those area that is commonly applicable for resident as well as non-resident. So whenever they are asking a question for capital gain listed shares for non-resident, the same way 112 way how we will calculate that should apply here also. There is no special provision for listed. So 115 A, AB, AC, AD. In 115 AD, with the foreign institutional investors, they sometimes ask capital gain questions also. So if there is 112A capital gain, we should apply 112A only. So there are a lot of other special rate prescribed in 115AD that you have to study and practice that question. That will be enough. 115AB and AC, only with the AB and AC, they will never ask a question because there is no scope for a problem from, because of that two sections are very small, they won't ask a question. But like this, with another non-resident taxation question, they can add the adjustments from 115 AB or AC. But 115 AD will be an independent question. If they are asking, it will be an independent question. But 115 A, interest, royalty, FTS and dividend. Either they can ask some theory question, they may ask some multiple choice questions, or they can put it in a case scenario, or they can ask a question like this. Usually the trend of the institute from in respect of this area is like this. The question is similar to this. That's why I selected this question. And here one more thing, it's very important. See that second item, majority of students will make a mistake. They will take the debenture interest income. They won't take the technical know-how. Some students will take the technical know-how as the royalty income or FTS. They will omit it to take the interest income. Remember that is true. And furthermore, don't apply 115A because debentures are issued in India. So it is not in foreign currency, debt is incurred. So the income, interest income, they won't get the concessional rate. It will be taxed at the normal rate of 35. So that is very important. And this is a second area. And one more area connected to the second area, that is presumptive taxation for non-residents. 44B, 44BB, 44BBA and 44 BBC. So all those four sections are very important. That is actually the reason one of that cruise ships last presumptive taxation is the recent amendment. So these four sections are important. Sometimes they will ask a question directly from this topic. This is the second area. And the last area of non-resident taxation, we can say 115 BBA, that is non-resident sportsman, non-resident association, non-resident entertainer, non-resident sports association. They are getting some of the income from India, participation in games, participation in advertisement. So those type of income will be taxable at a flat rate of 20%. So without any benefits, expense or chapter 6A or loss set off or basic exemption, without any benefit, flat rate taxation. So that they can ask. So in addition to that, related to that question, they can put some normal income in India also. They are getting some other income from salary or FD interest or some house property income. They can add such a type of area. That is another adjustment. And last part of NR taxation is purely theory. That is TDS, provisions of non-resident, especially what are the TDS specifically applicable to non-residents. And representative assessee. An agent of a non-resident in India will be treated as the representative assessee of non-resident. So what are the circumstances where a person can be treated as an agent of a non-resident? Those type of theory. And the recovery of tax of a non-resident from agent, and if it is not possible, how the tax will be recovered. All those theory area. So these are the major areas of NR taxation. And out of 30 mark international taxation, as you are aware, minimum 10 marks they will ask from 8 to 10 marks they will ask from NR taxation. Sure, it's the biggest chapter. And another biggest chapter is transfer pricing, TP. And another chapter is double taxation relief. And then authority for advanced ruling. Other chapters are, it's theory. that is base erosion and profit shifting, BEPS action plans, model convention, UN model, and OECD model. What are the difference between various articles of DTA agreement? All those are actually theory. Last moment, if you couldn't get confidence and all those things, I will say leave it. You couldn't cover that, leave it. But these 4 chapters, don't take risk. Non-taxation, TP, double taxation, authority for that story. Mandatory. Compulsorily, they will ask questions from these 4 chapters, and major questions are coming from this area. It's very important. Okay. Now, and there is recently there is another amendment also there. It is put in the RTP. You have to read that. That is as per the provisions of section 9, subsection 1, business income of a non-resident deemed to accrue or arise in India if the non-resident has a business connection in India. But there are certain exceptions. Non-resident engaged in news agency in India, that is collection of news and views from India for transmission outside India, not taxable. Non-resident foreign diamond mining company engaged in display of uncut or unassorted diamonds, it is not taxable. Display income. The act was silent regarding what about sales. Okay, if they have sales or sale of diamonds in India, definitely it will be taxable. But the income should be calculated on a presumptive basis. For that purpose, they put safe harbor rules. So that safe harbor rules is now notified for this type of non-resident foreign diamond mining company earned income from sale of diamonds in India. If they have income from display, no tax at all. 9 itself is saying that is not deemed to occur as in India, because primarily they are putting that condition to attract foreign diamond mining companies in India. But if they started active operation, sale of diamond, then it will be accrued and taxable. In that situation, practically there are a lot of difficult situations to compute their actual income, because diamond is mined from some other country, so the cost is incurred somewhere else. They put it into here, making marketing and selling it. So how the expense will be claimed? A lot of dispute will arise. So that is why they are saying we will put some safe harbor rule, presumptive taxation like that. So if you show this much income of your sales, we will accept that. So that is safe harbor. Circumstances under which department will accept the income declared by assessee. That is not a safe harbor basically. So safe harbor is notified for that area. That is a major amendment in this topic and not taxation. So you should go through it. If we got the time, last day, we can discuss that. Otherwise, you should read it. That's very important. They may ask a question from that. And there is a simple question explaining that concept available in your RTP. That you can go through that. By reading that amendment, go through that question. That's enough. And now, the next third, we are going to the third question in our handouts. Yeah, this is presumptive taxation, right? This is presumptive taxation. See, I am combining 2 presumptive taxation into this question. It is actually an old RTP question, right? But it's a good question. So, this section deals with the presumptive taxation of non-resident engaged in shipping business in India and non-resident engaged in aircraft business in India. Carriage of goods and passengers through aircraft and carriage of goods and passengers through ship. So, these 2 type of presumptive income we are discussing now, right? First, we can go through the provision, right? And then we will come back to and solve this question. So, 44B is providing the provisions for non-resident engaged in shipping business, right? Shipping business. So, that is if a non-resident engaged in shipping business in India, first we should find out what are the total freight collected from India. So, while taking the freight collected from India, there may be 2 situations. Number 1, for carriage of goods from or passengers from India, originating port in India, destination port is outside India. For that transaction, if they are getting money either in India or they are getting their freight outside India, it doesn't matter. It should be considered here because origin from India means accrued in India. It is Indian income. Situation number 2, originating port or airport for 44B as well as 44BBA, same provision. Originating port is outside India, destination port or airport in India. Actually, the income is accrued in a foreign country. Income is accrued in the country where the port is located, because originating place is the place where we are generally treating the place of accrual of income. So, if a non-resident engaged in shipping business or aircraft business in India, but the starting point is outside India, destination in India, to consider the income from that activity in India, it should be received in India. That freight should be received in India. So, originating port is outside India, and the freight also collected outside India, it cannot be considered in India because it is not an Indian income. It is foreign income. So this point is very important. So starting port is from India. Either you can receive the freight in India or outside India. Even though you are receiving the freight for the carriage of goods and passengers from India, it should be considered for tax calculation. But if originating port outside India and money is also received outside India, then it is not an Indian income. No question of tax liability. Even we cannot taken it for the gross receipts. Should not be considered. This is very important. So if a non-resident engaged in shipping business, but it is not a cruise ship, because for cruise ship they specifically created another provision 44 BBC. Not cruise, normal goods and passengers, mainly goods. Passengers also covered, or even livestock also covered, except cruise ships. So what is the total gross receipts received from India? While taking gross receipts, the point last we discussed is very important. Freight from India should be taken. Freight received outside India but originating port is from India should be taken. Freight received outside India, originating port also outside India, do not take. These two are the total freight. Sometimes a shipping company will give the breakup of the freight. Basic freight, handling charge, loading and unloading charge, demurrage charge. Remember, gross freight. Act clearly says any amount received should be considered. So it may be for handling charge, maybe loading, maybe unloading, maybe demurrage. All these amount should be considered along with the freight. So take the gross freight into 7.5% should be declared as income. And from that 7.5%, it will be accepted as the PGBP income. No other computation. No expense is allowed. Depreciation not allowed. Nothing is possible. Even though they are ready to maintain books and audit the books by chartered accountant, lower income declaration is not possible. They must comply with the presumptive taxation. So simply speaking, 44B and BBA presumptive is mandatory. So expense not allowed, lower income also not possible. So what is a specified sum? Here the specified sum means what we discussed, that is specified sum for the purpose of 44B and BBA, that is shipping and aircraft, means amount paid or payable in or outside India to assessee for carriage of goods and passengers shipped at any port or airport in India. Shipped at any port or airport in India. Origination port in India, then even though money is received from outside India, it should be taken. Originating port from India means export cargo. But regarding import cargo, remember the freight must be received in India. So amount received or deemed to be received in India by SSC for carriage of goods or passengers shipped at any port or airport outside India. So take the total and into 7.5% is the income. Similarly, when it is come to 44 BBA, we have to take only 5% of specified sum. Everything is, all other provisions are same, pakka same. So only difference is here 7.5, there is 5. Here ship, there is aircraft. And there is another difference regarding aircraft, they have only this provision 44 BBA. But for regarding shipping, there is another provision, section 172. During the previous year, a non-resident shipper, before leaving the Indian port, they have to compute the income. They have to pay the tax immediately before leaving the ship, and then only the ship can leave. Then only the customs authorities will give the clearance. That is known as accelerated assessment. In the previous year itself, their income will be assessed. And in the assessment year, they have an option. If they want to pay tax as per the normal provision, they want to claim Chapter 6A, they want to claim all, if they have any other losses in India, they want to set off with this presumptive income. If they want to do like that, then in the assessment year, they can come back to India and they can opt for regular provisions of the income tax law. That is known as a regular assessment. So these type of special or ad hoc assessment in the previous year and regular assessment, the assessment are applicable only for shipping business. For aircraft business, they have only presumptive income. In the previous year itself, pay the tax and go. It's over, right? They don't have any other regular assessment option. But for shipping companies, it is mandatory before leaving the ship. First, they have to pay the tax, and that tax rate will be applicable to a foreign company. Even though it is a foreign ship, which is a partnership firm or an individual, but still they have to pay tax as per the foreign company's rate of tax. And then they have to leave. And in the assessment year, if they want to, they can come back and opt for regular assessment like any other assessee. In that scenario also, income will be same, 7.5% of gross freight. But they can consider all other income in other heads, even loss, set off, Chapter 6A, normal income, normal tax that they can pay. At that time, whatever tax they paid in the previous year will be treated as advance tax. and can be reduced. Remaining, if there is a refund, they will get the refund. If they have to pay tax more, they have to pay more tax. So that is not a section 172, but 172 applicable only for ship, not for aircraft. So shipping assessee, nowadays there are two sections, 172 and 44B. But for aircraft, only 44BBA. So this is the basic provision, okay? And they have no option, even though they are ready to maintain the books and audit the books, no option, they have to pay tax as per section 44B and BBA. And now we can find out what are the gross receipts we have to consider. It's actually an MCQ, right? A incorporation, B incorporation, incorporated in country A and country B respectively, whose place of effective management is also in the said country, so non-resident, are engaged in the business of operation of ship and aircraft. Remember, A incorporation ship, A is 44B, and B incorporation 44BBA. The details of receipts, etc. during the previous year 24-25 are as follows. Okay, first one. Amount paid or payable in Mumbai on account of carriage of passengers. Okay, in Mumbai on account of carriage of passengers shipped from Mumbai port. Okay, then all other conditions are no need to worry about that, because originating port in India, it is Indian income. Okay, we have to consider that 20 for A and B 15 lakhs. Amount paid or payable in country A or B on account of carriage of passengers shipped from Mumbai port. Yeah, again that should also be considered, because originating is from India. Amount received or deemed to be received in India on account of carriage of passengers shipped from port in country A to Mumbai port, from airport in country B to Mumbai port. As it is received in India, should be taken. Amount received or deemed to be received in India in country A or B on account of carriage of, okay, amount received in country B, received outside India, and where is the originating port? Country A, country B. So this we cannot take. We cannot take into gross, right? Profit pertaining to Indian operations computed as per books of account, not relevant, not relevant, not permitted, not permitted. Even though ready to maintain books and audit, there is no provision under the tax law. For shipping and aircraft, presumptive is compulsory. So simply take the total, A incorporation 20 plus 5 plus 7 and apply 7.5%. So that is shipping. And B incorporation 15 plus 4 plus 8 and apply 5%. So which is answer? Correct answer? Option C. Okay, option C is the correct answer. Now we can go to the next question. Yeah. Which one? That is not, right? Not. Yeah. This one? Rates. 7.5 and 44 BB, that is for supplying plant and machinery for that is oil exploration related activity, that is covered in 44 BB, that is 10%, and there is another section 44 triple B that related to turnkey power project and civil construction. So in that case also 10%. Those two sections has a lot of similarity. Those two sections, even though they are saying gross freight into 10%, there is an option to declare lower income if they are ready to maintain books and audit the books by chartered accountant. 44 AA books, AB audit, they can declare lower income. But under B and BBA, that is not possible. Even new section, that is cruise ships, engaged in activity of cruise ships. There is a recent clarification related to that. Cruise ships also available in your RTP that you have to go through is the basic provision. This is the basic provision. BBC, any non-resident engaged in operation of cruise ship, that is luxury, tourism purpose, cruise ships carried out in India. What is the amount received from India? Total collection, apply 20%. No expense is possible. Even books and maintenance, they are ready to maintain books, but lower income not possible. 44 BBC is compulsory. Another thing is regarding cruise ship, activity must be performed within India. That cruise ship must be run within India. Government want to promote cruise tourism in India. For that, they opened that sector to non-residents. That is why they created 44 BBC. The provision, compliance provision will be easy. Simply find out the total ticket charge, total freight collected from India, total amount. Apply 20%, that's income, PGP income. So specifically regarding PGBP, we can say that for non-residents, specifically regarding PGBP, there are total 1, 2, 3, 4, 5, 6 sections under PGBP provision. 44B, 44BB, BBA, BBB and BBC, and then 44DA. But 44DA is very important. That's connected to 115A. Net basis taxation of royalty and FTS, provided non-resident should have a permanent establishment in India, book should be maintained there, and agreement should be approved after 31st March 2003. And all these conditions satisfied, net basis income from royalty and FTS taxable at a normal rate. Any one of these conditions not satisfied, 115A, gross basis taxation 20%, but that will be subject to DTAA. So these are the presumptive provision regarding non-resident taxation. Okay. Now we can go through the next question. Next question is related to non-resident taxation capital gain provision. Okay. First I will read the question. Okay. Before going to read the question, we can go through the provision, discuss the capital gain and come back to question. That will be more easy, right? To go to the capital gain provision of the non-resident. Section 48 is the basic provision. Section 48 clearly says that if the non-resident has a capital gain from sale of securities in India, especially shares and debentures. If the non-resident subscribed Indian shares and debentures, remember not listed, unlisted, right? Unlisted, because regarding listed shares, now the provision is governed by 112A. If it is listed and long term. So regarding all other shares and debentures of an Indian company subscribed by non-resident in foreign currency and transferred in India, and there a capital gain arises. So while computing capital gain, there is a special provision. As per rule 115A, the capital gain of non-resident from transfer of shares and debentures of Indian company must be computed in the original foreign currency in which he purchased the shares and debentures. So even though all the figures are given in INR, Indian rupee, we have to go back to foreign currency, compute the capital gain in foreign currency and reconvert it into INR. So that is a provision says. So how that will be done? And after 23rd July 2024, nobody will get indexation. And for non-resident, even prior to 23rd July 2024, no indexation. Indexation not at all available for non-residents. But there is an advantage. They can compute the capital gain in foreign currency. That foreign currency advantage is available for non-residents. Okay, that's not applicable for residents, only for non-residents. So indexation anyway not available. Okay. And now how the capital gain will be computed? So if the full value of consideration, that is selling price of shares and debentures, is given in Indian rupee, that should be converted into foreign currency, right? So how we will use the conversion rate, right? They are saying you have to take the date of transfer. On the date of transfer, what is the telegraphic transfer buying rate and selling rate of SBI? That will be given in the question. So take the telegraphic transfer buying rate and selling rate, take the average. That average rate must be used to convert Indian rupee into foreign currency. That means in Indian rupee divided by average rate, so that you will get into foreign currency. That is to convert full value of consideration of selling price in INR given, to convert it into foreign currency, maybe dollar or maybe pound, maybe euro. You have to use the average exchange rate of SBI. How we will take the average exchange rate? Telegraphic transfer buying rate plus selling rate divided by 2 on the date of transfer. So by using that rate, full value of consideration in INR divided by this average exchange rate, we will get foreign currency full value of consideration. Now, cost of acquisition. In between, expense for transfer, right? Commission brokerage paid for sale. That should also be converted by using average exchange rate on the date of transfer. And then cost of acquisition. On the date of acquisition, at what date they purchased, original date of acquisition. So on that date, what is the average rate of telegraphic transfer buying rate and selling rate of SBI? Use that average rate, divide, convert it into foreign currency. And then we will get the capital gain in foreign currency. So that capital gain in foreign currency should be reconverted into INR. For that, do not use average rate, use the buying rate on the date of transfer. So date of transfer, what is the buying rate? Applying that buying rate, we can convert that foreign currency capital gain into INR. So this provision should be applied for every non-resident who is purchasing Indian shares or debentures originally using foreign currency. First they are remitted their foreign currency into India. then convert it into INR, then they are subscribing shares and debentures, then they are selling it in India. In those cases, even though this share is sold and again purchase another share and again sold, in that situation also they are saying we should apply this method. For every purchase and repurchase also we should apply this provision. This is foreign currency calculation for non-resident. This is not mandatory, this is purely optional. They can do that because always it is better to take this because the capital gain will be less by applying this provision. This is not mandatory. So they can apply this rule and they can find out the capital gain. This capital gain in foreign currency should be converted to INR by applying the buying rate of the SBI on that particular rate. So to reconvert, don't take average rate, buying rate. But this calculation not applicable for 112A. What is 112A? Listed equity shares, equity oriented units, units of a business trusted, transferred on or after that is February 2018, and XTT is paid both at the time of acquisition and transfer. Then we have to compute the capital gain as per section 112A. That capital gain up to 1,25,000 rupees, the tax rate will be nil. And above 1,25,000 rupees, the rate of tax will be 10% or 12.5%, depends upon date of the transfer. If the date of the transfer is 23rd July, after 23rd July 2024, the rate of tax will be 12.5%. And if it is prior to 23rd July 2024, that is in our previous year, April, May, June, July 23, up to 23, the rate of tax will be in excess of 1,25,000, 10%. In excess of 1,25,000, 12.5% if the transfer date is after 23rd July 2024. So that is 112 rate of tax. And cost of acquisition of that capital gain should be computed in a special manner. If you acquired that listed equity shares, etc., prior to 1st February 2018, cost of acquisition should be computed in a special manner. That is, first we should take the original cost, and that should be compared with another two figures, lower figure. What is that another two figures? One, fair market value as on 31st January 2018, and then full value of consideration. What is the present selling price? Whichever is lower, that lower should be compared with the original cost. Whichever is higher should be taken as the cost of acquisition of listed shares. 112. No indexation benefit and no 87 on rebate also. From 112 long-term capital gain, you are calculating the tax in excess of 1,25,000 at the rate of 10% or 12.5%. From that tax, you won't get rebate. 87 rebate is not available. Even though you are resident, rebate is not available. Rebate, you are aware, right? Under default tax regime, what is the amount of rebate? Under default tax regime, what is the amount of rebate? 87 rebate. 25,000. What is the condition? Total income should not exceed 7 lakhs and you should be a resident individual. The rebate amount is 25,000. That rebate is not available from this capital gain tax. And what is the opt-out rebate? Total income should not exceed 5 lakhs and rebate will be up to rupees 12,500. And rebate is not available from sudden income. One is 112A, another one is digital taxation, virtual digital asset taxation, 115 BBH. That's Bitcoin, all those things, right? It will be taxable at a flat rate of 30%. Against that tax, you won't get the rebate under section 87A. But long-term capital gain, short-term capital gain, 111A, if you are resident, you can claim the rebate. But 112A, you won't get the rebate. Regarding 111A short-term capital gain, 112 long-term capital gain, rebate availability subject to dispute, right? For the current year, dispute is there. Department is not permitting that, but academically, for exam purpose, we can claim the rebate. Next year onwards, government eradicated all the confusions. They blocked it. From next year onwards, from flat rate income, you won't get rebate. Even long-term, short-term, no rebate. Next year onwards, for our assessment year 25-26, it is available. And now, this is the provisions for capital gain. And another provision regarding capital gain you have to keep in mind is, if there is a special provision prescribed for non-resident Indian, NRI. Non-resident Indian means an Indian citizen or person of Indian origin, but his residential status is non-resident. That is not non-resident Indian. For non-resident Indian, there is a special chapter, chapter 12A, section 115C, D, E, F, G, H, I. 115C to I. Special provision is there. As per that special provision, after computing the capital gain, they can claim some exemption as per section 115F. 115F. If they reinvest the capital, net sale proceeds from the transfer of the Indian company shares or debentures into another shares or debentures of Indian company, they can claim exemption under section 115F, proportionate exemption. So that is applicable for non-resident Indian. That is also an important area for non-resident taxation, but that is available only for non-resident Indian. And further, for non-resident Indian, they will have a concessional rate of tax compared to other non-residents. So that is capital gain with non-resident Indian, they can ask such a type of a question. Okay. Now, this is a general provision for capital gain computation. Now, there is another area regarding capital gain. We should go to the basics, section 9. As per section 9, what are the income deemed to accrue or arise in India? That is section 9. So 9 contains total 8 subsection 911, 912, 913, 914, 5, 6, 7, 8. So 914 is dividend, 5 is interest, 6 is royalty, 7 is fees for technical service. 911 says business connection, that is business income of non-resident through business connection. Business connection, again, there are two types of business connection. You may go through that. That is through dependent agent, and another one is SEPT', significant economic presence. Two types of business connection may be there. Now the problem is, in addition to that business income of non-resident, there is another important provision explained under section 911, which says that if a capital asset is situated in India, profit on sale of a capital asset situated in India is always deemed to accrue or arise in India and taxable in India. Profit on sale of an asset situated in India, if it is transferred outside India by a non-resident to another non-resident, but still it is taxable in India because asset is located in India. As part of that, they created another explanation because of that Vodafone case, famous Vodafone case. Shares of a foreign company. That foreign company shares is held by a non-resident, and that non-resident transferring that foreign company shares to another non-resident outside India. Then why India is concerned? It is a foreign company shares and transferor is non-resident and transferee is also non-resident. Then why India is worried? India is worried because that foreign company share derives its value substantially from assets located in India. So as per explanation 5, 6 and 7 of section 911, which says if the shares of a foreign company which derives its value substantially from assets located in India, then profit on sale of capital gain from transfer of that foreign company shares will be deemed to accrue or arise in India and accordingly taxable in India. So for example, a Mauritius company holding major shares of Indian company. So Indian company, 51% of Indian company is held by a foreign Mauritius company. That Mauritius company's shares are held by a German resident. Okay, German resident. So German resident is the shareholder of a Mauritius company, and that German resident transferring the shares of that Mauritius company to another German resident, and the transfer is happened in Germany or maybe in Mauritius. So here India says India will tax the capital gain from the transfer of that Mauritius shares by the German resident to another German resident outside India. How? Because India is saying, or section 911 explanation 567 says that Mauritius company share will have value because that Mauritius company have assets in India. Because of Indian assets, that foreign company's share have value. If that foreign company, Mauritius company, does not have assets in India, that shares will not have this much value. So why they are selling that shares to another non-resident with a high price? Because that foreign company derives its value from Indian assets. So how we will establish foreign company share derives its value substantially from Indian assets? So the criteria is that foreign company share held by the non-resident should be at least 50% voting right in the foreign company. That means that German resident should have at least more than 5% equity share right, equity shares having equity share. Such a type of voting right, equity shares should be held in the Mauritius company. So that foreign shareholders shareholding in the foreign company should be more than 5%. First condition. And second condition, how we can say that foreign companies share derive value from substantially from Indian assets? So first condition, the value of Indian assets held by the foreign company should be at least 50% of total value of assets of the foreign company. That Mauritius company, find out the balance sheet of that foreign Mauritius company, take the total fair market value of the foreign Mauritius company. Out of the total balance sheet assets, how much is the value of assets located in India? Take the percentage. If the Indian assets represents at least 50% of total assets of the Mauritius company, then we can say that first condition is satisfied. The substantially derives its value from India. Second condition, value of Indian asset should be more than rupees 10 crore. Value of Indian asset should be more than 10 crore. So the provision is very clear. Shares of a foreign company which derives its value substantially from assets located in India, the primary condition that foreign shareholder shall hold at least 5% of the voting shares of the foreign company. And number two, the value of Indian assets having fair market value more than 10 crore, which should be at least 50% or more of the total assets of the foreign company. If these two conditions satisfied, then we can say the shares of the foreign company derives its value substantially from Indian assets. In that situation, proportionate capital gain will be taxable in India. Proportionate capital gain means first to find out the capital gain arising from transfer of that Mauritius company shares by German resident to another transferor, another transferee, right? What is the capital gain? Find out the full capital gain. Then that full capital gain into apply the ratio. Numerator, value of Indian assets. Denominator, total value of assets of that foreign company. Here value means not the book value, it should be taken the fair market value. So that proportionate capital gain can be taxable in India. So practically it is a very complicated area because we should take the balance sheet of that foreign company and find out the fair market value. We have to do the valuation of all the foreign assets of that foreign company, right? By using the registered value or some other value certificate in that country, we have to find out the market value. Practically it is a very big issue, right? Academic purpose, for exam purpose, they may ask a question. They already asked a question. They may ask, but they won't get into details. Earlier there was a paper like international taxation elective paper, right? At that time they are asking deep questions, but for our normal exam purpose they won't go deep. But even though they are asking a deep question, you should be aware about these provisions. So this is the way capital gain is computed. First to find out the full capital gain, then apply the ratio B by C. B means fair market value of assets in India, because only that much portion can be taxed in India, because other value derived by the foreign company shares from foreign assets. So from Indian assets, how much value is derived, only to that extent it can be taxed in India. So that is why this ratio B by C. But remember, value of fair market value of Indian assets should be more than 10 crore. At least it should be more than rupees 10 crore. So if the value of Indian assets is less than rupees 10 crore, but it represents at least 50% of the total value of the foreign company, this provision not applicable. And another case, this provision is not applicable if the foreign shareholders shareholding in the foreign company is less than 5% of the shares, or that is not a equity share. In that case also, no voting right, no controlling right. That case also, this capital gain not applicable. So this is otherwise known as indirect transfer. So this provision is created because of the failure of the department in Vodafone case. They put this provision indirect transfer. This is explanation 5, 6 and 7 plus 911 of income tax law. So this provision is also important regarding capital gain provisions of non-resident. Usually all these valuations shall be done on the 31st March preceding the date of transfer. That is the date on which for non-resident shareholder transferred that foreign company shares. Prior to that date, what is the 31st March? Last accounting date ends. That date should be taken. And on that date, we should find out the valuation. But if there is a substantial increase in book value of assets of that the foreign company, that means on 31st March preceding the date of transfer, the book value of assets of that foreign company is assumed 100 crore. But on the date of transfer, the book value of assets of the foreign company is 120 crore. Then there is an increase of 20 crore. Increase of 20 crore means as a percentage of book value of assets as on the preceding accounting date end. So in that date, it is 100 crore. So 100 crore, 120 crore. 20 crore as a percentage of 100 crore means 20%. So if they are saying, if there is a substantial increase, more than 50% value of assets, book value of assets is increased on the date of transfer, then you should not take that balance sheet date. Then you must take the date of transfer. On the date of transfer, what is the total fair market value of assets of the foreign company? Out of that total fair market value, what is the fair market value of assets located in India? What is the percentage? Whether that is at least 50%. So whether the value of fair market value of those assets in India is more than 10 crore, proceed. So this is the provision. So this is also important. Sometimes they may ask. So now we can go to that question. And one more thing. In the present example, Mauritius company, suppose it derives more than 50% of its value from Indian assets. definitely that capital gain will be taxable in India. Provided one more condition, value of Indian asset should be more than 10 crore. Then proportionate capital gain can be taxable in India, even though transfer is German resident, even though transfer happened in Germany, even though the shares belongs to a Mauritius company, foreign company, but still it is taxable in India if all these conditions are satisfied. The point is, suppose that German resident not transferring that shares, he is still keeping that shares with the Mauritius company, and Mauritius company declared a dividend. So the question is whether that dividend can be taxable in India. That's a question. That is, dividend declared by a foreign company which derives its value substantially from assets located in India, and the dividend is declared outside India. Can that dividend be taxed in India? That's a question. So answer is clear, no. This provision typically applicable only for capital gain on transfer of shares of a foreign company. This is nothing to do with the dividend, because dividend is declared out of the operating profit. That operating profit they are earned in outside India. So nothing to do with India. So this is only for capital gain. So only capital gain is taxable in India. If dividend is declared from such a shares outside India, it is not taxable in India. But if the dividend from that shares or any foreign company shares dividend is paid in India, first receipt will be in India. For any income, if it is first received in India, it will be treated as Indian income and taxable in India. So it's a provision applicable only for capital gain, not for dividend. Now we can go to that question. Yeah. Mr. Roberts, a non-resident and a German citizen, is employed in a German company. The German company has a PE in India, and accordingly the income of the PE is chargeable to tax in India. So this non-resident company has a PE in India. Okay. Robert visited India during the financial year 24-25 on official work and stayed for 85 days. His salary for that period was rupees 28 lakhs, which is borne by the Indian PE, which is paid by Indian PE. Okay. This paragraph contains another confusion, another issue that I will explain. That provision we didn't discuss. If a non-resident individual working on behalf of a foreign company visited India, and regarding due to his work he stayed in India, and if his total number of stay in India does not exceed 90 days plus, the company which sent him to India should not be engaged in any business activities in India if these two conditions satisfied. For example, a German company has to provide some technical consultancy or technical advice to an Indian company. For that purpose, they are sending their technical expert to India. The technical expert came to India, stayed here for 2 months, and he completed the technical work and returned. His 2 months salary may be paid in India or may be paid outside India. But as per section 9, subsection 1, subclause 2, if service is rendered in India, salary deemed to accrue or arise in India, it is Indian income. But section 10, subsection 6 of the Income Tax Act says, 10(6) exemption says, non-resident individual does not stay in India, does not exceed 90 days, came to work in India on behalf of foreign enterprise, and that foreign enterprise should not have any other business activity in India, then such salary is exempted. At what amount it is exempted? But the main condition is that employee should be non-resident, his stay in India should not exceed 90 days. And third condition, that non-resident enterprise should not be engaged in active business in India. They can get royalty from India, they can get fees for technical service. They should not be engaged in business in India. First sentence, they have a PE in India. So that entity has an active business in India. So 10(6) exemption not available. So even though Robert is a non-resident, his stay does not exceed 90 days, it is taxable in India. Remember, this 28 lakhs is salary. We have to reduce standard deduction. If Mr. Robert is opting for default tax regime 115 BSE, we can claim 75,000 standard deduction. If you opt out of default tax regime, then we can claim opt out, then standard deduction is rupees 50,000. Okay. So first part income from salary, right? So out of this 28 lakhs, we have to reduce standard deduction 50 or 75. If the question says opt out, we can claim 50, otherwise 75. See, after solving this question, we will take a break. Okay. Now, If you didn't go through the exemptions under section 10.6, please go through that, because sometimes they will apply these type of small adjustments into the big problem. So because of that adjustment, if you don't know that adjustment, the entire problem final answer will be wrong. So this is an exemption, but here exemption not available, okay. All conditions are satisfied, only one condition is violated, that foreign enterprise sending that employee has active business in India. Second part, Robert held 1,200 shares of Nalapir Private Limited, an Indian company, since 28 November 2016, which he has acquired for rupees 15 per share. For acquiring the shares, he remitted $50,000 to India on 1st November 2016. He sold these shares on 23rd June 2024 for rupees 43 per share. Typical capital gain, subscribed in foreign currency. So capital gain must be computed in dollar and then reconverted into INR. Acquisition date is important, not the remittance date. Here acquisition of the shares is on 28th November. So we should take the average exchange rate on 28th November. Buying rate and selling rate average on 28th November. Do not consider the date of remittance, that is 1st November. Don't take that. 1st November is the date on which he remitted. We should consider the date of acquisition. 28th November. We have to use the average exchange rate to convert the cost of acquisition, and date of transfer 23rd 6 2024 43 per share. That should be converted by using buying rate and selling rate average on 23rd June. So we will get full value of consideration cost of acquisition, compute capital gain in dollar, reconvert in INR by using buying rate on 23rd June 2024. Remember, the transfer happened prior to the amendment date, 23 July. So the old rate will apply, old rate will be 10%, right? Old rate will be 10%. For non-residents, indexation not available. So the rate of tax is 10%. If they are taking the foreign exchange fluctuation, after 23rd July, anyway, the rate of tax will be long term 12.5%, a short term normal rate. And here, the next point, Robert also held 2,000 equity shares of Aribits GmbH AG. This is the indirect transfer provision, the second paragraph. First paragraph is Indian company share, second paragraph is foreign company shares. Robert also held 2,000 equity shares of Airbits GmbH AG, a German company which he had acquired for 145 per share in 2019. AG follows April to March as its financial year. He sold all these shares for rupees 615 per share to David, another non-resident, on 26th August 2024. The relevant information of AG as on 31st March 2024 is given below. Remember, it is a foreign company share. Transferor is non-resident. Transferee is also non-resident. Generally, this is not an Indian income. The only possibility is explanation 5, 6, 7 of section 911, indirect transfer. Shares of a foreign company which derives its value substantially from assets located in India. Then the capital gain from proportionate capital gain from shares of that foreign company would be taxable in India. So we have to check whether indirect transfer provisions are applicable. Total value of assets of the foreign company 15 crore included into above rupees 8 crore. So total value of assets 15 crore. Total value of immobile properties worldwide 12 crore. Immobile property held in India in a second above rupees 8 crore. So we have to apply the percentage. Assume it is a fair market value. The value given is fair market value. So value of assets held in India is rupees 8 crore. Rupees 8 crore. What is the total value of assets of the foreign company? The total value of assets of the foreign company is rupees 15 crore. So 15 crore, 8 crore by 15 crore into 100. What's the percentage? 50? 53.33%. Primary condition satisfied. And second condition, value of Indian assets should be more than rupees 10 crore. So what is the value of Indian assets? Only 8 crore, which is 8 crore is less than 10 crore. Second condition is not satisfied. So indirect transfer provision not applicable. So no need to compute any capital gain. So if this, instead of 8 crore, if it was 11 crore or 12 crore, something like that, then we have to compute the capital gain for this particular transaction and then apply the ratio. Find out the capital gain, then capital gain into Indian assets divided by total assets. Proportionate will be taxable. Okay. You are required to compute the total income, ignoring the provisions of double taxation avoidance agreement. So assume there is no DTA agreement. So then they are given the details regarding the foreign currency fluctuation. That is only for the purpose of the first part calculation, Indian shares calculation. So this is actually a previous year exam question. So from this area, we cannot avoid that. Sometimes they if they want to ask a question, simply they can do that, right? And for the first time, they asked the indirect tax provision in this question. But there was no calculation for that because value of Indian assets does not exceed 10 crore. Yeah, this is a solution. Salary 28 lakhs. So we are taking it as opt out of default tax regime. Question doesn't ask about tax liability. Question not asking tax liability, right? If the question is asking tax liability, then it will be different because you are computed total income taxable in India. Okay, not asking for tax. If they're asking tax liability, default tax regime and opt out is available for whether resident or non-resident. Then we have to take the better provision. In which provision tax will be lower, that we should select. So here we are claiming standard deduction 50,000. So we have to put a note on section 10(6). That is, it would not be available to him, even though his period of stay does not exceed 90 days. He is receiving salary from a German company which is also engaged in business in India. That is the reason why this exemption is not available. Answer very late. So we have to put a note on section 10(6) and then standard deduction 50,000, balance 27,50,000. So regarding capital gain, salary is simple, right? Now capital gain. Transfer of 1,200 shares of Indian company. Actual transfer is in INR 1,200 rupees 43 per share. To convert it into dollar, we have to divide it by average rate on the date of transfer. So average is 74 and 76 is the buying rate and selling rate. Average 75. So 1,200 shares into rupees 43 divided by rupees 75 per dollar. So $688 is the full value of consideration. Cost of acquisition, that is 1,200 into purchase price 15. On the date of acquisition, what is the buying rate and selling rate? Here the date of acquisition is that is 28th November 2016, 59 and 61. So take the average of 59 and 61, that is rupees 60. So in $300, reduce that, we will get the capital gain in foreign currency $388. This should be reconverted into INR by using the buying rate on the date of transfer. That is, buying rate on the date of transfer is 74, 23/6/2024, 74. So by applying 74, we will get the capital gain in INR. That is 28,712. This is a capital gain taxable in India from transfer of shares of Indian company. Then regarding transfer of 2,000 equity shares of Arbit's GmbH AG, you have to write the reason not taxable in India since the shares of foreign company do not derive its value substantially from assets located in India, as value of Indian assets do not exceed rupees 10 crore. So detailed provision is not required. In the suggested answer also they are just putting like this. They are not explaining detailed provision of 5, 6, 7 explanation. Income from other source, that is foreign company's dividend. It is taxable only because of the reason that it is received in India. It is received in India. First receipt is in India. For any income, if it is first received in India, it is Indian income. That is why it is taxable in India. 1,11,000. So the gross total income is 28,89,712. Round off after rounding off 89,710. So this is an important area. This is an important area means the second part, that is computation of capital gain. Because for every non-resident, if they are asking capital gain on shares, this provision will be there. So this is important. Capital gain should be computed in this way. And a lot of other provisions are incorporated in this question. Indirect transfer is there, and salary exemption 10(6) provision is there, but now they cannot claim exemption because condition is not satisfied. So these are the major questions we are covered from NR taxation, non-resident taxation, and other areas I discussed. You have to go through that, all those questions. Okay. Now we will take a break. After the break, we will go to the another major chapter, transfer pricing. Okay, especially transfer pricing, computation of arm's length price, secondary adjustment, 94A provision, all those areas. Okay, that's main core problem area we will discuss for transfer pricing. After transfer pricing, we will go to double taxation relief. Okay, so that this international taxation part revision we can finish. Okay, the next chapter we're going to discuss is transfer pricing. So transfer pricing basic idea, in every country the rate of tax is not the same. Some countries have a high tax rate and some countries have a low rate of tax. So a multinational company having operations with the different countries have a tax advantage. They may try to show more income at less tax countries and to show less income in high tax countries. So by using this, they can divert the profit and they can report the profit in low tax country, thereby evade the tax of the country in which they are actually earning the income. So to prevent this, Income Tax Act created transfer pricing provisions. That's the idea. So if there is a multinational company having operations with the different countries, so for that purpose, tax recognizes the concept of associated enterprise or group entity, holding subsidiary. So a lot of relationship is mentioned there to treat two enterprise as an associate enterprise. So if there is an international transaction, that is a transaction which has a bearing on profit carried on between these two associated enterprise or related party, income should be computed as per the arm's length principle. So if while applying the arm's length principle, if the department show that or the department feels that the income reported in India is lower than the real income they have to report based on the arm's length principle, then that difference income will be added to their net profit and income will be increased and they will be taxed. In addition to that, by determining the arm's length price by the income tax department, if there is the net profit of the assessee is increased, to the extent of that increase in income, they won't get any chapter 6A reduction. To the extent of that increased income, they won't get the section 10AA SEZ exemption. And further, it will be treated as an under reporting of income. There is a possibility of penalty also. If arm's length price is determined by the assessing officer or the transfer pricing officer, and based on the arm's length price, if the income declared in the income tax purpose in India is lower than the real income that they have to declare, then that for the difference department will increase the income. So to the extent of that increase in income, if it is made by department or assessing officer or transfer pricing officer or made by AO based on the report of the transfer pricing officer, then to the extent of that increase in income, assessee will not get chapter 6A reduction. Against that income, if it is located in a special economic zone, they can't claim section 10AA SEZ deduction. Further, there is a possibility of penalty also. So these are the consequence, ultimate consequence. And there is another area, a lot of compliance burden. They have to report every international transaction in form number 3ZEB, and chartered account should be certified, and every international transaction which is carried out with the AE should be reported. So if the international transaction is not reported in that form number 3ZEB report, for that separate penalty is there. And their due date for filing ITR will be 30th November of the assessment year. And separate documentations is required for the international transactions, that is mandatory documentation, and specific mandatory reporting is also there, country by country reporting, master file, local file. So those type of reporting is also prescribed. If the reporting is not violated, there will be definitely heavy penalties also mentioned there. That is, all those are theory area, and penalty for various non-compliance also is theory area. When it is computation part, the main area is determination of arm's length price. So basics level, first of all, when two enterprise will be treated as associate enterprise, and then if there is an international transaction between associate enterprise, how the transfer pricing will be find out. In addition to that, domestic transactions sometimes can be treated as international transaction. In that situation, international transaction transfer pricing provisions will be equally applicable for that domestic transaction. That is known as domestic transfer pricing, DTP. So international transaction transfer pricing. So TP as well as DTP, in both cases, compliance provisions are same. Penalty also prescribed. In both cases, they have to find out the arm's length price, and income must be computed having regard to the arm's length price. And another very important principle, the ultimate objective of transfer pricing provisions is, if income from India diverted to a high tax country, low tax country, because India is a high tax country, regarded as a high tax country. So if the income diverted from here and reported in Singapore or Mauritius or similar type of country where there is low tax or no tax at all,
to prevent that practice and convert or brought back that profit to India and paid more tax in India. This is a primary objective. Sometimes there will be a reverse scenario. That is, some other country's income will be diverted back to India. Say, for example, some other country has tax rate more than the rate of tax prevalent in India. So, multinational company having operation in that country, also in India. That situation, they may try to divert the profit from that high tax country and they may put that income in India. In that situation, transfer pricing provision should not be applied. Because if we apply transfer pricing provision in that scenario, Indian income should be reduced. The purpose of transfer pricing is to increase the income shown in India. So, by application of arm's length principle, if the ultimate result is reduce of profit in India or increase in loss in India, as per section 92 subsection 2, transfer pricing provisions are not applicable, do not proceed. If there is already more income declared in India, they will tax it, they will accept it easily, right? There will be no complaints and there is no any other prudent principle to give the profit to that country. No. If some other country's income reported here, we will tax it. But Indian income diverted to some other country, TP provisions will apply. That should be added. So this is another idea we have to remember. And now, computation of arm's length price and related compliance and proving that is all those are very complicated provisions and very tough scenario. So to ease of doing business and to reduce the compliance burden, they put another provision regarding transfer pricing. Not for all assessees, so for some eligible assessee, they can opt for safe harbor. If the safe harbor rule is followed, as we discussed earlier, government will say this type of industry. So, okay, you are software development and exporting. So, if your annual turnover does not exceed this much limit, if you show this much profit, say cost incurred into 20%, if for example, if you show the profit, your pricing will be accepted and we will not disturb you, your profit will be accepted. So, that is known as safe harbor rules. That is circumstances under which department will accept the transfer price declared by assessee. That is known as safe harbor. So if safe harbor rules is applicable to an assessee and the assessee opted for that, then no need to find out the arm's length price and the related complaints not required. But in that case also he should declare international taxation and he should give the form number 3C report. Everything should be made and separate form for safe harbor also. But complicated provisions of determination of arm's length price and related variance in total income not applicable. And another interesting situation is similar to safe harbor rule, to reduce the litigation, they put a provision, advance pricing agreement. That is before going into transactions with associate enterprise, in advance go to the department and ask them, this is our mode of business. We are going to provide these type of services or sending these type of goods to our associate enterprise. These are the purchase or sales. So we want to do an advance pricing agreement. So if department is satisfied and it is suitable for advance pricing agreement, department agrees, then both will sit and they will discuss the terms, how they will price, and department will say these are our suggestions, you should show this much profit or you should make the pricing like this. So both of them will negotiate and they will discuss and finally they will come out with an agreement. That agreement is known as advance pricing agreement. The idea is no need to find out arm's length price again and again for each and every year when that international transaction is carried out. No need for that. If you make the pricing as per the advance pricing agreement entered into between department and assessee, and this is purely assessee wise, other person's advance pricing agreement cannot be used by another type of similar business, but another assessee they can't take. It's purely assessee specific. And every person cannot make advance pricing agreement because there is a pre-filing consultation. In that pre-filing consultation, if the department feels that no, your type of business is not suitable for advance pricing agreement or we are not interested, that is not possible, then they can drop that. In that case, advance pricing agreement not possible because it's purely negotiating and finally both are agreed and came to it with your conclusion, they can make the advance pricing agreement. Once advance pricing agreement is made, then your future transaction should be billed as per the pricing methodology prescribed as per the advance pricing agreement. If you are not deviate from advance pricing agreement, it's fine, it's good. No need to find out any arm's length price. Your every transactions with the AE should be as per the APA. The department will not disturb you. There is no audit, no case, no litigation, peace of mind. So this advance pricing agreement is so popular. But there are certain disadvantages. The disadvantage is Once you enter into advance pricing agreement for a maximum 3 year or 5 years, see beyond that period, again you have to enter into advance pricing agreement. In between this period, you cannot change it. So if you change and you violate the advance pricing agreement provision, then it will be withdrawn and all your transaction will be valued as per the normal ALP principle and income will be recalculated and all other consequences will follow. Once future transactions advance pricing agreement is entered and your past transactions already entered into with AE is similar to that of these transactions for which you already concluded with an advance pricing agreement, then you can apply this APA agreement for back period. So why we are applying for back period? See, back period transaction is already concluded and you followed the normal and transfer pricing principles. Assessment not been completed. If that is taken for assessment, definitely there is a possibility of high demand. So to avoid that, you can apply the advance pricing agreement for future can also be applied for back years. That is known as a rollback provisions. So if you apply this advance pricing agreement portion for the past year, then for the past years already you declared the income and filed the return as per the normal arm's length method, right? But once AP applied for rollback provisions, then all those returns must be taken. Income should be recalculated as per the APA advance pricing agreement pricing methodology and revised return should be filed. So this is also possible. That is known as rollback provision. For all these, there is a detailed procedure and circular is there. Guidelines is prescribed. Study materials is more than enough. You must go through that. So there are certain conditions for rollback provisions. Advance pricing agreement future, it is easy, but for rollback provision, there is some specific conditions. The transactions should be the similar transactions and he must file the revised return and income cannot be reduced. By showing the advance pricing agreement, past income cannot be reduced. So a lot of conditions are there. That is known as advance pricing agreement area. So this advance pricing agreement, usually they will ask some theory type of questions. Problems, copies, not that much. Theory they can ask advance pricing agreement. That is a major area. And another thing is sometimes the arm's length price, normally the primary responsibility to find out the arm's length price is vested with the assessee. Department will not find out ALP. It is your responsibility if you are an assessee carrying on international transaction with the associated enterprise. Then it is your responsibility to find out the arm's length price and find out the income as per the ALP principle. And as per the methods prescribed under the income tax law. That is comparable uncontrolled price method, resale price method, cost plus profit method, profit split method, transactional net margin method. So as per any one of these methods, you must find out the arm's length price, declare the income and file your return. But the arm's length price determined by the assessee is not correct, or data used for finding arm's length price is not reliable. Adequate documentation has not been maintained, or the method used is correct but the computation is wrong. In those cases, only assessing officer can intervene into that matter. He can reject the arm's length price declared by assessee and he can find out the arm's length price. But when assessing officer tried to find out the arm's length price, sometimes he couldn't do that because it may be a complicated situation or a complicated industry. Assessing officer is not familiar with the terms used in that pricing methodology. So in that situation, he may refer the case to transfer pricing officer. But the issue is, assessee carried out 5 international transactions with the AE. These 5 arm's length price computation is wrong. Assessing officer selected these 5. According to AO, 3 international transactions determination of arm's length price is wrong. 2 is okay. So he didn't consider that 2 international transactions, he accepted the arm's length price. For other 3 transactions, he find out the arm's length price. In that 3 transactions, 2 transactions he got confusion. He referred to transfer pricing officer. Transfer pricing officer got request from the AO only to find out the arm's length price of these 2 transactions only. The other one AO has no confusion. The other 2 according to AO is correct. But transfer pricing officer has the wide powers. If TPO is of the opinion that other international transaction, whether referred to the TPO or not, even though it is accepted by other 2, accepted by AO, if TPO feels that the arm's length price determination in other transaction is also not correct, then TPO can find out the arm's length price of other international transaction carried out by the assessee, even though which is not referred by the AO to the TPO. He can find out, he can prepare the report, find out the ALP and refer the or give the report to the AO. So once transfer pricing officer find out the arm's length price and give the report to the AO, that report is binding on the assessing officer. There is no choice. There is no discretion. Report of the TPO is binding on the AO. Then AO must apply that transfer pricing officer's report. He must find out the arm's length price. He must take the arm's length price determined by the TPO. By giving effect to that, he should find out the new income of the assessee and to pass the new assessment order. And in this case, that is, if the arm's length price is determined by AO or TPO, based on which income is varied to the assessee, in that case, the other three consequences will follow. To the extent of income increased by AO or TPO, assessee cannot claim Chapter 6A deductions or 10AA SEZ deduction, and there will be under-reporting of income. Regarding that increase in income for that transactions, for that international transaction, if assessee did not maintain the books of accounts and did no proper documentation, definitely it will be treated as a case of misreporting of income, and as per section 270A, there will be penalty. These are the three consequences. But even though income increased by assessing officer or TPO based on the ALP determined by the assessing officer or TPO, but assessee maintained proper books and documents, because of the computation difference, income arises, increase in income arises. But assessee maintained proper books and documents, no penalty, because there is a specific exclusion for that. But at that case also, you won't get Chapter 6 and won't get a 10AA SEZ deduction. And now, these are the major area regarding powers of transfer pricing officer and assessing officer. Remember, powers of TPO is very wide. Even though a particular transaction is not referred to TPO, he can find out the ALP for that transaction. So first point, section 92, for every assessee having international transaction with the associate enterprise, they must compute income having regard to ALP. And 92A, meaning of associate enterprise. 92B, meaning of international transaction. So international transaction, in short way, we can say that any transaction may be purchase of goods or sale of goods, or payment of royalty or acceptance of royalty, or a payment for purchase of asset and claiming depreciation, or lending of money and obtaining interest income, or accepting loan and paying interest income. So any type of transaction, either debit side or credit side of the P&L, which have a bearing on the profit, we can say that is an international transaction. But the other side of the transaction should be an associated enterprise. And in a transaction, there are two persons. Any one of that person should be a non-resident. Both can be non-resident, or any one person can become non-resident, and the other party should be an associated enterprise. Associated enterprise, simple meaning one person participates in the control or capital or management of another enterprise, either directly or indirectly. That is known as associated enterprise. In detail provision says there are total 11 transactions. Any one of these transactions carried out during the previous year, they will be treated as associated enterprise. And if they are carrying out any transaction having a bearing on profit, it will be treated as an international transaction. In very rare cases, even though there is no bearing on profit, directly no impact in P&L, but impact in balance sheet, restructuring transaction, that will also be treated as international transaction with AE. There is only one exception, but generally international transaction means a transaction with the AE having a bearing on profit, either debit side or credit side. And that is all those provisions are saying in 92B. And 92BA, specified a domestic transaction, that is, you have a 10AA unit and your related party has another business, not a 10AA. So in 10AA, you will get a deduction, other business no deduction, other person no deduction. So you will try to divert the profit from other business into the 10AA, so that here you can claim 10AA deduction. Or same assessee have 10AA unit and other unit. In between these two units, inter-unit transfer of goods and services transaction will be carried out, and that price will be manipulated, and more profit will be declared in 10AA unit and less profit will be declared in other business. Or in other words, normal business profit will be diverted back into 10AA unit by manipulating the transaction entered into between these two units. Thereby, you will claim more deduction here, and ultimately the tax payment in the other business can be reduced. This is a fraud. So in that cases, if that transaction value exceeds a particular limit, that domestic transfer pricing can be applied. So that is a domestic transfer pricing provision. And similarly, section 80 IAB, 80 IAC, section 80 IA, IAB, IAD, IE. So those type of sections under chapter 6A heading C. Chapter 6A heading C provisions popularly known as profit linked tax incentive. So in those area also this similar type of fraud can be carried out. That is, if a person has 80 IAB business and another business, normal business no tax deduction, here he will get the tax deduction. He will try to enter into a transaction between normal business and IAB or chapter 6 heading C business, and price will be manipulated. Profit from normal business will be diverted back to this 80 IAB. In that case also domestic transfer pricing provisions will be applicable. So that is specific domestic transaction. And either international transaction or specific domestic transaction, the profit from that transaction should be computed based on arm's length price. And how arm's length price will be determined, that is 92C. So 92C says arm's length price can be computed by using total 6 methods. One is comparable uncontrolled price method, and second resale price method, and third one is cost plus profit method, then profit split method, transactional net margin method. Out of these 5 methods, 2 methods never asked for exam. Resale price method, they never asked. Profit split method, they never asked. All other 3 methods, frequently they are asking one method or another method, alternative attempts they are asking. 2 methods never asked, that is profit split method and resale price method not asked. So these are the 5 methods, and any other method, that is sometimes these methods won't be working, or it is very difficult to apply this method. In that situation, any other method prescribed by CBDT, that is a best judgment method, 6th method. So 5 methods are important. They can ask a problem from computation of ALP from that methods that we will go through. We will solve the questions on methods. And then safe harbor rule, only the safe harbor rule applicable for that non-resident foreign diamond mining company sale of diamonds. That recent amendment only you have to go through that safe harbor rule. For transfer pricing safe harbor rule, not detailed discussion in our study material. So that is not required. So what is the meaning of safe harbor rule? That's enough. Advance pricing agreement in detail you have to go through it. That's very important. And then secondary adjustment, another important area. See, after the problem, they can ask a problem in 3 areas. One is computation of arm's length price and related computation of total income. Second one is secondary adjustment. And the third one they can ask is that is limitation of interest in certain cases, that is section 94B. These are the 3 problem areas from transfer pricing. From any one of these areas, definitely they will ask a problem, 6 to 8 marks. In addition to that, they can ask multiple choice questions also. Then 92C, secondary adjustment. That is, what is the idea of secondary adjustment? The primary purpose of introducing transfer pricing is to prevent the practice of diverting Indian income into low tax country. To prevent that, they create a transfer pricing provision, right? Okay, you diverted the profit from here to that low tax country by application of arm's length price. Your net profit is increased. That income is taken into here, at least in books, and your income is increased, and you have to pay tax. So more tax is received by government. But now the government is saying, see, not only for tax, you see, if that much money, instead of diverting from here to that country, if that money has been invested in India, how much India will be developed? So there is an economic impact also. So the problem is, whatever profit you have been diverted from India to that foreign country, that income should be brought back to India within the time prescribed under the income tax law. It's a very dangerous provision. In addition to transfer pricing adjustment, whatever profit has been diverted from India to that low tax country, that should be brought back to India in real money within the time prescribed under the income tax provision. If you did not brought back that money into India, then secondary adjustment will be applicable. That secondary adjustment says that much amount will be deemed to be a loan granted by Indian entity to the AE, and deemed interest will be calculated, and that deemed interest income will be taxable in India again. First of all, you diverted the profit, that add back, you are paying tax. And again, that money, if it actually did not brought back to India, that will be treated as a deemed loan. And on that deemed loan, it's not a real loan, deemed loan, and deemed interest will be applicable on that amount, and deemed interest income will be calculated, and that will be taxed in India. Up to what period? Up to the date when you repatriate that money into India. Okay, then what's the end solution? If I did not want to repatriate that money, but I doesn't want to make this interest calculation, I want to stop this, then what is the solution? But I am not ready to brought back that money into India. It's practically not possible, right? Every multinational companies, in each year there will be 500 crore or 600 crore, thousands of crores of transaction, right? So all those money they cannot brought back to India. That is not possible. Theory it is possible, practically very difficult. So government put another provision. Okay, you do one thing. If you does not want to repatriate that money into India, do one thing. Take that total amount. On that, pay 18% income tax, 12% surcharge, and 4% cess. That tax, additional tax. If you pay that tax, that case will be closed. So that is secondary adjustment climax. So secondary adjustment is very important. So that they can ask problem on this interest calculation or secondary adjustment calculation or even this additional payment of tax. That area in transfer pricing is very important. 92, obviously theory. Just some dry theory. You have to go through that. Maintenance and keeping of information and documents. 92, you report from chartered accountant, and 92 you have some definitions. Okay. So these are the major areas. So in my opinion, the core area from transfer pricing out of the past trends is from theory area, the more important area is advanced pricing agreement and various penalties under transfer pricing. That is the theory area more important. And the problem area, computation of ALP and this secondary adjustment. And one more thing that is not in between 92, that is in 94B, that is limitation of interest. That is thin capitalization, we can say like that, thin capitalization or limitation of interest. So in order to escape from the transfer pricing provision, they will develop, or they already developed another type of fraud. That is, even though there is no requirement, the associate enterprise will give a lot of loan amount to the Indian entity, and for that loan amount, this Indian entity will give interest. Sometimes that interest rate will be at arm's length the price, so there will be no transfer pricing disallowance. But lot of interest they are paying and debited to P&L. Interest expense is allowable under section 36 of the income tax law while computing PGBP. Only thing is you have to deduct the TDS, and the loan amount must be used for the business purpose. That condition they will satisfy. A lot of interest will be debited to P&L. Ultimately, interest expense will boost and profit will reduce. And this interest is paid to AE, and Indian profit simply diverted to foreign country. Arm's length price, yeah, it is at arm's length rate. Bank rate, or this is the bank rate, so we are paying at bank rate. Okay, it is at arm's length rate. So no violation of transfer pricing provision. So TP adjustment cannot be made. But even though there is no requirement, this Indian entity is taking lot of loan from AE and paying interest at the market rate. So ultimately interest expense will be more. So interest expense is debited to P&L, profit is reduced. So this reduced profit reached in the hands of the associate enterprise located in low tax country. Again, it's a brilliant idea. So government put the provision 94B. Okay, you can do that, but there is a condition. Total interest paid to associate enterprise should not exceed a particular limit. If you exceed the interest paid to AE exceeds this particular limit, that excess will be disallowed. And that disallowed interest you can carry forward just like loss to next year. And next year, if your total interest does not exceed the limit, if there is a deficiency, to the extent of that deficiency, this carryover amount can be adjusted. We will do a problem. So likewise, they created a provision. That is 94B. That is also important. Before 94B, there is a small section 94A, notified jurisdictional area. There are certain countries with which India has no proper information exchange mechanism, or there is no double taxation avoidance agreement at all. So those we can say that blacklisted countries. So some of the people in India, they will dump their black money into that blacklisted countries. Example, Cyprus. But now Cyprus is no more a blacklisted country. They removed Cyprus from blacklist. But initially, Cyprus was one of that country. So they created a provision 94A. Don't do any dealings with countries notified under notified jurisdictional area 94A. If you do any transaction with a country or a resident located in NJA, whatever transaction you carry out, it will be deemed as international transaction, and every provisions of transfer pricing will be applicable. So likewise, they put some restrictions. And for claiming expenses for payment made to a resident of NJA is also limited. A lot of further conditions has been put on, and additional documentation condition is also created. Otherwise, those expenses will not be allowed. So that is 94A is also another important area related to this transfer pricing area. So these are the major area. And now to apply transfer pricing, two basic conditions. There must be an international transaction and must be carried out between AE. General definition actually does not help what is an international transaction, right? And what is an AE. So we have to go through specific definition of associated enterprise. So basic condition, one entity holding at least 26% shares of the another enterprise, both of them are AE. Cross holding is not required, just one side. Indian company holding 26% of a foreign company, enough. They are AE. And it should be equity shares, right? It should have voting right also. And second case is triangular case. Two company and there is a third company. That third company holding 26% shares in commonly in the other two companies. Then the other two companies will be deemed to be AE. So at least 26% voting power of two enterprise held by same person. Then the other two enterprise will be deemed to be AE. And third one is one enterprise appoints more than half of the board of directors of the another enterprise. Then the person who have the power to appoint that more than half of the board of directors and the other company is also deemed to be AE. See, instead of appointing more than half, sometimes they have the power to appoint only one director, but that director is managing director or executive director. That's also enough. That will constitute an AE. And next one is one enterprise similar to that 26% voting share triangular case. Here also triangular case is there. One company appoints more than half of board of directors or executive directors of more than two companies. Then other two companies also will be treated as deemed to be associated enterprise. And then says one enterprise one enterprise giving loan to the another enterprise. And for the borrower enterprise, the loan taken from the another enterprise constitutes at least 51% of the total assets of the lending enterprise, borrower enterprise. So if the loan amount represents at least 51% of the total assets of the borrower enterprise, then we can say that lender and this borrower is deemed to be AE. Actually, first one, 26% participation in capital. Second also participation capital. Third is participation management. Fourth is participation management. All other cases, participation in control. So one enterprise giving loan 51% of the book value of the other enterprise. And next one, giving guarantee, not directly giving loan. For obtaining loan, one entity is giving guarantee, and with that guarantee is at least 10% of the total borrowings of the other enterprise. So Indian company have total borrowings of 100 crore. Out of 100 crore, at least for 10 crore rupees loan, if another foreign company gives the guarantee to the bank, then that foreign company and this Indian company will be treated as AE. And next one, they are saying manufacturing industry. So one entity manufacturing the goods and the entire goods has been sold to another enterprise. There is a sole buyer. Plus that buyer company decides the price, credit period and all other related conditions are influenced by the buyer enterprise. Both conditions should be satisfied. One entity manufacturing goods and selling to another enterprise. So the buyer enterprise decides the price and other related conditions. So it's a sole buyer, right? If that sole buyer says that this should be the condition, the seller enterprise is bound to follow that. So it is some sort of influence, control is there. So that is manufacturing goods and selling to another enterprise. And next one entity is manufacturing out of their total raw material requirement, at least 90% of the total raw material requirement is purchased from another one entity or a person directed by the another enterprise. Plus the price and other related conditions is also influenced by other enterprise. Then we can say they are associated enterprise. So at least 90% of the total raw material requirement should be acquired from another enterprise. And next they are saying one entity engaged in manufacturing or producing or processing any goods, but they are using on an intangible asset, maybe a trademark or patent or copyright or franchise, license, technology, something like that, intangible asset. But they are wholly or mainly depend on that intangible asset. And this intangible asset belongs to another enterprise. So if another enterprise one fine morning say that we are no longer giving you that intangible asset, then definitely this entity will be in trouble. So it is also a control. So engaged in manufacturing by one enterprise, wholly dependent on the patent or copyright or know-how, etc., owned by other enterprise. So we can say that both of them are associated enterprise. And next one is if it is a firm or AOP or BOI, not a company, we cannot say 26% criteria. 26% criteria only for shares. It's not company. It's not a company, firm, AOP, BOI, then at least 10% interest is held by another person. A third party has at least 10% interest. That may be any type of interest, maybe controlling interest or maybe profit sharing ratio, whatever it may be. At least 10% interest in another enterprise, they will be treated as AE. And next one is an individual also having control in another enterprise. If it is a sole proprietorship, he got control in another company or another enterprise, then both of them can be said to be associate enterprise. Similarly, an enterprise is controlled by members of HEF together. So, as per general meaning, as per Companies Act, control means at least 51% control should be in another person. Then only we can say it's a control. It's not defined in the law. So, first 10 cases are very important for your exam point of view to decide whether two enterprises are AE. First 9 is very important. Other ones are not that much important for an exam purpose. Okay. And last one is any other mutual interest as may be prescribed, but nothing has been prescribed. So effectively 12 relationships are there, out of which first 9 or 10, that is very important for your exam point of view. This is AE. Normally to said to be AE, any one of these transactions should be carried out during the previous year. Then we can say both of them are AE. In some questions directly they will say associates are holding subsidiary. Then we can straight away say AE. Some questions they won't say like that. They will put any one of these conditions. So we should check whether any one of these transactions satisfied. Yes. So conclude they are AE. Then go to the transfer pricing provision. And now the next provision is international transaction and specified domestic transaction. Regarding specified domestic transaction, there is a limit. Specified domestic transaction, as earlier we discussed, that is between 10AA unit and another unit of the same associate, inter-unit transaction is carried out. 80 IA, IB, IC, ID, etc. Chapter 6A heading C business and associate, same associate have another normal business not under chapter 6A heading C, that is a normal taxable unit. In between these two unit transaction is carried out and income is diverted. And third one, associate and a third party, another person, another associate. But these two are carrying out some transaction, but associate have 10AA unit or 80 IA IB unit and other associate have a normal business. In between them, their transactions price is manipulated and other person's profit is diverted back to associate's profit or associate's books, which is a 10AA unit or IA IB unit, and thereby evading the tax. In that case also, domestic transfer pricing can be applied, provided all these transactions together exceeds rupees 20 crore. So that is a limit. So to attract a specified domestic transaction, the total of all these transactions carried out during the previous year should exceed rupees 20 crore. And reason there is an amendment, section 115 BAB. What is section 115 BAB? That is for new manufacturing companies in India. They are starting manufacturing on a particular date in 2019, before a particular date in 2024. In that cases, that companies, they have an option to pay the tax at concessional rate. That is 15% tax rate and 10% surcharge and exemption from minimum alternate tax. So that 115 BAB concessional rate of tax for new manufacturing company. It's a very attractive provision, 115 BAB. So sometimes these 115 BAB companies, they will be entered into transaction with the other persons and their profit will be diverted and manipulating and claiming concessional rate of taxation for ineligible profit. That ineligible profit will also be, that transaction will also be computed as per the transfer pricing provision. But in all these cases, the amount should exceed rupees 20 crore. But there is no such a similar provision for transfer pricing in case of international transaction. If you carried out a single rupee international transaction with the AE, TP applicable. But to attract domestic transfer pricing, this listed transaction should exceed rupees 20 crore value in a previous year. Then only specified domestic transactions, transfer pricing will be applicable. So this is the applicability of transfer pricing provision. And now we are moving to the computation methods. So you can straight away go to the methods. So these are the primary theory you have to keep in mind. And one more thing is very important. This provision is very important. Sometimes we will do a problem and only at the end of the problem we will get the idea that 92 subsection 3 is applicable. So stop that provision, stop the computation, say conclude, transfer pricing provisions are not applicable. So when? So by applying in a case where computation of income or expense or cost as per ALP has the effect of reducing the income chargeable to tax. So already assessee is declared income of 1 crore. If you apply TP provision, cancelling the provision, the income will be 90 lakhs. So 1 crore will be reduced. So already declared income has the effect of reduction. don't apply transfer pricing provision. Similarly, assessee already showing a loss of 60 lakhs. So if we apply transfer pricing arm's length provision, the loss will be 80 lakhs. No, transfer pricing provision is not applicable. So if it has the effect of reducing the income chargeable to tax or increasing the loss computed in books, then transfer pricing provision is not applicable. So an easy way to remember all these provisions while solving problem, the simple solution is, when you are making payment of expenditure, your P&L account debit side should be, keep in mind, P&L account debit side. Payment of expenditure to AE, if it is above arm's length price, transfer pricing provisions are applicable. Payment of expenditure to associate enterprise below arm's length price or equal to arm's length price, TP provisions not applicable. This is regarding debit side of the P&L, maybe purchase of goods from AE, accepting loan from AE and payment of interest, using intangible asset of AE and payment of royalty, purchasing asset from AE and debiting depreciation, or any other similar expense making payment to AE. If the actual payment we will call it as, for easy purpose, we will call it as TP, actual payment transaction amount, TP, transfer price. If the payment of expenditure, transfer price, is above arm's length price, meaning expenditure is overstated, profit is reduced, TP will apply, transfer pricing provision apply, ALP will apply. So first we should find out the arm's length price, then compare the whether it is payment debit side or credit side of the P&L. Okay, if it is debit side of the P&L, remember it is expense. So payment of expense above arm's length price, transfer pricing provision will apply. Arm's length price is 1 crore, you are making payment of 1.5 crore, transfer pricing will apply. Excess 50 lakhs will be add back to the net profit. But arm's length price is 1.5 crore, you are making payment only to 1.3 crore, then the arm's length price provisions or TP provision should not be applied because the profit already declared in India is more. If you apply arm's length price, it should have been reduced. That is not possible. And now what about credit side of the P&L? So credit side of the P&L, receipt of income. So receipt of income below arm's length price, transfer pricing provision will be applicable. Arm's length sales 10 lakhs rupees per unit, but you are selling it to associate enterprise or related party for 9 lakhs. So arm's length sales should be 10 lakhs, but you are declaring income sales only 9 lakhs or 8 lakhs. So transfer pricing provision is applicable. That difference will be added to your net profit. So remember, receipt of income below arm's length price and payment of expenditure above arm's length price, debit side and credit side of P&L, transfer pricing provisions will applicable. So when transfer pricing provisions are not applicable, payment of expenditure below arm's length price and receipt of income above arm's length price, do not apply TP provision because already the declared profit in India is more. So while solving a problem, first identify whether it is payment or receipt. Then compute arm's length price. Then decide whether there is a variation to the income to be made or we should write the note transfer pricing provision is not applicable. So this should be the way. So by reading the question, first you should identify whether it is payment or receipt. Okay. See, above all of these things, first you should apply whether it is AE, whether they are AE, whether TP provisions are applicable. Then find out whether it is payment of expenditure or receipt of income. Then for that payment or receipt, find out arm's length price. Compare with the transfer price, whether we should make a variation. So this should be the method or steps while computing the problem on transfer pricing questions. Okay. Now we can go to the methods. So this is the first method. Comparable. Total 5 methods are there. Comparable uncontrolled price method, resale price method, cost plus profit method, profit split method, transactional net margin method. So first method is comparable uncontrolled price method. It's purely between the comparison of prices between related party with the unrelated party. So what is the first step for solving a problem from comparable uncontrolled price method? Assessee Indian entity entered into a transaction with the related party, associate enterprise, which is a foreign company or non-resident. So that is known as transfer price. So this transfer price is manipulated. It is tainted. It is not correct. Some fraud has been carried out. This price is manipulated. So don't touch transfer price. So under comparable uncontrolled price method, you should not disturb this transfer price. Transfer price means the actual price at which a transaction carried out with the related party. Don't touch that. So keep it there. Compare or take the comparable uncontrolled transaction with unrelated party. So if this Indian entity carried out similar transaction with an unrelated party in uncontrolled conditions, then that is known as comparable uncontrolled price method. We can call it as comparable uncontrolled transaction price. So that cut price should be taken. And now the second step is make a comparison, because these two transactions should be at the same comparable level. There may be some level difference. Okay. So while making comparison, both of them should be at the same comparable level. So there may be some level difference, some functional differences. So some material differences which would affect the price. So that material differences should be eliminated, so that we will get arm's length price. So computation of arm's length price under comparable uncontrolled price method, the basic price is comparable uncontrolled transaction. That is assessee carrying on similar transaction with unrelated party. That is known as comparable uncontrolled price method. If the same assessee does not carry out uncontrolled transaction with an uncontrolled party, unrelated party, then there is only one way. We have to take the external comparable. External comparable means similar company in a similar industry, in a similar company. If a similar transaction is carried out with an unrelated party, what would have been the price charged if it is income? Or what would have been the price paid if it is a debit side of the P&L? So that should be taken. So there are two types of comparables in all 5 methods: internal comparable and external comparable. So always we should take first preference to internal comparable, because in internal comparable all the data are available easy, because inside our books only we will get the information. But external comparable means we should go to the database, we should buy the database, we should collect it, then we should use various filters, and we should take the similar transaction near to our level of transaction, then take that. So a lot of job. But if internal comparables and external comparables are available, so first preference must be taken to internal comparables, and if there is no internal comparables, go to external comparables. But anyway, comparable transaction should be the basis for uncontrolled transaction, should be the basis for CUP method. So price charged in comparable uncontrolled transaction is taken, then add or less adjustments to account for differences between the international transaction and controlled transaction which would affect the price. So adjustments means add or less. Some will be adjusted, some will be reduced. So depends upon that situation, we should read and whether it should add or less to make it at level par with the controlled transaction. We should make all the adjustments with that controlled transaction. We will get the arm's length price, and then this arm's length price should be compared to transfer price, the actual transaction carried out with the related party. What is the price? Then find out the difference. Then decide whether a TP adjustment should be made. That is, whether the payment is more than the ALP or whether the receipt of income is less than the ALP. Then only make the adjustment. You will get the total income of the assessee. So this is the way, first method we should apply. What would have been the possibilities of material adjustments? In related party transaction, we may give discount. Unrelated party, we are not giving discount. It's a difference. Related party, we will give a warranty with the transfer price, a related party. But with the unrelated party, there may not be a warranty, or there may be opposite. Unrelated party transaction contains warranty, related party have no warranty. Similarly, insurance, freight, etc. Import, export, there will be customs duty and freight. So in some cases, related party, we will bear the freight. Unrelated party, they are bearing the freight. So some difference will be there. These are the examples of material differences. These difference should be adjusted. Okay. We are straight away going to comparable uncontrolled price method question. The 5th question, right? So AE1 Limited is an Indian company. The shareholding pattern of AE Limited is as follows. AE2 Limited, foreign company, 30% holding. AE3 Limited, Indian company, 30%. Financial institution, Indian company, 10%. Public, 30%. So from the shareholding, it is very clear that the associated enterprises of AE1 Limited is AE2 Limited, because it is non-resident, foreign company, and holding at least 26%. 30% is holding. In examination, sometimes they won't give the shareholding pattern. Simply the question will start. AE1 Limited and AE2 Limited are holding subsidiary. That's enough. And one company is foreign company. That's enough, because To said to be a holding subsidiary as per the Companies Act, at least 51% should be held by the other company. To constitute AE, 26% is enough. So holding subsidiaries are always AE under the tax law. So here AE to foreign company is the related party, associated enterprise. So whatever transaction carried out by AE1 with the AE2 should be at the ALP. Otherwise, we have to find out the ALP and these adjustments should be done. So actual transaction carried out between AE1 and AE2 should be treated as TP, transfer price. With unrelated party, we should find out the arm's length price. Okay, AE1 Limited is a manufacturer of compact disc writers, CD writers, and its customers inter alia include AE2 Limited and M Limited. See, AE2 Limited is the related party. That is the transaction of TP. Related transaction is with AE2. And they are selling to M Limited. So very clear, M Limited is the unrelated party. M related is the unrelated party. So to find out comparable uncontrolled price method, we should take the base price of M Limited with M Limited. Then every adjustment should be made on the price with M Limited to make it at the comparable level with AE2. We will get the arm's length price. Okay. AE1 Limited during the year supplied 10,000 numbers of product to AE2 Limited at a price of rupees 2,000 per unit, and 200 numbers of the same product to AE3 Limited at a price of rupees 2,750 per unit. AE1 Limited has sold 100 units of the same product to M Limited at rupees 3,000 per unit. So here the transfer price transaction is with AE2 Limited. So for AE2 Limited, they sold 10,000 numbers. That is the related party transaction because foreign company, non-resident. With the Indian company, that is 30% holding AE3, that is not an international transaction because to said to be an international transaction, at least one party should be non-resident. So transaction with the AE2 is the international transaction, that is transfer price. And unrelated party is M Limited. So with the M Limited, they made a sale of only 100 units. There is a practical difficulty. There is some different views there. See how you can compare a transaction of 10,000 numbers with 100 units. That is a issue. But practically when we are doing transfer pricing, we will make some filters, product filters and turnover filter we will use. So by using turnover filter, if we sold 10,000 with a related party, almost 10,000 or 11,000 or 9,000 or okay 8,000 or 12,000 type of sale with the unrelated party only we will select. So in this question, in the absence of any other data, we are taking M Limited as the unrelated party and the comparable transaction is M Limited with M Limited. So what is the price charged from M Limited? 3,000. What is the price charged from related party? That is 2,000 per unit is charged from related party, foreign company. Whether it is debit side or credit side of the P&L, it is affecting debit side or credit side. See, AE1 Limited is a manufacturer of compact disc writers and its customers include AE2 and M Limited. AE1 Limited during the year supplied 10,000 numbers. That means sales, P&L account credit side, sales. So we have to find out arm's length sales. What is arm's length selling price under cup method? That we have to find out. For that basis, we should take the price of M Limited. Okay. So what are the major material differences? So transaction with the AE2 Limited at FOB. FOB means you are studying at customs, free on board. That is no freight is involved, no insurance involved. That should be paid by other company. So FOB basis. But transaction with the M Limited, we are charging CIF. That is FOB plus insurance plus freight. Details, freight and insurance, rupees 550. Quantity discount. So with the AE2 Limited, related party, we are giving discount. But with unrelated party, we are not giving discount. So what is the discount given to related party? That is one CD of INR rupees 10 each for every CD writer plus INR rupees 20 per CD writer. That means total discount is 30. 10 plus 20. 30 rupees is the quantity discount we are given to related party. But remember, no discount is given to M Limited, unrelated party. So that's a difference. Credit. Transaction with the AE2 Limited, we are giving 1 month credit. But transaction with the M Limited, no credit is given. Cost of credit is 1.25% per month. Per month, 1.25%. So for 1 year, will be 1.25% into 12. Warranty. no warranty is given with the A2 Limited, but for with the M Limited, we are giving a warranty of 6 months. Cost of warranty INR rupees 250 per unit. Yeah. Find out the ALP and income to be varied if any. So first we have to find out the arm's length price, and then we have to find out the income which has to be made any variation. So first we will find out the price with the M Limited. Okay, the price with the M Limited we charged is 3,000. That is the basic for the calculation. This is the base price 3,000. So comparable uncontrolled price 3,000. Now comparison. Transaction with the AE Limited, A2 Limited, that is a related party. We are made at FOB. FOB means freight or free on board. So that price is only cost. It does not include insurance and freight. But this unrelated party transaction price is CIF. Insurance and freight is loaded in that price. So to make it same comparable level, we have to reduce insurance and freight. So reduce insurance and freight from rupees 3,000. We will reduce 550. So first adjustment, reduce less 550 from CIF, so that it will be at same comparable level, FOB. Then only we can find out the manipulation. So both should be same level, not same price, same level. Price is different, level is different. So reduce 550. And now second, quantity discount. AE2 Limited, we give a quantity discount. If we give a quantity discount, it means the price will be less. But related party, unrelated party, we are not giving any discount. So if we are not giving discount, means price will be more. So unrelated party's price is more than the related party price. To make it at the same level, we have to reduce the discount. So because here the price is higher, M Limited's price is high because no discount is given. Every adjustment can be made only with the unrelated party's price. Related party price cannot be touched. So reduce the discount. So here also we are giving discount, then reduce. That is 30, rupees 30 we have to reduce. Third, credit. Transaction with the AE2 Limited, 1 month credit we are given. But M Limited, we are not giving credit. See, if we are giving credit, the price will be more or less. If we giving credit period, the price charged will be more or less. Definitely price will be more because working capital shortage or fund is blocking. We are giving credit to you. So we will bill you more. So as the credit is given to transaction with the AE2 Limited, AE Limited price is more. Related party price is bigger, higher because we are giving credit. But unrelated party we are not giving credit because as far as transactions carried out, immediately they are paying the price. So we are not giving credit, so the price will be lower. So related party's price is lower. Unrelated party's price is lower, but related party's price is high. To make it the same level, we have to add cost of credit. We have to add. So the price of the M Limited is 3,000 per unit. So 3,000 into, we have to apply 1.25% for the 1 year, right? Assume all the details are for the 1 year, right? So we have to add for one year credit. We can add 1.25% on that 3,000 for 1 year. We have to add. And warranty, transaction with the AE2 Limited, that is the related party, we are not giving any warranty. Not giving warranty means price will be less. If you give warranty, you will charge more. So transaction with M Limited, we are giving 6 months warranty. Yeah, so M Limited price is more. Related party price is less. So to make it at par, reduce. So cost of warranty 250 per unit. So if you calculate per unit, then just reduce 250. If you are calculating for total 10,000, total should be taken. Better per unit find out. Okay, so reduce 250. So we will get the arm's length price. So what is the arm's length price? You got it. Per unit, what is the arm's length price? 2620. So what is the actual price we charged? What is the actual price we charged? 2,000. So in a per unit, how much we are and what is the total number of unit? That should also you should take. Then only you will get the total amount which should be adjusted. Yeah. So this is the solution for that. So 2,207, right? 1.25%. Then freight we reduced, warranty for reduced, quantity discount we reduced. Cost of credit we added. So total arm's length the price is 2207.5. 1.25% per month. They taken 1 year or just 1 month? 1 month. Yeah, question says whether the details regarding 1 month. During the year, right? So we should take for per annum, right? 3000 into 15%. So that is 450 something like that will come, right? Yeah, they are saying only 1 month they are giving, right? Yeah, question say clearly say like that. Yeah. Cost of credit 1.25% per month. Yeah, 1 month. Yeah. Transaction with AA2 Limited, credit period 1 month. Yeah, just 1 month. So why there is a difference? 2,206, correct, right? 2,207.5 is the arm's length price. Arm's length price to be billed, it's sales, right? To be billed, but actually they billed only 2,000 with AE. The real price, arm's length price is 2,200. So per unit, they are making a manipulation of 207.5 is understated in India. So what is the total number of units sold to unrelated party? 10,000 unit. So 1 unit 207.5 into 10,000 unit means 20,75,000 rupees. They reduced the Indian income and diverted to foreign country through AE transaction. So that should be added. So this 20,75,000 should be added to the net profit of this company, Indian company. And we have to say this is a sale. So the selling price of rupees 2,000 is lower than arm's length price. So if it is in the debit side, expense side, it is just opposite, right? Payment of expenditure, if it is more than ALP, then only arm's length price or transfer pricing provisions will apply. But here it is a receipt side. So arm's length billing to be 2,207.5, but actually billed only 2,000 rupees. So lower per unit by 207.5. So total number of units sold to related party 10,000, 20,75,000 to be added to net profit of this company further against this 20,75,000. No chapter 6 is allowed. Maybe 80 IA or IB or similar type of unit, but still that deduction not allowed. If it is located in a special economic zone and exporting it against which they are eligible for 10AA, no 10AA deduction not allowed. And against this 20,75,000 will be treated as a underreporting of income. Regarding this transaction, this 20,75,000 variation arising from 10,000 unit transaction with the related party. Related to that transaction, if proper books and documents is not maintained in transfer pricing, it will be treated as a misreporting of income. Accordingly, this 20,75,000 on which a tax will be calculated, on that tax, 200% of that tax can be levied as penalty as per 270A. So these are the 3 consequences if this variation is done by AO. If company itself is showing that this is ALP, we made a difference, so we are adding to the net profit, then there will be no problem because that is not a fraud case. Assessee itself is reporting. But if assessee says that my arm's length price is 2,000, what I billed is correct, but department rejected, they find the arm's length price 2,000 and 207.5, then this problem will arise. 3 consequences. This is comparable uncontrolled price method. So now we can move to the second method, resale price method. So this is usually applicable in case of payment only. This is not applicable in respect of export. This is usually import. The associate enterprise is located outside India. This first method, comparable uncontrolled price method, is best suitable for goods sold or goods imported. Also we can apply cup method. Even for normal services also we can apply cup method. So normal cases we can apply cup method. But resale price method is best suited when associated enterprise in India is importing some goods from associated enterprise located outside India, and without any major value addition, just adding some profit, that goods are resold in India. So in that situation, this method is best suited. So if they are doing a lot of value additions to that goods or services and then they are loading profit and value addition, then they are selling, this is not suitable. But just some basic value addition is doing, not that much, some characteristics is not changing. In that situation, we can say this resale price method is best suited, or reseller, redistributor. So main manufacturer outside India, distributor is an AE located in India. In those cases, this method is suitable. So how we find out the arm's length price? Totally different from other method. Don't compare the methods and study. It's completely different. Comparison possible only in two methods: cost plus profit method and transaction and net margin method. Only a small difference. In cost plus profit method, we are using the gross profit margin, but in transaction and net margin method, we are using net profit margin. That's only difference. Otherwise, all other things are same in all those two methods. But all other methods completely different. So when we study resale price method, don't think about cup method, first method. Resale price method, how we will find out. So first we should take the resale price at which goods imported from AE and sold it to unrelated parties in India. Actually, we are finding out the arm's length price method by using the transfer price itself. The manipulated price, tainted price is taken first. But in the last method, we are taking cut price, comparable uncontrolled transaction. But here, it's not like that. At what price we are reselling the product which were imported from our AE and sold it to unrelated customer in India. So here resale, the other party should be unrelated party. But the goods has been imported from related party and resold it to the unrelated party in India. So what is that price? So take that price. And the second step, from which we have to reduce normal GP margin in a cut. So what is cut? Comparable uncontrolled transaction. That means if we are selling these type of goods, importing from an unrelated party and resold it to unrelated customers in India. Similar goods are importing from unrelated party and sold it to unrelated parties in India. What would have been the gross profit margin we are charging? So that gross profit, that will be given in the question. So that gross profit margin should be reduced from resale price with the related party. Reduce. We'll get the cost. Then from this price, reduce what are the expenses incurred in connection with the import from related party. At the time of original import from related party, what are the expenses incurred? For example, customs duty, freight, transit insurance, ship demurrage charges. So these type of import related expense we have to reduce. Purchase related expense means import related expense, reduce. So we will got the price at the point when the goods are reached at the port. We got that price. Now compare the import transaction with a related party with unrelated party. So related party import, we incurred customs duty, freight, but unrelated party import, we incurred only customs duty. We didn't incur any freight. So similar type of material difference is there. That material difference should be adjusted to this price at the last step. So up to this point, do not consider any material difference. Simply take the resale price at which goods are imported from related party and sold it to unrelated parties in India. So the resale price in India should be taken and reduce the gross profit margin with the unrelated party. That means similar goods imported from unrelated party and sold it to unrelated party in India. At that transaction, what is the normal GP margin? That GP margin should be reduced from this tainted price. We will go to the cost, and from that cost reduce purchase related expense. So this is a backward calculation. So we will reach at the point where the goods are imported at the point of import. Point of importation, what is the price we will get? So from that price, then make the material differences between unrelated import and related parties import. We will get the arm's length price. And this arm's length price is the purchase price of arm's length. Arm's length purchase price. Remember, resale price method is applicable only in case of P&L account debit side. Import from related party and resold here, and compared with the actual price at which it is imported from the related party. Compare. If the price at actually imported with the related party is more than this price, excess should be added to net profit variation. Got the idea? So I think it's time for lunch break. Go for lunch break after having the lunch, and then come back and we'll continue. Okay. So evening at what time you will be comfortable? By 6 you are okay? 6 you are okay, right? Because we have to finish international taxation today itself. Then only other 70 mark domestic taxation is there, right? So that another 2 days we can, only 3 days is there, right? So 2 days is at least required for the other area. So today we have to finish at least international taxation part fully. So come at 2:30. For this international taxation part, other area I didn't prepare any solution. We saw in the class itself. Okay. I will do the detailed this part. DP, taxation and The question resale price method ആണ്. Question number 6 അല്ലേ? Question number 6, right? Yeah. So while doing resale price method, there is a small point you have to keep in mind. First, what we are doing is at what price it has been purchased from related party and then resold in India to the ultimate customer. That ultimate customer in India is unrelated party. So that price is the starting point. So originally it is imported from a related party and sold it to unrelated party in India. From that resold price, what we are reducing is normal gross profit margin in a comparable uncontrolled transaction. That means a similar goods has been imported from unrelated party abroad and has been resold to unrelated parties in India. So it is actually a similar transaction to the first one. So from that, what is the normal gross profit margin that we are reducing? So by reducing the unrelated parties gross profit margin from this price, what we are getting is the price that would have been paid if it is purchased from an unrelated party. So that is the actually price we are getting at that point of time. From that related purchase expense from a related party has to be reduced from that price, so that what we are getting is the price which will be similar to that purchase from an unrelated party from abroad. So next we are adding or less the add or less their adjustments to account for differences. So that may be some difference in import expenses or discount or something like that. So that differences while considering, you should think about comparable uncontrolled price method where what we are doing is compare the related party transaction with unrelated and both are making at the same level. So similar type of adjustments we are doing at the last stage. So then we will get the arm's length the purchase price. So here we can see that question. So A1 Limited is an Indian company. A1 Limited is an Indian company. The shareholding pattern of A1 Limited is as follows. Shareholders name, foreign company. So it's very clear here. The related party is AE2 Limited, foreign company in which AE1 Limited is holding 30% shares. That is a AE. AE1 Limited trade in compact disc writers. AE1 procured CD writers both locally and in the international market. It imports consist of CD writers purchased from AE2 as well as another manufacturer known as. So this is the related party transaction, that is importing goods from AE2 Limited and then it is resold in India. AE1 Limited during the year purchased 100 CD writers from AE2 Limited at rupees 2,900 per unit. So this is TP transfer price. These are resold to A Limited at a price of 3,000 per unit. So that this 3,000 is the starting point of our computation. AE1 Limited has also purchased similar product from an unrelated supplier, that is K Limited, and has resold the same to M Limited, who is also an unrelated party and has earned a normal gross profit of 12% on sales. So actually in this question, related party and unrelated party transaction, material differences has not been given. So it's a very simple question. Simply follow the steps mentioned in rules, how we will value. So first to take the price, that is resale price at which it is resold to customers, that is from AE and resold it to unrelated party in India. That price is rupees 3,000 less. From this 3,000, reduce the normal gross profit marker on the sales which is originally purchased from unrelated party, imported from unrelated party and resold to related parties in India. So that is in this case 12% on sales. So less normal GP margin in a comparable uncontrolled transaction, that is 12%. So 3,000 into 12%, how much? 360. So balance is rupees 2,640. This is the price. And the next step is less import related expense. So suppose if these goods while imported from AE2 Limited, if they would have been given in the question say customs duty of rupees 300 incurred per unit, and freight of rupees 100 paid. So if similar type of items were given, that will not be reduced, but nothing has been given. And after that, compare these two prices. If there is any difference between unrelated party import and related party import, that will be adjusted. So nothing has been there. So this is the arm's length price to 2,640. And this rupees 2,640 is the arm's length price which should be paid for import. Remember, it is P&L account debit side. Even though we are starting 3,000, which is a resale price in India, what we are trying to find out is the arm's length price at which it should be imported from related party. So arm's length price is 2,640, arm's length purchase price or import price. But actually at what price we are importing it? So we are importing it for rupees 2,900 per unit. This is a TP. So something is different here, because arm's length prices you can pay to rupees 2,640, but what we are paying is rupees 2,900. Remember, it is P&L account debit side. Payment of expenditure exceeding the arm's length price. So arm's length price 2,640, arm's length payment, but the actual transfer price payment 2,900. So excess payment is rupees 260 per unit. So how much unit has been imported? 100. So 260 into 100 is the income to be added back to the net profit. This is resale price method. Resale price method is compared to other methods, it's a little bit easy. So they never asked the resale price method for exam. Actually, before 2021, not 21, during that COVID period, right? We can say up to 2019. They have asked the questions only from this first method, comparable uncontrolled price method frequently. And only once in 2016, I think, for all the syllabus, they asked their question from the next method, cost plus profit method. But after that, from 2021 later, 2022, 23, 24, in between, they asked the questions from cost plus profit method, even transactional net margin method also they asked. So they never touched two methods. One is resale price method and another one is profit split method. So they never asked. That means it is a possibility also. Next time they may ask a new method of, for the first time they may ask a question from resale price method, or they may ask a question from profit split method. Okay, so now we can move to the third method. So the third method is cost plus profit method. It is best suited for manufacturing industries, this cost plus profit method. Manufacturing, not only the goods, even service is providing from India to outside India, or goods is manufactured here and exported to associate enterprise. In those cases also this method is suited. So under cost plus method, this is completely different from the other two methods, because other two methods are basically comparisons with the prices. But here it is not like that. Here the arm's length price is find out based on the profit margin. If it is cost plus method, we are taking the gross profit margin as a benchmark. But under the next method, transaction net margin method, we will consider the net profit. So the idea behind this method is, the manipulation is happening at the time of loading profit and fixing price. There is no manipulation in actual cost of production or actual cost of providing a service to AE, because our cost of production and the books and everything is audited. So for cost details, we cannot make any manipulation. When we are making manipulation, or we are trying to manipulate the price so that the profit can be reduced. So based on this, they are saying actual cost nobody can be manipulated because it's audited and books and documents evidence is available. So that should not be touched. But we should think about the profit margin, because in that people are usually making the manipulation. So first step, to the associated enterprise for providing services or manufacturing goods and exporting, what are the actual costs incurred for production or for providing service? For example, there is a company in Chennai which is developing a software and exporting to US to its associated enterprise. So for providing that service, actual cost of providing that service, that is actual expense incurred, cost incurred in India is 10 lakhs. But they are billing at rupees 12 lakhs. So our question is whether this 12 lakhs is arm's length. That's our question. So this method says, So you simply ignore the profit loaded by the Indian entity, just to take the actual cost of providing that service or actual cost of production in case of goods, 10 lakhs. So take that. And then for a similar type of services or a similar type of goods we manufactured and exported to unrelated parties in US, in that transaction, what is our normal gross profit margin? Remember, margin means in percentage. Gross profit margin can be found out basically in two models. So number one, either as a percentage of cost or as a percentage of sales. In examination, they asked both types. Gross profit margin as a percentage of total cost or gross profit margin as a percentage of sales. Both they asked. So you should be careful. So in two ways we can represent gross profit margin, either as a percentage of cost or as a percentage of sales. As a percentage of cost means gross profit divided by cost into 100. As a percentage of sales means gross profit divided by sales into 100. So anyway, we have to take the comparable gross profit margin with the unrelated party. Gross profit margin, remember, percentage. But this gross profit margin compared to the actual gross profit margin earned with the related party transaction, both should be at the same comparable level. So if there is any difference in item which would affect the cost profit margin, gross profit margin, then that should be adjusted. So after adjusting the normal gross profit margin with unrelated party, take the adjusted gross profit margin. And this adjusted gross profit margin should be added to actual cost. Earlier example, 10 lakhs. Actual cost of providing the services or manufacturing goods to AE. On that, we should add the adjusted GP margin, or we can say adjusted arm's length gross profit margin. So this arm's length gross profit margin in percentage should be added to the actual cost of providing goods or services to the associated enterprise, related party. We will get arm's length sales. And this arm's length sales should be compared with the real sales we billed the associated enterprise. If there is any difference, we can make the variation. And usually cost plus profit method and even transaction net margin method is best suited for export. It is applicable for credit side of the P&L. So actual billed should be compared with the arm's length amount to be billed. Difference we have to vary. So this is a theory. So direct and indirect cost incurred by assessee for goods or services produced or provided to EAE should be taken from our books. Actual data, actual cost. See, we have actual cost and we have actual sales also. Actual sales is tainted, manipulated. So we have to take the actual cost with AE and then add adjusted GP margin. Adjusted GP margin means normal gross profit markup in comparable uncontrolled transaction in percentage. Adjust such a margin for material difference. Here also we can say related party is with the related party we are providing warranty. Unrelated party we are not providing warranty. So definitely it will affect the profit margin. So similar type of items we should compare with both margin. Sometimes we have to add, sometimes we have to reduce some items. So depends on. By reading the question, we have to judge that whether it should be added or less. So adjust such a margin for material difference. So we will get the adjusted gross profit margin. And this adjusted gross profit margin, that should also be related to production, because direct and indirect costs related to production only should be taken. Administrative expense and indirect cost not related to production should not be considered in cost. And similarly, such a type of material difference which will affect only the net profit, which will not affect the gross profit, should not be considered. So direct trading account debit or credit, which will affect the GP margin. P&L account debit or credit will not affect the GP margin, because GP margin means direct cost. What is the gross profit on that work? So that we are finding out, not the administrative and other indirect expense we will not be considered here. This adjusted GP margin should be added as profit to the actual cost. We will get the arm's length price or arm's length sales to be billed. So we will go to the question. Remember, there are two methods, either GP margin as a percentage of sales or GP margin as a percentage of cost. So how we will find out that? So if the question says that 35% on work or 35% on sales, then that means it is as a percentage of sales. So if they are saying 35% on cost, then that GP margin is represented as a percentage of cost. So on cost means cost is 100. On sales means sales is 100. So cost plus margin or sales plus margin. So some costing basic idea you should keep in mind. So the representation of margin as a percentage of cost or as a percentage of sales is very important. So now we can go to the question, the seventh question. So Nano Incorporation, a German company, holds 45% of equity in High-Tech Limited, an Indian company. So we can say Nano Incorporation and High-Tech Limited Indian company are AE, 45% equity. High-Tech Limited is engaged in development of software. High-Tech is Indian company. Indian company engaged in development of software and the maintenance of the same for customers across the globe. Its client includes Nano Incorporation. So AE is also a client. During the financial year 24-25, High-Tech Limited had spent 2,400 man hours for developing and maintaining software for Nano Incorporation, with each hour billed at rupees 1,300. Actually, this is the transfer price, actual sales with the AE. For this actual sales, we have to find out the ALP sales. This is actual billed. Next data. Cost incurred by High-Tech Limited for executing work for Nano Incorporation amounts to rupees 20 lakhs. So this is actually the actual cost of providing the services with the AE. This is our starting point of computation. 20 lakhs. 20 lakhs should be taken. Now, regarding the margin, they are saying an unrelated party transaction. High-Tech Limited had also undertaken developing software for Modi Industries, for which High-Tech Limited had billed 2,700 per man hour. So that is a sales with unrelated party. Sales with unrelated party. We don't need the sales with unrelated party. We need the margin. The persons working for Modi Industries and Nano Incorporation were part of the same team and were of matching credentials and caliber. High-Tech Limited made a gross profit of 60% on Modi Industries work. Yeah, that is the data we require. Normal GP margin with the unrelated party. See, 60% on Modi Industries work means whether it is 60% on sales or whether it is 60% on cost. If they say on work, no, on work means on sales, on billed amount. 60% on Modi Industries work. We will say there is a project is coming. On that project, this much profit. On this project, this much, that means sales. On work means on sales, not on cost. So 60% on Modi Industries work. So remember, this is 60% on sales. They are giving GP margin as a percentage of sales. High-Tech Limited's transaction with the Nano Incorporation are comparable to transactions with the Modi Industries, subject to the following differences. So with the related and unrelated, they are giving the difference. Nano Incorporation gives technical know-how supported to High-Tech Limited, which can be valued at 8% of the normal gross profit. That means the normal gross profit margin. Modi Industries does not provide any such support. Remember, this 8% you should not adjust directly, because the reason is they are saying 8% of the normal gross profit. That means 8% of margin. So here the margin is 60%. So 60% into 8%. That should be taken. That's very important. So on normal gross profit, if they are saying 8% on sales directly, then we can adjust. Directly adjust. But this they are saying 8% of the normal margin. That is the first material difference. And second one, since the work for Nano Incorporation involved a huge number of man hours, a quantitative discount of 14% of normal gross profit was given. That is also 14% of normal gross profit. So related party, for related party, they given a quantitative discount. And for related party provided technical know-how. That means for unrelated party, they are not providing technical know-how. If they are not providing technical know-how or support, we will provide a technical know-how and support for that work, so that we will build it to more. We will be build more, because we are incurring cost, so we will build it more. But for nano, we will bill it less, because they are providing technical support. And second one, for unrelated party, the gross profit margin will be more. Why? Because we are not giving any discount. But for related party, we are giving discount. So the related party's margin will be less, and unrelated party margin will be more. This is the second difference. And the third difference, High-Tech Limited had offered 90 days credit to Nano Incorporation. Okay, if we are giving credit to Nano Incorporation, related party, we will bill more, because we are incurring expense. So the margin will be more. The cost of which is measured at 2% of the normal billing rate. Yeah, here which is very important, 2% of normal billing rate. Rate means price, selling price. Here we can adjust directly, not on margin. No such credit was offered to Modi Industries. So remember, first thing is technical support. Related party providing technical support, unrelated party not providing us technical support. So for unrelated party, we are incurring more expense, and we are billing more. So the gross profit margin with unrelated party will be more to that extent. And second one, we are giving quantity discount to related party. Since we are giving discount, the selling price will be less, automatically margin will be less. So gross profit margin is lower in second case. But unrelated party, we are not giving discount, the margin will be more. Third part, we are giving credit to related party, margin will be more. But for unrelated party, there is no credit, cash and carry. So the margin will be less. So first two items are on markup, but remember second item is on sales, direct. Third item. So first item, value of technical know-how, 8% of 60%. Remember, 8% of 60%. Unrelated party is providing technical know-how, but related party is not providing technical know-how. We are taking the related party margin 60%. As the related party does not provide technical support, we have to arrange technical support, for which we will incur more, so that we will bill more. So 60% is more margin. So we have to reduce it compared to make to the normal other level, related party level, we have to reduce. So 8% of 60%, because question itself says that 8% of gross profit margin is 60. So 8% of 60, 4.8, we have to reduce. Second one, quantity discount given to Nano Incorporation. Nano Incorporation's profit margin is lower, because we given discount. So the selling price will be less. So profit will be less. So margin also will be less. But unrelated party, we are not giving discount. So the 60% margin with unrelated party is high. So to make at the same comparable level, reduce it. So 8.4%. That is, we have to reduce. So balance 46.8%. Now, to Nano Incorporation, we give a credit period, so that its margin will be more. Unrelated party, we didn't give any credit, so margin is less. To make it the same level, add 2%. 2% of 100%. 100% means that is sales. So directly 2% we can add, because the 60% is as a margin on sales. So this 2% is also on sales. So direct 2%. 48.8% is the arm's length margin to be billed as a percentage of sales. Because on work, on sales. So this 48.8% on sales is the arm's length margin to be billed. Okay. So now we can go to the straight away we can compute the arm's length price. Simple. This arm's length margin should be added on actual cost of providing goods or services with E. So that is given in the question 20 lakhs. So 20 lakhs is the cost. So we need 48.8% margin on sales. So that means sales is 100. So this 20 lakhs is sales minus margin. That is 48.8 is the margin. So therefore 51.2% is 20 lakhs. Because it is a percentage on sales, right? 48.8% on sales. So sales is 100, right? So to get the cost amount we know 20 lakhs. So sales minus profit margin 48.8. So 100 minus 48.8, 51.2 is the cost. Then what will be the 100 into 100? We will get the sales. So directly you can add the margin. So 20 lakhs divided by that is 48.8 into 51.2. We will get the profit margin 19 lakh. Sorry, 20 lakhs divided by this is 51.2. Then what is for 48.8? So we will get that figure 19 lakh 6,250 is the margin. Or if you put 100 directly, you will get the figure 39 lakh 6,250. So in both way we can do. So arm's length amount to be billed or arm's length the sales or transfer price is 39 lakh 6,250. But actually what we build is in the given the question, that is per man hour we have billed 1,300 to nano and actual hours incurred is 2,400 man hours. So 2,400 into rupees 1,300, what we build is 31 lakh 20,000. To be billed is 39 lakh 6,250. Remember, it is P&L account credit side. Sales is understated. So understated to the extent of 7 lakh 86,250 to be added. But if it was reverse, arm's length was 3120 and actual build is 39 lakh 6,250, TP provisions will not be applicable. But here sales is less than the arm's length. So difference 786,250 should be added. So this is cost plus profit method. This is actually an exam question. They asked a very old exam, that is November 2016. The same question they taken and in another pattern they asked with the change in figures. The major change was 60% on cost. So in this question, the question says 60% on Modi Industries work. They asked another question, gross profit margin as a percentage of cost. If it is as a percentage of cost, the only difference is last moment when we take the cost, that cost should be taken as the 100. So here instead of taking this 51.2, we will take the another amount 48.8. So like or directly we can add. If cost is 100 and margin given is as a percentage of cost, directly find out the arm's length margin. This 48.8% directly can be added on 20 lakhs. 20 lakhs into 48.8% margin. We will get the arm's length sales. That's the only difference. They are made a change when asking a question recently, I think 2022 or 23 like that. They asked for no syllabus a question. In that same pattern, even adjustments also same. The only difference is they uses the word 60%. I'm not sure whether it is 60 or something like that. On cost, clearly say on total cost. So that question is based on margin as a percentage of cost, but this question margin as a percentage of sales. So this is cost plus profit method, best suited when Indian entity manufacturing goods or providing services and exported to related party outside India and billed. So for arm's length the sales to be billed, we have to apply, we can apply cost plus profit method. Next method, once we studied this method, next method is very easy. Transactional net margin method. So this is actually cost plus profit method. Here we are using normal GP margin. But in the next method, they will take net profit margin, net profit margin. Again, there also net profit margin as a percentage of sales they can take, net profit margin as a percentage of cost they can take, net profit margin as a percentage of asset employed they can take. So because net profit can be represented in different basis. So usually for exam purpose, you should keep in mind either on cost or either on sales. They will ask any one of these, but in practically a lot of other bases also we are using in TP. So transactional net margin method. Next method. So we will discuss the theory first. This is cost plus profit method. Third method. So next transactional net margin method. After that we will discuss profit split method. Simple. The only difference is instead of GP you have to take an NP, net profit margin. So first step is same. Total cost incurred. See here the word is direct and indirect cost. But when it is come to net profit, total cost, all direct costs, even all indirect costs, any indirect expense related to that goods or services exported to non-resident which should be considered. Total cost incurred in international transaction with AE. Then add adjusted net profit margin. From where we will take the net profit margin. Similar, comparable uncontrolled transaction with unrelated party in uncontrolled condition. Similar comparable transaction. What is the net profit margin in that transaction? That should be taken. Add or less material differences which would affect the net profit margin. Adjusted net profit margin we will get. This adjusted net profit margin should be added to the actual total cost. We will get the arm's length, the sales to be billed. So there also cost plus profit method also same method. Same way we are solving the question. The only difference is there we will consider GP margin and only direct and indirect cost will be taken. But here we will consider total cost and net profit margin will be taken. Rest of the things are same. There we will consider material differences which would affect the GP margin. Here we will consider the differences which will affect the net profit margin. Adjusted net profit margin will be added. We will get the arm's length price. So while we're solving question, the simple method is first read the question. Once you sure that it is TNMO method, or question says that compute arm's length price under transaction net margin method, or any indication like that, some net profit margin is given. Even though they are not mentioning TNMM, we can assume it is TNMO method. Once identify that, first step is go to the unrelated party. What is unrelated party's sales? What is the unrelated party's total cost? Reduce that. You will get unrelated party's profit. Then find out the margin. If you take the margin as a percentage of cost, here also it should be added as a percentage of cost. If you finding the margin as a percent of sales, here it should be added as a profit margin as a percent of sales. If the question says consider net profit margin as on sales, then you should consider sales only. If the question says net profit margin as a percentage of cost, then we should take cost only. If the question is silent, we can take any margin, either cost or either sales. So there is a question. I think the 9th question, right? 8th is actually profit split method that we will do next. So first 9, question number 9, and thus incorporation. Yeah. So Andes incorporation having its business in Malaysia has advanced a loan of Malaysian dollar 1,60,000 to Andes in Limited India. Book value of total assets. Remember, in all other questions, from the first sentence itself, we can identify whether they are AE. But here they are simply saying Andes Incorporation having its business in Malaysia advanced a loan of 1,60,000 to Andes Limited India. So we have to check from the data given whether they are AE. So 1,60,000 Malaysian dollar to Andes Limited. Book value of total assets of Andes Limited was 125 lakhs. That is in rupees. That should be keep in mind. The loan is given in Malaysian dollar, but this book value of asset is given in 125 lakhs rupees. Andes Limited provides software. Yeah, all other details are related to transfer price. So from this, we have to find out AE, whether they are AE. So one entity gives loan to the another entity. For the borrower entity, the loan amount should constitute at least 51% of the book value of assets of the borrower enterprise. So here 1,60,000 Malaysian dollars into exchange rate is given in the question. 1 Malaysian dollar is 45. So into 45, rupees 45. So we will get convert that into Indian rupee. How much? 57.6? 70? 72 lakhs, right? 72 lakhs. So this rupees 72 lakhs divided by rupees 125 lakhs into 100. What's the percentage? 57 point, yeah. So it is more than, the loan amount represents more than 51% of book value of assets of the Andes Limited. So they are AE. So this first we should establish they are AE. Then we have to write separately. It's an adjustment. Because question nothing says regarding shareholding. Question doesn't say holding subsidiary. So only if they are AE, transfer pricing provisions are applicable. So how they are AE? Because of this condition. Advancing loan which constitute at least 51% of book value of asset for borrower. Okay, they are AE. Now we can think about the TP. Andes Limited provides, that is Indian company provides, software backup support to Andes Incorporation. Again, export. P&L account credit side. Andes Limited has spent 50,000 man hours during the financial year 24-25 for the services rendered to Andes Incorporation. The total cost for Andes Limited is MD Malaysian dollar 75 per man hour. So this is the actual cost. We need this actual cost. This is TP, actual build. Andes Limited has billed Andes Incorporation to Malaysian dollar 90.75 per man hour. Gamma Limited. Here comes the unrelated party. Gamma Limited in India, which has a similar business model, provides software backup support to Olive Incorporation in Penang, Malaysia. Gamma Limited's cost and operating profit are as here under. So direct cost 600, indirect cost 200, operating profit is 200. calculate arm's length price for the transaction between Andes Limited and Andes Incorporation based on the above data of Gamma Limited using transaction net margin method. Assume one Malaysian dollar is equal to rupees 45. Explain if there is any adjustment to be made to the total income of Andes Limited. Malaysian dollar. Okay. Now we can go to the question is over, right? Question is over. Yeah. So first take the unrelated party. Unrelated party. This is here. It is with Gamma unrelated party. What is the total cost? Total cost is 600 to 800 rupees in lakhs. 800 lakhs. 800 lakhs. So what is operating profit? That is 200 lakhs. So we can take as a percentage of cost. If you are taking as a percentage of cost, the net profit margin is 200 lakhs divided by 800 lakhs into 100. So what is the GP? Sorry, net NP, net profit margin. What is net profit margin? 25 around percent, right? 25%. From the question, there is no material difference. Nothing is mentioned. So no material difference means no adjustments. This 25% is adjusted NP margin. Simply take this net profit margin with the actual cost. You will get the arm's length sales. It's actually an exam question, right? So find out the actual cost. The actual cost, Andes, this Indian company Andes Limited, is 75 per man hour is the cost. What is the total time spent? 50,000 man hour. So what is the cost? So the cost is 50,000 Malaysian dollar. Sorry, 50,000 man hours into 75 Malaysian dollars into rupees 45. We will get the cost in INR. What is the total cost in INR? Rupees 16 lakh. 87 lakh. 16, 87, 50,000, correct? This is the actual cost. From the question we can identify. They incurred 50,000 man hours for this work. And the actual cost incurred for Andes Limited is given in, not in Indian rupee, given in Malaysian dollar, 75 per man hour. So 50,000 man hours into 75 Malaysian dollar per man hour, converted into INR into rupees 45. 16 lakh 87,000, 16 lakh 80, so 16 crore 87 lakh 50,000. Yeah. Now add the NB margin. Okay. We take the NB margin as a percent of cost or sales. This 25% is as a percentage on cost or sales. Cost. So this is a cost. So directly add margin. 25% of 16 crore 87 lakh 50,000. So add margin. 25% margin on cost. We will get arm's length sales. Margin or arm's length sales? Margin. Arm's length sales 21 crore 9 lakh 37 500. So what is the margin? Just to write here margin. Just the margin 4 lakhs. 4 crore 21 lakhs 87 500. So arm's length sales to be billed is 21 crore 9 lakh 37 500. Okay. And what is the actual they build? Actual they build is 90.75 per man hour. This is the TP. So TP here. So TP we have to find out. So 50,000 man hours into 90.75 into rupees 45 is the TP sales. TP sales. That is how much? 20 crore 41 lakh 87 5. So the sales is underbilled. Actual to be billed is 21 lakh 9,000 21 crore 9 lakh 37 500. But the transfer price sales is 20 crore 41 lakh 87,500. So what is the variation to be done to the net profit? 67 lakh 50,000 to be added. So this is TNM method, transaction net margin method. So last 3 years, 2 times they asked questions from this TNM method. So the latest the trend is either cost plus profit method or TNM method. or cup method, first method, comparable uncontrolled price method. Other two methods never asked. So now next step one is profit split method, that is the last method. Practical application also very rare. Examination they never asked, but in detail in study material they are explaining the concepts of profit split method. So as their detailed discussion is there, it's a warning, it's a possibility they may ask the profit split method question. So I will explain how it will be computed. So this profit split method is applicable only when multiple associated enterprise located in different countries are coming together to provide a big work. So in that case, this method is suitable. So there is not 1, 2 AE, maybe 3 or 4 or 5 AE, and all of these AEs are contributing for a common work, and they are billing their share. So the question is whether the share they billed are adequate, whether it is at arm's length. Because entity located in India is giving technical support, entity located in Singapore is providing production, and German entity is supervising. So they are billing all these three together as a work. So each country's AE will get their share for the work they are done. So the question is whether the amount billed by each entity in the country is arm's length, especially with the Indian entity. So multiple international transactions which are so interconnected that they cannot be evaluated separately. In that situation, we have to apply this profit split method. So in this combined transaction with multiple AEs are involved, first step is identify the total profit earned from this total work. See, for example, an international construction work is up. So Malaysian holding company got the work. It has a subsidiary in India and it also has a subsidiary in Germany. So German company provides the technical support. Indian entity gives the raw materials and procurement and production, and Singapore entity the ultimate finalization and billing. So in this case, all these three entities together, what is the total profit they are earned from that work? Combined net profit must be identified. Then this combined net profit should be divided among all these associate enterprise based on their basic return, like see what functions they are performing, what are the assets they are employed for this work, what are the risks they are assumed. That is known as FAR analysis. Functions performed, assets employed, risk assumed. So based on this FAR, there will be some allocation ratio for the profit between these entities. So Indian entity 30%, German entity 40%, and again 30% for the Singapore entity. So that is 30, 40, 30. So that will be given in the question. We need not worry about FAR ratio. That will be given in the question. So based on that FAR ratio, this profit should be divided. Which profit? Combined net profit. That means what is the top final amount billed for the client? Reduce all the cost incurred by Singapore entity, Indian entity, German entity. We will get the combined net profit. So this combined net profit should be divided among these three entities based on FAR ratio. So we will get the share of profit. And this share of profit should be added to actual expenditure or actual cost incurred by each entity separately. So Indian entity incurred for this particular work, raw material production and procurement, they incurred total 1 crore rupees. Their combined net profit is based on FAR ratio 30 lakhs. So 1 crore plus 30 lakhs. 130 lakhs is the amount they have to bill. This is arm's length sales. But actual bill may be 120 or actual bill may be 140. Then we will discuss, depends upon that, we will compare, depends upon that, we will find out whether there is any variation in profit to be added. So first step, identify the combined net profit, and then that combined net profit should be divided based on FAR ratio. And there are two methods, that is profit split method, that is one is total profit split method and second one is residuary profit split method. If it is a residuary profit split method, the profit will be split in two steps. First step, based on a basic return. Basic return means, so if Indian entity is incurring this type of expenditure in another work, minimum they will get this much return. So usually basic return is calculated as a percentage of cost incurred. So if this much cost we are incurring for some other unrelated party, we will earn at least a 20% profit on the cost incurred. So that is known as basic return. FAR ratio is different. FAR ratio means based on functions performed, assets employed and risk assumed in that international work, what is the return, fair return they have to receive. That is FAR ratio. Basic return means That is a usual, very basic return. At least we should get this much. FAR ratio will be definitely will be more than the basic return. So if basic return and FAR ratio is also given, then first the combined net profit should be allocated to all the three entities based on basic return. And remaining profit, if any, that should be divided among the FAR ratio. So if two-step division is there, that is known as residual or residuary profit split method. If no basic return, only FAR ratio is given, simply divide the combined net profit based on FAR ratio and add it to actual cost. We will get the arm's length price. That is known as total profit split method. So they can ask a problem in two methods, either total profit split method or residuary profit split method. If the question is silent, we have to do only the total profit split method. If they given basic return and FAR ratio and asking us to compute the profit split method, then we have to do both. Sir, whether the arm's length price in both method will be same? No, definitely will be different, because profit is allocated in two ratios. So definitely the final sales will be different. So this is the way we are finding out the profit split method. So we are actually calculating the arm's length price of the Indian entity only. But for finding out the total profit, we need the other entities total cost also we require, because then only we can find out the total cost. Once we got the total cost this for the international work, then only we will get the combined net profit. Okay, so we will solve a question so that you will get a better idea. I will solve both the methods. Okay, so first one, AE1 Limited, Indian company, the related party is very clear, that is AE2 Limited, foreign company, 30%, AE3 Limited, foreign company, 30%, that is also AE. There are two AE, AE2 Limited, AE3 Limited. Financial institutions, Indian company, yeah. AE1 Limited is an investment advisory company which is in association with AE2 Limited, assists its clients with the foreign acquisitions. AE3 Limited, which is based in USA, has worldwide presence. AE1 Limited is approached by M for identifying potential target companies for acquisition in the USA. So actually they are providing some services, acquisition, mergers and acquisition services. In order to serve M, AE1 Limited and AE3 Limited have each contributed integrally to identification of potential targets and assisting M with the acquisition process. So for the above, AE1 Limited received consideration of $50,000. Then the financials are as below, AE1 Limited and AE3 Limited. What is the revenue they got? Total revenue is $50,000. That $50,000 is split among AE1 and AE3, $30,000 and $20,000. Next data, very important. We need that. Cost. AE1 Limited incurred $20,000. AE3 Limited incurred $8,000. Profit. AE1 $10,000. AE3 Limited $12,000. That will be the profit they will show in the books, but that we won't accept. The arm's length sales is 30,000 and 20,000 is the arm's length sales. Transfer price sales. We have to find out the arm's length equivalent to that AE1 Limited revenue 30,000, whether it is at arm's length, that we have to check. So AE3 Limited no need to check, because AE3 Limited is not located in India. We have to find out the arm's length price of the entity located in India only. Factors to be considered. They are giving all the data. Basic return is given, that is for profit split method. So basic return they are given in the B point, right? That is for AE1 Limited and AE3 Limited, that is $800 and $3,000. $3,000 for AE1, $800 for the AE2 Limited. At least they should get that much basic return. See how they calculated basic return, that is given in the first paragraph, right? The normal basic return is ordinarily calculated as a percentage of cost incurred or gross revenue or capital employed. In this example, it is assumed as a percentage of the cost. Based on the FAR analysis, basic return of AE1 and AE3 are determined to be 15% and 10% respectively. See, we will get that figure, 15% and 10%. 15% of cost, right? 20,000 into 15%, how much? 20,000 cost incurred into 15%. 3,000, right? And 8,000 cost incurred into 10%, how much? 800, right? So that is the way how the 3,000 and 800 they arrived. It's given. If they incur cost, at least they should get 15% and 10% of the cost as a basic return. So that is 3,800. Total 3,800. And now on the basis of FAR ratio, 70%, 30%, 70% for AE1 and 30% for AE3. Apply total profit split method and residual profit split method. So first we should identify the total profit, combined net profit. So total amount they billed is for the client is 50,000. $50,000. What is the total cost incurred by both entity? 20,000 plus 8,000, 28,000. So combined net profit. What is the combined net profit? $12,000. Correct? 12,000, right? Or 22? So, sorry, 22. 22. Sorry, 22. $22,000. Now, once we got the combined net profit of 22,000, then the next step we have to identify is the split. So this combined net profit, first I am doing the total profit split method. So based on the FAR ratio 70 and 30. So 70% for AE1 and 30% for AE2. This is for AE1 and this is for AE1 and AE3, right? Yeah. How much? 22,000 into 70%. 5,400. And here balance 6,000. Actually, the 6,600 we don't require that because that is belongs to the other entity. Other entities country we don't know how they find out the ALP. We need Indian entity only AE1 15,400. So now take the cost incurred by AE1 Limited Indian entity for this work, that is $20,000. Add this profit we arrived. So based on FAR ratio, the return they should get $15,400. So what is the amount they have to bill? $35,400 they have to be billed. Or we can say ALP sales. What is the actual bill? Actual bill is 30,000, right? 30,000. So income to be varied is $5,400 to be added to the net profit of AE1 Limited. If we apply total profit split method, this is total profit split method. Now we can go to the residual profit split method. Okay, in case of residual profit split method, first we should identify the combined net profit, same 22,000 as we arrived. Then it should be divided, not fully, up to the basic return. They should apportion the profit. Basic return for AE1 Limited is $3,000. That is 10% of their 15% of their cost, and for another entity is $800. And then out of 22,000, if you reduce 3,800, what is the balance? This minus 3,800. What is the balance? 18,200. This 18,200 is the residual profit. After reducing the basic return to each entity, AE1 and AE3, the remaining profit available for distribution 18,200. That should be again splitted based on FAR ratio 70/30. So 18,200 into 70%, 12,740, right? And here that's actually not required. 12,740, that's enough. So this plus this added to cost. So cost given $20,000 and basic return profit 3,000. FAR profit to be received 12,740. Therefore, arm's length price to be billed how much? 35,740. But actual to be billed, actual billed is 30,000. So income to be varied is 5,740. So actually profit split method is very simple. If they are asking for exam, it's very simple. Out of all these methods, this method is the most simple method. So find out the combined net profit, split either FAR ratio, or if they are giving basic return ratio and FAR ratio, then first up to the amount of basic return, distribute the amount of profit based on that basic return amount. That will not be a ratio, that will be an amount we have to find out. In this question, there is straight away given. For exam purpose, sometimes they will say basic return is 15% of cost and 10% of cost. They won't give the figure 3,800 for exam purpose. This is actually this to explain the concept of this method. I use the detailed question. In your examination, sometimes they won't say this 3,800. Instead of that, they will say basic return is 15% of cost and 10% of cost. Then they will say FAR ratio is 70 and 30. So we have to find out that 3,800. So this is the profit split method. So profit split method is over. So comparable uncontrolled price method, and second one is that is profits resale price method, and then cost plus profit method, then transactional net margin method, and then profit split method. So these are the 5 methods. So sometimes an assessee may have multiple arm's length price in one method. So which method is most suited? It is the responsibility of the assessee to find out the most appropriate method. So based on that is not most selection of most appropriate method. So based on nature and class of international transaction, class of associate enterprise, and FAR ratio used by them, and availability, coverage, and reliability of data, degree of comparability, to what extent we can make the comparability, what is the availability of data. So based on these guidelines, assessee has to select which method is most suited for the international transaction for finding the ALP. They have to select. So if assessee selected one method, so he got say TNM method or cost profit method. Okay, in that again there is another issue. Under cost plus profit method, there are a lot of comparables. So comparable uncontrolled transaction, there is not only one transaction, there are 2, 3, 4, 5, 6, lot of comparable uncontrolled transaction. Then what we will do? So if there are multiple comparable transaction, we have to find out the multiple ALP. If we got multiple ALP, then we have to go to the arithmetic mean of that ALP and take the arithmetic mean as the arm's length, final arm's length price. If under a single method, multiple arm's length price is available, we have to take the arithmetic mean. But if the number of arm's length price is 6 or more, so if it is 6 or more, arm's length price are available, arithmetic mean is not possible. In that case, we have to go for the range concept. So if the number of comparables are less than or equal to 5, that is number of arm's length price are less than or equal to 5, then we can take the arithmetic mean. That arithmetic mean should be taken as the arm's length price. When we are taking arithmetic mean of the 5 or less arm's length prices, in that situation, they are giving a tolerance band, they are giving a convenience. The convenience is, suppose your arm's length price and arithmetic mean ALP, both are different. So what is the difference? What is the variation? If the variation is not exceeding 3% of the transfer price of the assessee, then it will be accepted. Your transfer price will be accepted. Arm's length will not be taken. So the condition is, if where the arithmetic mean is taken as the ALP, when we are taking arithmetic mean as the ALP, that is the number of ALP is less than or equal to 5, especially first 3 methods, CUP, RPM, CPM, and TNM method. Okay. For profit split method and other method prescribed CBDT, anyway, even though less than 6 or more than 6, we will take only arithmetic mean. But comparable uncontrolled price method, resale price method, cost plus profit method, TNM method, if the number of arm's length price got under a single method is 5 or less, we can take arithmetic mean of that all those arm's length prices, and that will be taken as a ALP. But if the difference between such arithmetic mean ALP and actual transfer price is more than 3%, then only we have to proceed with the TP variation adjustment. But if the variation between actual transfer price and arithmetic mean ALP does not exceed 3% of the transfer price, then your transfer price will be accepted. That means there is no need for these arm's length price. And if the comparables is more than 6, equal to or more than 6, then we have to go for a table. We have to put a table. That is known as a range concept. In that table, a small arm's length price first, a little big figure next, that is ascending order. Arithmetic arm's length price should be, we have to arrange it in a table, and in that table we have to find out the 35th percentile and 65th percentile, and if the transfer price is in between 65th percentile and 35th percentile, in between that range, transfer price will be accepted. And if the transfer price is not between 35th and 65th percentile of the data set, then we should take the median of the data set, and that median of the data set should be taken as the arm's length price. This is known as a range concept. Usually they are not going to ask the questions on range concept in deep, but just you should understand this. So what is range concept? That is when the number of arm's length price under a most appropriate method is 6 or more, we have to find out the data set, and we have to put all these items in ascending order, and we have to rank them, and in ascending order put a data set, pure statistics. Then find out the 35th percentile and 65th percentile. If the transfer price falls between this range, TP will be accepted. If it is not within this range, go and find out the median of the data set, and corresponding to that median, what is the value that should be taken as the arm's length price. So this is the range concept. So just I am leaving this because we have limited time, and usually they are not asking in depth from this, but this 3% you should be keep in mind. They may ask a multiple choice question, and this range concept also they may ask this percentile and all those things. Okay. And when we are applying range concept in comparable uncontrolled price method, only current year data must be used, but in resale price method, CPM and TNM method, total 3 years data must be taken, current year and preceding 2 years weighted average data must be taken. After taking weighted average, put the data set ascending order, then find out 35th percentile, 65th percentile as usual. So examination, they never tested questions from this area. By seeing this, we will feel that it is complicated. Actually, it is very simple. That is why examination they are not asking. Practically also, everything is done by software. It is very easy. Now, this 3% tolerance band, when this is given, see, in a most appropriate method, assessee find out arm's length price, but he is getting more than one arm's length price. So, if the arm's length price is 5 or less, then we will take the arithmetic mean. So, in that case, the difference between ALP determined by using the arithmetic mean and transfer price exceeds 3%, then only we will proceed. So, if it does not, the difference does not exceed 3% of the TP will be accepted. This tolerance band is not available in one situation. Only one situation this tolerance will not be given. That is, if the Indian entity carrying out a transaction with a resident of NJA. NJA earlier we just discussed. What is NJA? Notified Jurisdictional Area, Section 94A. Certain blacklisted countries with which India has no proper information exchange mechanism, where people dump their black money. So, notified jurisdictional area, there is a assessee in NJA, and that person carrying on a transaction with Indian entity, these two persons will be deemed to be AE, even though there is no 26% holding, even though there is no 10% guarantee, even though there is no 90% raw material procurement, even though any one of that transactions are not satisfied, but still Indian entity and the person located in NJA will be deemed to be an AE, and all the transactions in between them will be deemed to be an international transaction, and every transfer pricing provisions will apply except these three. The only advantage available in the TP is this 3% tolerance band. That advantage is not available for international transactions carried out with persons located in NJA. That is prescribed in 94A. In all other cases, under transfer pricing, we will get this 3% tolerance band. And next area, we have to give it that. That's the power of AO and TPO, all those things we discussed. So next area, most important area is that is secondary adjustment. Secondary adjustment means when you are making this transfer pricing adjustment, and or transfer pricing adjustment can be happened in many other way also. That is how we will rotate this. How we will rotate this? No idea. So first that I will do, first I will explain what is secondary adjustment. Secondary adjustment means due to the primary adjustment, if there is a happens to a primary adjustment happens to an assessee, then only there will be secondary adjustment. So what is primary adjustment? Primary adjustment means a person's a person's income has been varied due to the adjustment of the transfer pricing officer, that is ALP determined by transfer pricing officer or by the assessing officer based on report of the TPO, and income is increased. Number two, a person's income is increased due to he declared for safe harbor rule. So if he opted for safe harbor rule, to comply with the safe harbor, minimum percentage notified under safe harbor rule he has to declare. So by declaring that safe harbor, his profit is increased. So in that situation, primary adjustment happens. Number three, sometimes there may be some dispute relating to transfer pricing adjustment, and assessee may go for double taxation relief through MAP, mutual agreement procedure. He can file a complaint with the concerned income tax department in the other country and here in the income tax department. That is mutual agreement procedure. So by considering that application, if the income tax department itself or the government itself give a solution to him, that is known as MAP solution. So based on MAP procedure, if there is an income variation happens, that is also a primary adjustment. Or assessee itself himself is suo motu making adjustment to transfer price in his return based on the arm's length price declared by the assessee itself. So these are the reasons where primary adjustment can be happen. So whenever there is a primary adjustment and that primary adjustment amount is more than the limit, that much amount must be put back to India. That is the condition put under the income tax law. That amount should be brought back to India or repatriated back to India. Not getting that. Okay. You cannot read this, right? You cannot read this. Now in this we cannot adjust this. No other way. So primary adjustment, how primary adjustments happen? Number one, transfer pricing adjustment, income is increased, and that income is increased suo motu by assessee. Assessee itself is declaring this is my ALP, actually this is my transfer pricing, I am making the increase. Okay, suo motu by assessee in his return of income. Or sometimes based on transfer pricing adjustment made by assessing officer and it is accepted by assessee, he does not have any dispute. And third one, due to advance pricing agreement, that APA assessee entered into an advance pricing agreement with the department. Based on that APA pricing methodology, his income is increased and his income return has been increased. Or due to safe harbor rule, or due to MAPS resolution, that is a mutual agreement procedure. See, due to transfer pricing, there will be a double taxation because Indian entities' income is increased. Correspondingly, the foreign entities' income has not been reduced to that. So that income will be taxed in that country for AE, and Indian entities also added and taxed here. So for the same income, for two persons, two different countries, it is taxed. Because in transfer pricing, definitely there will be double taxation. Because here in Indian entity, income is varied. Correspondingly, that non-residence income is not reducing. So what happened? There will be double taxation. But not for single assessee for two countries. Two different assessees, two different countries for the same income taxed twice. This is known as economic double taxation. So if single person for the same income taxed in two country, jurisdictional double taxation. For jurisdictional double taxation, we have solution. DTAA agreement, 91 relief, unilateral, bilateral relief available. But for economic double taxation, direct relief is not available. So what we will do? So for economic double taxation, relief can be obtained only through MAP. With that country, associate enterprise country and India, there should be a double taxation avoidance agreement. As per there is the double taxation avoidance agreement, there should be a specific clause that for associate enterprise and transfer pricing related issues, and they can go for MAP resolution. There should be a specific provision in the DT agreement. Then we can go for economic double taxation solution under MAP. So if the concerned government and the Indian entity decided and they can give a relief, then relief will be available. But there is no assurance. Sometimes relief will be available, sometimes not. So that is known as mutual agreement procedure, or otherwise we can say that whenever there is a dispute in double taxation avoidance agreement, they can approach the concerned government who signed the DT agreement directly. That is known as MAP, high level resolution. So mutual agreement procedure resolved and assessee income, or MAP resolution final decision was assessee failed department 1, then income will be increased. Or safe harbor rule, or advance pricing agreement, or Suyomoto made by assessee accepted by made by AO accepted by assessee, and Suyomoto by assessee in case return of income, or based on TP adjustment. So in that case, primary adjustment happened, that is income is increased. So if the amount of primary adjustment made by assessee or department is more than rupees 1 crore, then secondary adjustment is compulsory. So even though there is a transfer pricing adjustment, variation in income, but that amount does not exceed 1 crore, this section 92C secondary adjustment is not applicable. Okay, then what is secondary adjustment? Secondary adjustment says, so if there is a primary adjustment, that income is added to your net profit and you are paying tax here, but that much economic resources is not coming back to India. So whatever profit you diverted from India to that foreign country, that should be repatriated back to India in real money. So that AE should give back that money to India. It should be come to India. So that's the idea. So practically very difficult. So when it should be repatriated to India, they are saying within the specified date. Specified date is usually generally the specified date means a due date for filing ITR plus 90 days. So due date for filing ITR in respect of international transaction assessees will be 30th November. So 30th November plus 90 days is the usually the time limit for repatriate their money within India. So within that time period, that is due date for filing ITR plus 90 days, if the money has not been repatriated into India, then what? Okay, then there will be deemed interest. Because this much money which did not brought back to India will be treated as a loan given by Indian entity to AE, and on which notional interest will be calculated. And that notional interest will be taxable as income for the Indian entity, and you have to pay tax on that. So generally the time limit is 90 days from the due date for filing ITR. So if the money has not been repatriated within that time limit, then they are saying it will be treated as a deemed loan and interest rate will be applied. So interest to be calculated from the specified date. So, and how the interest will be calculated. So they are saying if the international transaction is denominated in Indian rupee or whether it is denominated in foreign currency. If it is denominated in Indian rupee for the relevant previous year, for which year you are calculating the interest, for that relevant previous year, what is the SBI lending rate of marginal fund, what is the cost of lending rate for SBI. So that plus 3.25% should be applied. So if the SBI lending rate is 9, then 9 plus 3.25, for example, 12.25 will be the rate. So if the international transaction denominated at Indian rupee, then we should take SBI lending rate as on the 1st April of the relevant previous year. Remember, relevant previous year means for which year we are calculating the interest, that previous year. So that previous year's 1st April, what is the 1 year marginal cost of SBI lending rate plus 3.25. But if it is in foreign currency, we have to take 6-month LIBOR. LIBOR is actually outdated, but still they are using that word. 6-month LIBOR, London Interbank Offer Rate on 30th September of relevant previous year plus 3%. So this interest to be calculated from the specified date. And that interest will be added to the income of the assessee. So if primary adjusted amount is not remitted to India within 90 days from specified date, deemed loan by assessee to NR assessee, interest on deemed loan at a notified date shall be added. So what is the due date? Specified date. Specified date is usually 90 days from specified date. So specified date means normally due date for filing ITR, that is November 30th, because in all these cases definitely there will be November 30th because they are carrying out international transaction. Form number 3 CB has to be uploaded, so 30th November plus 90 days is the time. If money has not repatriated from 90 days from the specified date, remember interest is calculated from specified date. Interest is not calculated from 91st day. 90 days is the time cushion given to repatriate the money. So if you did not repatriate that money within 90 days, they are calculating interest from the early date, from the specified date, not from 91st day. If transfer pricing adjustment Siomoto made by the assessee, due date is the specified date plus 90 days, time limit for repatriation. If AO made in his order, assessment order, and assessee accepted, date of order by AO plus 90 days. And if advance pricing agreement is entered before the due date for filing ITR, then due date for filing ITR. But if the advance pricing agreement is entered after the due date for filing ITR for that relevant year, then end of the month in which advance pricing agreement is entered. And if safe harbor rule, due date for return of income, map resolution, date of giving effect by AO. So generally due date for filing ITR should be taken. If it is made by AO, order of the AO plus 90 days time for repatriation. But if not repatriated, interest is calculated from this date, not from 91st day. From 30th November, 1st December onwards, interest will be calculated. If it is not repatriated within 90 days. That's very important because in MCQ, while calculating interest, we will make the mistake. From specified date, it will be calculated. And sir, up to what time this will be calculated? So till the date when you repatriate that money, it will be continued. So for next year also, it will continue. So to make an end to this industry demanded, we need some other provision because majority of the companies are not going to repatriate that money because it is crores of rupees. They won't brought back that money into India. So government says another issue, that is you can do one thing. If you does not want to repatriate that money and if you does not want to make this additional national income based on interest, then do one thing. Pay some additional tax on that primary adjusted amount. Then you will be relieved from all the consequences. So option to pay additional tax at the rate of 18% income tax, 12% surcharge, mandatory. Normally surcharge is applicable only when total income exceeds 1 crore. But here mandatory surcharge 18% plus 12% plus 4%. So the effective rate will be 20.964%. This amount should be, this percentage should be applied on the money which you are not repatriating. That is primary adjusted amount. Sometimes some companies will say we repatriated this much. Okay, then remember balance amount. So balance amount they will apply 20.964%. Tax can be paid. This will be treated as a final payment and no further tax treatment. That means further there will be no notional interest calculation. After 3 years, current year 24-25, assessment year 25-26, there was a primary adjustment exceeding 1 crore. You didn't brought back the money till 2028. So in 2028, you want to pay additional tax. Remember, if you are paying additional tax on 2028, September 30, up to September 30, 2028, you have to pay interest. This interest income you have to declare. On 28th September, you can pay additional tax of 20.964% on the excess money which has not been repatriated and pay the tax. And this tax, if you debit it to P&L, it will disallow. It is not allowed as an expense. This tax is not an expense because this is equal to income tax. Income tax is not allowed as an expense in while computing BG because company will pay this tax and they will debit such a tax payment and the P&L debit balance, right? Debit said they will debit in 2028 when they are paying the tax. Not allowed. This is not a business expenditure, not allowed because basically it is an income tax. So specifically section 40 subsection A subclause 2, income tax is not a business expenditure. It will be disallowed. So, but once you made this final payment, no further tax treatment, further no adjustment, nothing. You are free to the extent of that primary adjustment, you are free. But next year again primary adjustment, again you have to repatriate. Otherwise, notional loan deemed interest will continue. So this is a provision of secondary adjustment. This is very important for your exam point of view. Yeah. Yeah. No. Additional tax is not applicable on interest. Additional tax applicable only on the excess money. Excess money means the money we are made in primary adjustment. Interest amount you should be paid, but that interest also not allowed as expense. That interest, interest is not we are paying, interest is income, right? Interest is calculated as income. On that income, you have to pay normal tax. You have to pay normal tax. This is additional tax to stop that calculation of deemed interest income. They are saying this excess money repatriate, not repatriate, is treated as a loan given by Indian entity to AE. So if it is a loan, interest is accrued. That accrued interest calculated at this rate, shown as income in the books of the assessee. If it is a company, they have to pay 30% or 25% tax. Got the idea? That is normal income. But this tax is to stop this treating as loan and the notional interest calculation. They are paying additional tax, you can pay and stop it. So you have only two solutions. Either you have to pay you have to declare notional income and pay tax, or you can stop this by paying additional tax, or you repatriate the money. But nobody is going to repatriate the money. Mainly the company will try to do basically this additional tax they will try to pay. Anyway, it is a loss because 20.964 is a big amount. But at least one time, if you yearly pay 20.964%, at least you can avoid that notional interest income, right? Otherwise, you could repatriate. Definitely, MNCs will find some other way. If they want to make some investments in India, they will route like this through route. They will show something like that. This money is repatriated, something like that. Anyway, they need to invest some money in here. And they will make some documents stating that this is the repatriation. And money came into the banking channel. They will definitely find a way, 100% sure. Already started. And now, next is 94A is another important area. We have to keep in mind in this area. This is also sometimes they are asking. That is 94A, notified jurisdictional area. So notified jurisdictional area, it's a small section, 94A. Actually, it is outside the TP provision, but it is related to TP. This is also an anti-avoidance measure. Transfer pricing is also a anti-avoidance measure. So 94A says a person in India should not make transactions with a person located in notified jurisdictional area. So far, no country has been notified. So far, no country has been notified. See, once notified Cyprus, within months, that notification withdrawn. Cyprus has been eliminated. Why? Because we're going to assume probably Cyprus government has been made an emergency meeting with the Indian authority and made pressure. Because if it is blacklisted, nobody will go and invest in Cyprus because of strict provisions. So because of political reason, with retrospective effect, Cyprus has been withdrawn. That means now there is no country in this list, but this provision is keep it open as a warning. So when a country is listed under 94A, that is a blacklisted country. Usually blacklisted countries means a lot of people from India are dumping black money into that territory. And in that territory, there is no proper government or there is no proper tax administration. So even though India is requiring any information regarding those persons from that country, we won't get it. So their data will be confidential in that country. So in those cases, that countries will be treated as notified jurisdictional area and it will be notified under this section. Okay. Once it is notified, a person in India, resident in India, making a transaction with any person located in NJA. That may be an individual, that may be a company, or that may be a permanent establishment of a foreign company located in another country. For example, a foreign company located in Dubai has a branch in NJA and Indian entity is carrying out transaction with that branch in NJA. This provision will be applicable. So if you are carrying out a transaction with a person located in NJA, even though there is no associated enterprise conditions. So what are associated enterprise conditions? Participation, capital, control, management, that 12 scenarios. So any one of that 12 transaction does not carried out during the year. No 26% holding, no raw material procurement, no sale of goods, nothing like that, but still deemed to be AE. So this entity, Indian entity, and that person located in NJA, they will be treated as AE, and whatever transaction they are carrying out, maybe accepting loan, giving interest, or giving loan and accepting interest, or payment of expense or receipt of income, whatever may be, any transaction with such a person located in NJ will be treated as international transaction, and all the provisions of transfer pricing provision will be applicable except tolerance variation. Tolerance variation is, that is arithmetic mean and actual transfer price, that variation does not exceed 3%, it will be accepted, right? That won't be accepted. If there is 3% variation, even though within 3%, TP adjustment shall be made. So all transactions and one of the parties located in NJ will be deemed to be AE, and all transaction deemed to be international transaction, and all TP provisions will apply except variation. And next consequences, second consequence. See, all the transfer pricing provision will applicable means you have to prepare documents, you have to find out ALP, you have to make the variation, you have to repatriate the money, a secondary adjustment, primary adjustment, books, documents, penalty, everything will apply, even form number 3 CEB, everything. And second, if you are making a payment of expenditure to a financial institution located in NJA, that means Indian entity taken loan from a financial institution or a bank located in NJA. And we took the loan, we are making repayment. So we are making payment of interest expense. So that interest expense or that loan repayment, so for us, interest is the expense, loan repayment is not an expense debited to P&L, but interest will be debited to P&L. So such a payment will be disallowed, such expense will be disallowed unless the Indian entity gives a declaration and made a prescribed arrangement to the CBDT that if CBDT asking for any information from that financial institution located in NJA, that financial institution is bound to give whatever information CBDT is asking. So for that, first they have to make an undertaking, they have to make an agreement with the foreign entity that, see, if our CBDT asking any information, you have to give that. So only after giving that authorization or that prescribed arrangement, then only the payment of expenditure made to financial institution located in NJA will be allowed as an expense to the Indian payer, Indian entity. So disallowance of payment made to financial institution located in NJA unless assessee furnishes an authorization to income tax authority to seek relevant information from the said financial institution on behalf of such assessee. So whatever information which can be asked by Indian entity, that will be asked by CBDT also, and that other entity must provide. So if there is no such arrangement, this expense will not be allowed in India. And second, if the assessee does not provide the proper explanation regarding the source of money of the person located in NJA, any liability which is payable to the NJA will be deemed as income of the Indian entity. That means Indian entity took a loan, huge amount of loan from a financial institution located in NJA. And CBDT is asking to give this much amount of loan to the Indian entity, that NJA entity, from where they get the money, who is funding them. So from where they are getting that much capital, from where they are getting the money. So ultimately, Indian black money will be converted and dumped into these territories, and that will be again converted to India as a foreign direct investment or something like that. So to prevent that circulation, they are saying we need the source from where that money obtained by the person located in NJA. So that source should be revealed to the CBDT by the Indian entity. Otherwise, whatever loan taken from that entity will be treated as income of Indian entity. Very dangerous situation. Indian entity took a loan of 100 crore from an NJ entity, but they failed to disclose the sources of that NJ entity. In that situation, this 100 crore liability loan will be treated as income of Indian entity. Very dangerous. Amount received or credited from NJ will be deemed as income if assessee does not provide explanation for source of income or explanation not satisfactory in opinion of AO. And next one. Normally, to claim an expense in India, we have to maintain some basic information. To whom we are making the payment of expenditure, what is the nature of expenditure, where is the bill, bank statement, all those things we have to keep. In addition to that, if we are making any payment of expenditure to a entity located in NJA, for us it is an expenditure, for them it is an income. we have to maintain additional documents required by the CBDT, prescribed by CBDT. Only then that expenditure will be allowed. So no deduction of any other expenditure or allowance or depreciation arising to such a transaction unless assessee maintains, Indian entity maintains relevant documents and furnishes prescribed information. So additional expenditure and documents must be maintained. Then only expenses which is paid or payable to the NJ entity, which is an expense for the Indian entity, allowed subject to this additional documentation. And last, higher rate of TDS. When we are making a payment of expenditure to an NJA, the rate of TDS shall be normal rate or 30%, whichever is higher. So this 30% is the rate. So on this 30%, we have to apply cess also. This is the TDS rate, right? Only the TDS rate, not the tax rate. TDS we have to deduct at a higher rate. So if the NJ entity file the return, they can claim the actual tax. So excess will be, they will get the refund. But for the Indian entity, we have to deduct the TDS at a normal rate or 30%, whichever is higher. 30 is a very high rate. So even though it is a royalty, normal rate under as per section 115A is 20, but we have to deduct TDS at 30. If the interest is paid to an NJA entity which is invested in notified infrastructure debt fund, normal rate is 5, but we have to deduct TDS at 30. So higher rate TDS must be deducted. So this is another. So if we did not deduct a higher rate, what will happen? It will treat it as a non-deduction. If we deduct 20% instead of 30%, it will be treated as a non-deduction. The department can say that while computing your PGBP as per 40A1, we are going to disallow 100% of your expenditure. Entire expense can be disallowed. Because PGBP there is a provision, if TDS is not deducted, it can be disallowed. Again, it is paid to non-resident. So 100% can be disallowed. So that is also possible. But there are two views. Short deduction and non-deduction is not same. In case of short deduction, only proportionate amount should be disallowed. In case of non-deduction, food should be disallowed. But there is another view. Short deduction is equal to non-deduction and it should be disallowed. So different contradictory high court decisions are there. So two views are also possible. But anyway, higher rate of TDS will be applicable. This is 94A NJA. So this is the only privilege they are not getting in TP. That is 3% or 1%. That 1% is when it is related to a wholesale trading transaction. 1% is a tolerance band for arithmetic mean. It's not important. Generally 3%. So that 3% variation not available, even though we are taking arithmetic mean for an ALP for a transaction with the person located in NJA. And next is the another important area, that is thin capitalization, or we can say 94B, limitation of interest. Can we take a break? Yeah, after the break we'll continue. Okay. So only these 2-3 areas in TP, and we will do the remaining problems in TP. Then we will go to the double taxation relief. While studying or revision, remember to solve a question on double taxation relief, you should be well versed with the heads of computation, salary, HP, PGBP, capital gain, IFOs. You should be very clear about set off. You should be aware about basic chapter 6A reductions available to individuals and HF, because majority of the DT problems are asking for individuals. So we need to study that ATC, CCCD, all those chapter 6A, you should be aware. So then only we can do the problem. And one more thing, if assessee is a resident, income is received from foreign country, that will be in dollar, pound, euro, that should be converted into INR. So we should study that rule 115 also, how the foreign income should be converted, because for new syllabus, they included that rule in our syllabus. But for the old syllabus, question will give the exchange rate. But here we have to know in which date, whose exchange rate will be taken. They will give SBI rate for different dates. So which date should be taken? So that should be aware of. Then only we can solve the problem properly. And recently DTA problems are not asking for simple level. Whatever questions available in the study material is simple. But the questions they are asking for exam is tougher questions. Okay, so that should be careful. So after DT relief, I think the major area of international taxation we will cover. Okay, and tomorrow onwards we will do the balance topics. So take a break, 15 to 20 minutes. Okay. അപ്പോൾ നമ്മുടെ സെക്കൻഡറി അഡ്ജസ്റ്റ്മെന്റ് കഴിഞ്ഞു. 94A NJ കഴിഞ്ഞു. Okay, so next is limitation of interest, section 94B. But 94B section, what it says when an Indian entity making interest payment to non-resident including AE, the total interest paid including AE interest should not exceed a particular limit. That limit is 30% of EBITDA. EBITDA means earnings before interest, tax, depreciation, amortization. Okay, suppose if the total interest including AE interest, total interest means sometimes there may be interest debited to P&L which is paid or payable to Indian residents, maybe bank interest, non-AE interest, or maybe AE interest. We should take the total. AE interest as well as non-AE interest, total interest debited to P&L should not exceed 30% of EBITDA. If it exceeds 30% of EBITDA, out of that excess, AE interest will be disallowed. So this disallowance will never applicable for non-AE interest, but for computing the 30% of EBITDA, we will consider total interest. Whether it exceeds 30%, we will consider total interest. But disallowance applicable only for AE interest. AE interest, that means interest paid or payable to AE. And this section applicable for where the payer or the borrower is Indian company or permanent establishment of a foreign company. So not only for residents, even for non-residents also this section is applicable. That is, one non-resident is paying interest to another non-resident, but the payer non-resident is located in India. In that situation also it is applicable. That is why PE, permanent establishment of a foreign company. A foreign German company set up a branch in India, and that branch is taking a loan from Japanese company and paying that Japanese company and German company is AE. So this Indian branch is paying interest to Japanese company. This section is applicable. So that is PE of a foreign company or Indian company. And what is paying? That is interest. So for paying interest, they are taking loan or debt. So it may be debentures or it may be deposits or it may be loan. So Act uses the word borrowing, loan or debt. So interest or similar nature. So any amount in the nature of interest. So there are certain contradictory decisions whether guarantee fee can be treated as an interest. So in the latest decision, court says guarantee fee cannot be treated as an interest. So interest, actually debt, in return we are paying interest. And total interest to the associated enterprise should exceed rupees 1 crore. So to attract section 94B, lot of conditions, there is a monetary limit more than rupees 1 crore. If the interest is paid or payable to the AE should exceed rupees 1 crore. Total interest may be more than 1 crore, but if the AE interest is less than 1 crore, this provision is not applicable. And who is the lender? That is, who is the person getting the interest income from India? That's lender is a non-resident associated enterprise of assessee, or sometimes directly not an AE of Indian entity. It's a third party. For example, an American bank granting loan of rupees 10 crore to an Indian company. Indian company took a loan of 10 crore from American bank, Bank of America. There is another company in America which is an associated enterprise of Indian company. Say X Incorporation US. So Indian company Indy Limited. So Indy Limited is took a loan of rupees 10 crore from Bank of America. At or about the same time, simultaneous same time, there is another American company which is an associate enterprise of Indy Limited, that is X Incorporation. That is X Incorporation made a deposit of rupees 10 crore with the Bank of America. So we took a loan of 10 crore from Bank of America. At or about the same time, an equal or matching amount is deposited by our associate enterprise in that bank. If this happens, this American bank and this Indian company Indy Limited will be deemed as associated enterprise only for the limited purpose of this section 94B. So they are clearly saying Not an AE. The lender is not an AE, but lender have been guaranteed by AE of assessee. That is X Incorporation, US company, is an associate enterprise of India Limited. That X Incorporation gives a guarantee to Bank of America an equal amount of 10 crore. Or deposited a matching amount from an AE of assessee, or similar amount is deposit, put a deposit in Bank of America. Maybe they are getting interest for that deposit, but anyway, the loan amount and deposit amount is matching. Then instead of giving direct loan, they are routing through third party. That is the idea. So even though it is not like that, so if this happens, that third party will be treated as deemed to be associated enterprise. So this provision not applicable in other cases. This deemed AE concept applicable only in 94B. This particular deemed AE applicable only in 94B. And total interest paid or payable exceeds rupees 1 crore to AE. And we are claiming that interest deduction under PGBP. That means as per the provisions of PGBP, it is allowable expense. That interest is allowable. To claim an interest under PGBP, basically there are two conditions. Number one, that loan amount must be used for the purpose of business. And second one, when we are making interest to non-resident, we have to deduct TDS. So PGBP provisions complied. So this is an expense allowable under PGBP. But AE interest exceeds 1 crore. Including AE interest, total interest, if it is exceeds 30% of EBITDA, out of the excess interest, what is AE interest included in that excess amount, that will be disallowed. So they are saying in another way, total interest in excess of 30% of EBITDA. Remember, total interest means interest to AE as well as non-AE, exceeds 30% of EBITDA, or interest paid or payable to AE, whichever is lower, should be disallowed. But if the Indian entity, that is a borrower entity, the main purpose of Indian entity is engaged in the business of banking or insurance, then it is active business. As part of their active business, sometimes they will take a loan from AE, no problem. This section is not applicable. So the borrower entity should not be engaged in the business of banking or insurance. So we can say a lot of exception. If the interest paid or payable to AE does not exceed 1 crore, this provision not applicable. If the payer engaged in the business of banking or insurance, this provision not applicable. Even though interest exceeds 1 crore, total interest does not exceed 30% of EBITDA, this provision not applicable. All these conditions cumulatively satisfied, then excess interest will be disallowed. How the excess interest will be calculated? First, we should find out what is the total interest exceeding 30% of EBITDA, then compare that amount with the AE interest, whichever is lower. Or in other words, we can say that AE interest as well as non-AE interest should exceed 30% of EBITDA. Out of that excess amount, AE interest will be disallowed. And this disallowed amount is not a permanent disallowance, it is a temporary disallowance. Once it is disallowed, this disallowed amount can be carried over to the next year. Just like carry forward of loss. It can be carried forward to next year. So suppose in the current year, if 2 crore is disallowed, that 2 crore can be carried forward to next year. And in the next year, if your total interest does not exceed 30% of EBITDA, say next year, your total EBITDA is 100 crore, 30% of EBITDA is 30 crore. But next year, your total interest is only 28 crore. So not reaching the limit of 30% of EBITDA, there is a gap. To that gap, you can set off this carryover interest in the next year against the PGBP income. So disallowed amount can be deducted next year along with the next year's interest up to maximum of 30% of EBITDA. So in the next year also, if you have disallowance under 94B, again it should be carried forward. No other way. So next year should not be disallowance and your total interest does not reach 30% of EBITDA. There is a gap is available. So to that extent, you can set off this carryover interest. Maximum 8 years you can carry over. Within 8 years, you cannot absorb this interest. It will lapse. So this is section 94B provision. And what is EBITDA? Earnings, that is profit, before claiming interest, before claiming tax, before claiming depreciation. Depreciation includes additional depreciation also. And before claiming amortization. Amortization, we can say that under PGBP there are certain amortizations. So one such amortization, we can say that section 35D is an amortization, 35D amortization of preliminary, and section 35DD amortization of amalgamation or expenditure, 35DDA amortization of VRS compensation paid, and 35ABA amortization of telecommunication license fees paid, 35ABB spectrum license fees paid. So these are the amortizations. So amortization. So if the P&L account debit with the 35D, DD, DDA, 35AB and ABB, it should be add back. Depreciation debited to P&L, add back. Tax, add back. Interest, total interest, whether AE or non-AE, full interest add back to the net profit. We will get EBITDA. So once we got the EBITDA, then find out the percentage, that is 30% of EBITDA. So if the interest exceeds 30% of EBITDA, out of that excess interest, compare with the AE interest, whichever is lower should be disallowed. This is 94B, limit of interest reduction. So this is a very important provision. Sometimes they may ask a problem, or if it in MCQ, see these limits. Okay, total interest should exceed 1 crore in this particular limit. So then only disallowance is applicable. And remember, these things carry forward. So maximum 8 years you can carry forward, and you can set off to the extent of the next year's interest is fall short of 30% of EBITDA. To that deficiency you can adjust. Balance again carry forward. Maximum 8 years, and it can set off only with the PGBP. Remember, next year's interest, this can set off only with the PGBP, right? Any other business also possible. It cannot set off with any other heads. And now we can finish the balance questions in TP. So first we will take question number 10. Paras Limited is an Indian company engaged in the manufacture of supreme quality mink blankets. It has total borrowings of rupees 60 crore by way of loan as on 31st March 25. Saksham Limited of Germany imported 5 lakh blankets from Paras Limited for the resale in Germany at rupees 2000 per unit. Paras Limited sold similar blankets to other dealers in Germany at rupees 2100 per unit. So we have to find out arm's length the price, and we have to find out the primary adjustment, and we have to see whether it is more than 1 crore, whether secondary adjustment is applicable, then how the secondary adjustment will be done. All these are included in one question. So 2100 is the unrelated party's price. So related party 2000. Paras Limited received a bank guarantee on 1/4/2024 for availing a cash credit limit of rupees 9 crore, for which Saksham Limited was the guarantor. How Paras Limited and German company become AE? So we have to check this. Total borrowings of the company, Indian company, is 60 crore, right? So 10% of 60 crore is 6 crore. They are giving guarantee for at least 9 crore. That is more than 10% of total borrowings. The other company is giving guarantee. One of the situations under section 92A, deemed to be associate enterprise, any one of the transaction carried out. One of that case is here. So they are AE. Okay, that is AE point only. First one is goods transaction. That is for finding out the ALP. Second one is how they are become AE. The terms of trade for other dealers was to make payment within 1 month from the date of sale of goods by Paras Limited, whereas for Saksham Limited, the credit period allowed was 3 months for the date of sale of goods. So only in one case there is a payment within 1 month, and another case there is a credit period is allowed. The cost of capital was 12% per annum, and the supply of goods is assumed to be uniform throughout the year. So the major difference is this particular cost of credit is the material difference we have to adjust. We can apply comparable uncontrolled price method. We have to adjust this material difference. We will get the arm's length price. You are required to determine whether Paras Limited and Saksham Limited are associate enterprise. Yes, that we already discussed. They are associate enterprise because Paras Limited got the guarantee from the German company to the extent of more than 10% of their total borrowings. So they are AE. If yes, compute the arm's length price of the transaction between them, and the amount to be added to the income of Paras Limited, if any, by way of an ALP adjustment. That is speaks about TP adjustment variation. Definitely there will be a TP variation. We have to find out that. Then we have to check whether that amount is more than 1 crore. Then only we can answer this next part. Assuming that the above adjustments to the transfer price have been made suo motu by Paras Limited in its return of income. What is the time limit for the repatriation of such excess money? Okay, if it is suo motu made by Paras Limited, the time limit is allowed is within 90 days from the due date for filing ITR. 30th November plus 90 days. Okay, next question. What are the implications if the excess money is not repatriated within such a prescribed time limit? So we have to tell all the implications. So if they did not repatriate, it will be treated as a deemed loan and interest will be calculated. Depends upon whether the international transaction is denominated in Indian currency or foreign currency. We have to take SBI rate plus 3.25% or the Libor rate plus 3% that we have to take. Depends upon the how the transaction is denominated. And again, we can say the other option, they can pay additional tax at the rate of 18 plus 12 plus 4, so that the provision will be concluded. Okay. So that we have to find out. So first we have to find out the arm's length price. So the related party, that is in this case 60 crore, okay, German company number 5 lakh blankets from Paras Limited for the resale in Germany at 2000, that is a TP. The unrelated party price is 2100 per unit. So first we should find out the unrelated party. So first we should say that AE condition we have to put it. So here it is at least 15% of the total borrowing, 9 crore out of 60 crore. So they are AE, that we should mention. And then computation of arm's length price of transaction within Paras Limited and Section Limited. Selling price of each blanket to unrelated parties in Germany 2100. Then there is only one material difference is there, that is adjustment of cost of credit. Paras Limited provides credit for 1 month to unrelated entity, whereas it provided credit period of 3 months to Section Limited. Therefore, adjustment for the cost of such a credit to be carried out to arrive at arm's length price. So 12% into 2100 into 2 by 12. Therefore, 2 months is the additional, right? 3 months and 1 month. So that should be added. So we got the arm's length price of 1 unit of blanket 2142. But what we are charging is only 2000. So there is a variation of 7 crore 10 lakhs. 7 crore 10 lakhs is the transfer pricing variation which has to be done. So 7 crore 10 lakhs means it is more than rupees 1 crore. If the primary adjustment is more than rupees 1 crore, secondary adjustment is applicable. This rupees 7 crore 10 lakh should be repatriated within November 30 plus 90 days. November 30 plus 90 days means you have to count that date. December 31, January 31, so 62, and February 28. So within February 28, they have to repatriate 7 crore 10 lakhs into India. In addition to TP adjustment and paying tax, further I have to repatriate this money. So if this money is not repatriated within 28th December to, so 28th February 2026, then it will be deemed as a loan given by Indian entity to the AE and deemed as a loan, and interest will be calculated. As this in this case the transaction is denominated at Indian rupee, we can say that SBI lending rate as on 1/4/2025 plus 3.25. Remember 1/4/2025 because we are calculating interest for the period of 24, not for 24-25, in 25-26 because due date is in 2025 November 30. So 90 days period expired on 28th February 2026. So the financial year for which we are calculating interest is 25-26. Interest should be calculated from 1st December onwards, not from 29th February or not from 1st March. Interest should be calculated from the due date for filing ITR. That specified date we have to calculate the interest. So that is 1st April 2025 onwards we have to calculate the interest. And the rate will be 1/4/2025. What is the marginal cost of fund lending rate of SBI plus 3.25. And it will continue till the money is repatriated. But usually we are computing income year wise. So for the previous year 25-26, interest will be calculated from 1st December to 31st March 2026. Then still not repatriated next year 26-27. The entire year we will again calculate the interest for this money, but at that time the rate will be taken on 1st April 2026. What is the SBI lending rate plus 3.25. Likewise it will continue till the repatriation. But to escape from and to close the case, last resort, pay additional tax. So additional tax will be for this 7 crore 10 lakhs rupees into primary adjusted amount 7 crore 10 lakhs into 20.9664%. They can pay additional tax. Once they paid additional tax, the entire adjustments will be deemed to be concluded. And further, there will be no treatment, and further will be no deemed loan and interest approach. It's closed. So I don't remember, this is an old RTP question, but that question contains all the aspects. That's why I selected that question. So this is a provision on secondary adjustment. Next question, 11th question, that is on 94B, limitation of interest. So we are going to solve that question. 11th question. And the next two, three questions are actually based on, that is double taxation avoidance agreement. Okay. See question number 11. Yeah. So on 23rd June 2024, R Limited, 23rd June 2024 means our current year, 24-25, an Indian company borrowed 100 crore rupees, 100 crore from MPT Limited, a company incorporated in Singapore. Okay, borrowed 100 crore. The said loan is repayable over a period of 6 years. This loan is guaranteed by L Limited, a company incorporated in USA. L Limited holds 30% shares in R Limited. Okay, so here the party in Singapore is unrelated party actually. MPT Limited is an unrelated party that is located in Singapore. From that MPT Limited, this Indian entity borrowed a loan of 100 crore. So there will be no AE, but the problem is, yeah, it is the set loan is repayable 5-6. This loan is guaranteed by L Limited, a company incorporated in USA. L Limited USA and R Limited are AE because 30% shares are held by L Limited in R Limited. So for the purpose of section 94B, M Singapore and R Limited are deemed to be associated enterprise. First we have to write that how they become AE, because directly they are not AE. So we studied the provision how they become AE. So that equal amount is deposited or guarantee is given. That is a condition. Equal amount is deposited or guaranteed. Not an AE, lender is not an AE, but lender have been guaranteed by AE of assessee, in this case L Limited, or lender should have been received deposit matching. Here guarantee provided. So that is why it is AE. Otherwise they are not AE, right? Now what? The position of the Indian company R Limited, 23, 24 and 24, 25, 2 years details is given. So we need the current year data, that is 24, 25, that is our current year. So employee benefit expense, interest paid to MPT Limited, 238, depreciation, income tax, profit transferred to reserve. And gross profit, 1,630. Calculate the income under the head profits and gains from business and profession of R Limited for assessment year 2025-26, assuming gross profit is calculated as per the provisions of income tax. Gross profit is calculated as per the provisions of income tax, not the profit transfer to reserve. Gross profit is calculated as per. That word is very important, right? Gross profit is calculated as per the provisions of income tax, and depreciation is also as per income tax rules. Give appropriate reasons of your workings. Assume none of the companies are engaged in the business of banking. So first you have to start from here, that is 1,630, that is the net profit or GP computed as per the provisions of the income tax, 1,630. So after this 1,630, they debited employee benefit expenses, interest paid to M, depreciation, income tax and profit transfer to reserve. So we need the EBITDA, means earnings before interest, tax, depreciation, amortization. So in this 1,630, they don't debited these things. If we are taking the net profit here we have to have 1,550, right? Yeah, not this. So this 1,550 is gross profit before debiting this. So if we are taking this 525, we have to add back all these things. So if we are to taking the gross profit, we have to reduce only the employee benefit, we have to reduce, so that we will get the profit, EBITDA, we will receive directly the EBITDA, that is employee benefits we have to reduce, that is 301. So we will get the EBITDA. Or you can do like this, if you take in the net profit 525, if you are taking, then add to the 525, add income tax 232, depreciation 254, interest 238. That also, we will get the EBITDA. So what is the EBITDA? 1249. Here also same, right? So two ways you can do. Depends upon which profit you are taking, whether you are taking net profit or whether you are taking gross profit. Okay. So this is EBITDA. So EBITDA into 30%. So what is EBITDA into 30%? 374.57. Yeah, this is 30% of EBITDA. So whether the interest exceeds this 30% of EBITDA. So interest is 238. So interest paid to MLIM PT Limited for the current year 24-25, this 238 does not exceed 30% of EBITDA, because only the total interest is 238. It is less than this 238, total interest is less than 30% of EBITDA. That means 24-25 there is no disallowance. But the problem is they are giving the details of 23-24. That means at that time you should remember, okay, then we have to check whether 2023-24 there is a disallowance. If there is a disallowance in 23-24, that can carry forward and current year we can set off. So go back to 23-24. So 23-24, 1,650 is the gross profit, 1,650. So reduce employee expenses, that is 280, right? So what is the EBITDA in last year? 1350. 1630. Yeah. 1630, right? Yeah. Okay. 1350 EBITDA in last year. Okay. Into 30%. How much? 405. So last year it is 589, which exceeds 30% of EBITDA. How much is excess? 184. 184 or 589, whichever is lower, to be disallowed under section 94B. So 184 is lower. Here there is no other interest, only A interest is there. If there is another interest, that would always be considered for 30% in exceeding EBITDA purpose. But here only A interest is there. So 184 or 589, whichever is lower. 194 to be disallowed. So first we should do the computation for previous year 23-24. Previous year 23-24, we can directly take the net profit. So the net profit is 240. Net profit is 240. Employee benefit is allowed under income tax. Out of interest, we are going to find out the disallowance. We are going to make the add back. Depreciation as per income tax allowed. Income tax is not allowed under IT Act. So add income tax. Income tax is not a business expense, 271. Remember, I am considering 240. So 271 add back. And then 94B disallowance. How much? 184. So what is the PGBP income for that year? 23-24. PGBP income for 23-24. 695. That will be PGB. And now remember one important point. This 184, even though add back, it can carry forward to next year. So this 184 will be carried forward to current year. So in current year, the EBITDA amount is 1249. 30% of EBITDA 374.7. Your total interest can be up to 374.7. But in the current year, it is only 238. So what is the difference? 136.7. So up to 136.7, this 184 carry forward in the last year, you can set off in the current year. So out of 184, 136.7 can be claimed in the current year. So in the current year, we have to take the net profit. So current year PGBP income 2425. What is the net profit of the company? That is 525. Out of that 525, add back IT. IT is not allowed as a business expense, 232. And there is no disallowance. And now we can claim deduction. Less 94B, shortfall of last year, we can set off in the current year, 136.7. This we have to reduce. Get the PGP income. So what is the current year PGP income? 620, 620.3. So this is the current year income. And one more thing you have to write, out of 184, 136.7 is set off in the current year, remaining again to be carried forward, 47.3. That should be carried forward to next year. So here some sort of a PGBP computation adjustments is also appearing. So they are asking total PGP income also. So this is an exam question they asked recently. So that area is over. So these are the main area you have to keep in mind in transfer pricing, especially 94B, 92C is secondary adjustment, 94B limitation of interest, 94A notified jurisdictional area, 92C is secondary adjustment, and usual area, that is computation of arm's length price under different methods. These are the core problem area for transfer pricing. And for theory area, that advanced pricing agreement is an important area for transfer pricing theory, advanced pricing agreement, and then documentation, maintenance, reporting, and penalties. These are the core theory area. So if they are asking a big problem, they won't ask a theory. If they are not asking problem, they will ask theory. See, in a particular situation, there is only interest to non-AE, no interest to AE. This section not at all applicable. No need to check this. Yeah, AE and non-AE is available. To both of them, we are paying interest. For the purpose of excess interest calculation, in excess of 30% of EBITDA, we have to consider both. Yeah. That is a provision says. For excess interest purpose, we have to calculate both. So total interest means AE interest, total interest means AE interest plus non-AE interest. If that exceeds 30% of EBITDA, that is amount 1. Now compared with the AE interest, whichever is lower. So the basic idea is only AE interest will be disallowed. Only AE interest will be disallowed. But if AE interest, how much AE interest to be disallowed? That depends upon total interest exceeding 30% of EBITDA. So if AE interest is 0, no disallowance, even though total interest exceeds 30% of EBITDA. Now, these are the core area in TP, right? So TP and not taxation. I think you got an idea. Now we are moving to double taxation relief or double taxation avoidance agreements. So how double taxation arise? Basically, to tax an income, there are two basic rules followed all over the world. Every country is following these two rules. One is residence rule and another one is source rule. Residence rule means it is immaterial from which country you earned the income. It is immaterial from where the source of income is coming. It is material in which country you are resident. So residence country has the right to tax all income earned by that person, irrespective of the country of source. That is known as residence rule of taxation. And what is source rule of taxation? Source rule of taxation says we are not worrying about in which country you are resident. If you earned income within our jurisdictional territory, source is in India or source is our country. So you have to pay tax here. So even though you are a non-resident, for Indian income, you have to tax in India because we are applying source rule of taxation for non-residents. And if you are resident, you are earning income from South Africa, you have to pay tax in India. At that time, we are applying residence rule. So simply speaking, for residents, taxing residents, India is following residence rule. And for taxing non-residents, we are using source rule. So India is using a combination of residence rule and source rule. So in those situations, for the same income, country of source applied a tax based on source taxation rule, and country of residence is different, and that country of residence taxed that income based on residence rule, there arise double taxation. So for the same income, for the same person taxed in two different countries, that is known as jurisdictional double taxation. In case of jurisdictional double taxation, we can claim double taxation relief. Act purposefully uses the word double taxation relief. Sometimes they will say double tax avoidance, but that is not real. They are not giving double taxation avoidance. They are giving some relief only. Anyway, income is taxable in both countries. In one country, the tax paid in the other country will be allowed as relief. So that is why it is known as relief. Very rare situation, exemption will be given. Only income will be taxed only in one country, and in the other country it will be completely exempted. In that case, actually double taxation avoidance happens. Rarely. Majority cases we are getting relief only. So total there are 3 sections incorporated in the income tax law: 90, 90A and 91. 90A is literally unimportant because that is specifically applicable to certain selected persons only to get the relief. So that is not relevant. So main is 90 and 91. So section 90, what it says? As per section 90, to promote mutual economic relationships and to promote mutual investment, trade, etc., central government has the power to enter into double taxation avoidance agreement with the different foreign countries or territories outside India as per Indian constitution. So by obtaining the power from Indian constitution, Income Tax Act created section 90. Under section 90 subsection 1, which says that central government has the power to levy double taxation avoidance agreement with the foreign country. What are the objectives? That is for DT relief, promote mutual economic relations, trade, investment, exchange of tax information, prevention of tax evasion or avoidance. These are the objectives for which DT agreement is entered into. So not only for the purpose of double taxation relief, there are a lot of other objectives for DT relief or double taxation avoidance agreement. That is promote mutual economic relations, trade, investment, prevention of tax evasion. All those are objectives of a DT agreement. And 90 subsection 2. See, by obtaining power from 90 subsection 1, almost more than 100 countries. India have double taxation avoidance agreement with more than 100 countries. Some DT agreements are very detailed agreements. Some are very limited agreements. So some are comprehensive agreements. So more than 100 countries India have DT agreements. Or by using this power, India is entered into. And now what section 90 subsection 2 says? 90 subsection 2 is very, very important for the purpose of this DT relief or for this chapter or for your practical knowledge also. Remember, 90 subsection 2 is very, very important. What this section says? This section says whenever a conflict arises between the provisions of taxation as per DTAA and the provisions of taxation as per the domestic law, that is in Indian perspective, Indian income tax law says a provision, but that provision is contradictory to the provision contained in DT agreement. Domestic law, Indian Income Tax Act says that 115A says if a non-resident getting royalty from India, it will be taxable at a flat rate of 20%. 115A. At the same time, if that non-resident's country and India entered into DT agreement, and that DT agreement article 11 or 12, which says that if the resident of that foreign country getting royalty from India, it should not be taxed more than 10% in source country or India. Conflict. Domestic law section 115A says it can be taxed at 20%. Same time DT agreement says no, it cannot be taxed more than 10% in your country. Conflict. So whenever there is a conflict, the beneficial provision to assessee will prevail. So which is beneficial for non-resident, to tax at 20% in India or to tax at 10%? To tax at 10%. So DT agreement will override income tax law. So this is the only provision based on which all the big fours are giving tax consultancy to MNCs. Because all MNCs are, you see, majority of the MNCs who are making large investment in India, they will put on a country where there will be a favorable DT agreement exist. So that is not treaty shopping like that. So this provision is very important. So even though Income Tax Act say 20% surcharges, we will tax you. So DTA agreement simply sitting and smiling. No, you will do nothing, man. Domestic law 115A say it will be taxable 20%. But DTA agreement says no, it will be taxed only in the residence country. It won't be taxed in source country. No tax at all. Mauritius, Singapore, to some extent Netherlands, Antilles, very favorable provision. So KPMG or ENY, they will say to the company, don't start your operation from US. Go settle your office or company in Mauritius or Netherlands, Antilles. Then route that activity to India and get the favorable advantage of DTA. So no need to pay tax in India. So any provision, whatever provision is saying in income tax law, everything will be overridden by DTA agreement if it is favorable. But some other conditions is there that non-resident has to prove that I am from this country. So he has to prove the residence by giving the tax residency certificate and other prescribed particulars. Then only he will get the advantage. But anyway, that is only procedural complaints. Definitely they will do that. So they will take the advantage. So this provision is very, very important. But in only one situation, this provision cannot be taken. That is when the GAR provisions are applicable. General Anti-Avoidance Rule. GAR provision. That is when a person is doing an impermissible tax avoidance arrangement in India, that is some fraud is carried out, not a tax planning, but a tax evasion according to Income Tax Department. They made the primary verification that declared the transaction carried out between that persons are impermissible tax avoidance arrangement. Then the provisions of GAR will apply, or the Income Tax Act Chapter 10A. Chapter 10A means GAR provision will apply. If GAR provisions are applicable, then you are a fraud person in the eyes of income tax law. Whatever beneficial provisions available, that will be taken away. And then at that time they are saying if GAR provisions are applicable, then DTA agreement will not come to rescue. Income tax provisions only will be applicable. Except in those cases, very rarely GAR is applicable, right? Because of this Vodafone case, they are putting GAR provisions into it. But there are numerous conditions to declare an assessee as a GAR under the GAR provision, or to declare the transaction impermissible tax avoidance arrangement. It's very difficult. So practically, I think even though inquiry is happening, it will not reach the final stage. Before that, it will drop. Again, it will give some bad message to the investors, right? So some multinational companies, they will be reluctant to invest in India, right? So the government will not go to that extent, but still provision is there. So 90 subsection 2 favorable provision not applicable if GAR applies on assessee. In all other cases, 90 subsection 2 is a biggest advantage, because whenever we are deducting TDS under section 195 for a payment made to non-resident, we must check this provision, whether that income is covered under DTAA, whether the rate as per DTA is lower than the normal rate, then we should apply that favorable rate. So we should deduct TDS only that lower rate. So if the DTA agreement says that it is not at all taxable in India, then no need to deduct TDS. So while giving the certificate by chartered accountant, we will say no, due to this provision it is not taxable in India. So tax residence certificate and all other details has been obtained. So TDS is not applicable. We can make the payment without TDS. So this is 92 and 2A. And now 90 subsection 3. Normally double taxation avoidance agreement is a detailed agreement containing around 30 or 31 articles. Depends upon whether it is OECD model DT agreement or whether it is a format of UN model. Depends upon that, article number will vary. But in every double taxation avoidance agreement, the keywords used in that agreement will definitely defined in the agreement. For example, royalty. What is the word meaning of royalty? We cannot take the general meaning. DT agreement uses royalty, it will define what is royalty. Dividend, it will be defined in the DT agreement. So what is a permanent establishment? DT agreement will define. So if a word used in the DT agreement is not defined in the DT agreement, then we can take the meaning as per the domestic law. So if there is no meaning in DT agreement and no meaning in domestic law, central government can give a definition to that word by mutual negotiation. With that country, they will discuss, see, there is a word used in our DT agreement, but that is not defined. Can we give an explanation to that meaning or that word? If both the countries agrees, they will arrive at a meaning and will be notified. But if any meaning is given in the DT agreement, then you cannot take income tax meaning or dictionary meaning or general clauses meaning or constitution meaning or Wikipedia meaning. You can't take that. If a word is used in DT agreement gives a definition, take only that definition. So by interpreting definition, a lot of assessors will get benefits. So terms in DTA not defined in Act or DTA, meaning can be given by central government through notification. And 90 subsection 4 says that to get DTA benefit, that is 90 subsection 2 benefit, to get that favorable position, TRC is mandatory, tax residency certificate is mandatory. But if TRC does not contain a lot of relevant information, then you have to give additional information in the form of Form 10FA should also be filed. So TRC plus additional information required by CBDT should be given, like name of that assessee, country of residence, TRC period, address in that country, equivalent to PAN in India, what is the tax identification number in that country, what is the constitution of the assessee, whether it is a company, firm or LLP, so email ID. So those type of details in that country should be given. So that is additional particulars. And these are the main sections of 90. 90 subsection 1, 2, 2A, 3, 4, 5. Simply speaking, 90 says regarding bilateral relief. Bilateral relief means if there is a DT agreement, there is two party, India and a foreign country. So residents in India or residents in that other country, both will get the benefit through DT agreement. That is why it is known as bilateral relief. Residents of both countries, that means residents of both the states. Both the states means contracting state and other state. That means the signatories of that agreement. So India and Mauritius, if there is an agreement, India, for an Indian resident, India is contracting state and Mauritius is other state. If the other person is resident in Mauritius, then Mauritius is his contracting state, India is other state. So likewise, in both states, persons will get the benefit. That is why it is known as bilateral relief. But if there is no double taxation avoidance agreement, for double taxation relief will be available only to Indian residents. That is section 91. 91 says where there is no DTA agreement, but you are an Indian resident, paid tax in a foreign country, and that income is taxed in India also because you are resident. No need to worry about that. Go to section 91, claim relief. So if there is no DTA agreement, non-residents won't get benefit. Only residents will get benefit. That is through 91. That is when 91 is known as unilateral relief, but 90 is known as bilateral relief. And now some explanations given under section 90. First is taxing a foreign company at a rate higher than domestic company shall not be treated as a less favorable tax treatment. So to understand better this provision, I will explain another thing. Every double taxation avoidance agreement contains a particular article known as non-discrimination article. In that non-discrimination article, which says that while taxing a resident along with a non-resident, if both are doing the same activity and the same category, there should not be a discrimination in taxing that two assessees. That is, Indian company, they are allowing an expense, foreign company not allowing an expense. Indian company taxing at 25%, foreign company taxing at 35% or 40%. So now it is 35%. So such a type of discrimination should not be made. That is, non-discrimination article says. The problem is, see, under the tax law, always the rate of tax for a foreign company is usually high compared to domestic company. Domestic company, the rate of tax is 15%, or some case 22%, and some case 25%, and some case 30%. Total 4 rates is there: 15, 22, 25, 30. But for foreign company, the rate of tax is 35. Some incomes are taxable at flat rate 20, 115A, or some may be 5 or 4 or 9. But normal rate of tax is 35. So if we see 35 is more than 25, so definitely this non-discrimination article will apply. So central government cannot collect 35% tax on foreign company. This will be a big problem. So they already put a provision in advance under 90 stating that, see, 35% is equal to 25. 35 is equal to 30. 35 is equal to 15. To that extent, please don't cry. 35 is equal to 25. Mathematically, it won't work, right? 35 is not equal to 25. They are putting a provision. So we cannot apply non-discrimination article to the extent of taxing a foreign company at a rate higher than Indian company. So that will be equal to domestic company tax. That's the idea. See, earlier, if you analyze the income tax law, the tax rate of a foreign company is not higher. Domestic company, earlier their tax rate is 30. Domestic company's rate of surcharge is higher, 7% or 12%. Domestic company has to pay buyback tax. Domestic company has to pay dividend distribution tax. I'm saying the old position, not the now new position. Now there is no DDT. Now there is no BBT, right? Buyback tax. So earlier, all these taxes are applicable only for domestic company. If you apply all these tax, the rate of tax will go above 40. So we can say that actually the foreign company's rate of tax, if you consider the collectively all the taxes together, including surcharge, the rate of tax of a foreign company is not high. Just comparing the basic rate of tax without considering additional taxes, then it's correct. Foreign company's rate of tax is high. But anyway, they put an advance provision. So taxing a foreign company at a rate higher than domestic company shall not be treated as less favorable tax treatment. So remember, to this extent, article of non-discrimination article cannot apply, because what section 92 says, provisions in DTAA and Act, whichever is more favorable should be applied. DTA agreement say should not make non-discrimination. Okay, don't make discrimination, right? But here it says 45% or 40%, 35% is equal to 25%. So to that extent, it's actually a discrimination. So if we apply DTA agreement, central government cannot tax foreign companies at 35%. That is why they put this clause. So now it's clear. Rate of tax higher than domestic tax should not be treated as less favorable treatment for that foreign company. Second one, there are certain specific territories outside India notified by central government for the purpose of entering into DTA agreement. Usually, central government can enter into DTA agreement with a country outside India. But there are a lot of other areas which is not a country. International community not accepted it as a country. Some territories, Hong Kong, Bermuda Islands, Netherlands Antilles. So those are the examples of some territories. But with that territory also, central government has the power to enter into DTA agreement. That is explanation 2 says. Explanation 3 of section 90 says that notification issued under section 90 subsection 3 deemed to be valid from the date of DTA agreement. Original DTA agreement drafted in 1995. At that time, there is used the word royalty. The word royalty used in DTA agreement has not been defined in 1995. Not in the agreement. There is no definition in the agreement. 2005, central government allotted a meaning through notification for the word royalty in that agreement. 2005. Even though this explanation is coming or notification put on 2005 only, but it will be deemed to be valid from 1995. That is the original year in which, original date on which DTA agreement came into effect. So all the meaning, even though later on assigned, it will have a retrospective effect. So accordingly, if a person wrongly availed any benefit, you have to pay tax. So that's the impact. So notification issued under section 93 deemed to be valid from the date of DTA. And terms defined in DTA, you must take the meaning as per DTA. Not defined in DTA, then meaning as per Act plus notification. If there is notification is given, notification meaning. If no notification but meaning is defined under the domestic law, income tax law, no notification is prescribed and no definition available in DTA agreement, but word is used in DTA agreement, no definition is explained, then take the meaning as per Domestic Act. Domestic Act means Income Tax Act. So these are the major structure of the provision 90 and explanation. And now how the double taxation relief is given as per section 90. Through 90, how the double taxation relief is given. So through section 90, double taxation relief can be given in basically through two methods. One is exemption method and another one is tax credit method. Exemption method is the best, but only few agreements contains exemption method. Majority of the India's DTA agreement contains tax credit method. So exemption, there are two types of exemption. One is full exemption method. Full exemption method means income will be taxable in residence country. It will be exempted in fully exempted in source country, or sometimes ulta. It will be taxed in source country. It will be completely exempted in residence country. So that is full exemption method. So if there is full exemption method, assessee will completely get double taxation avoidance. But very few agreements contain full exemption method. Only with developed countries, DTA agreements contains full exemption method. India is a developing country, so India is not promoting full exemption method. India is promoting tax credit method, so that both country will get some benefit. And there is another method, exemption with the progression. Exemption with the progression means income earned in source country is taxable in source country. Income earned in source country is taxed in source country, but in the residence country, that income can be included only for the purpose of tax rate purpose, or for the purpose of computing the tax rate, it will be included. It won't be taxable. For example, India is residence country. There is another country, country X, source country. So a person got an income of 5 lakhs from that source country. As per the agreement between India and that country X agreement, which says that income will be taxable in country X. That 5 lakhs will be taxable in country X. But in India, that 5 lakh can be considered for rate of tax purpose. That means, in this example, his foreign income 5 lakhs. What is his Indian income? You have to compute the total income of that person in India. Salary, house, property, PGP, capital gain, IFOs, clubbing, set off, GTI, chapter 6A, total income, find out the total income. Say total income in India is 10 lakhs. Okay, fine. Now, along with this 10 lakhs, that 5 lakhs will be added. So 15 lakhs. On this 15 lakhs, compute the tax. Slab rate tax, normal tax, including cess. Find out the tax. So we will get a tax. That tax divided by 15 lakhs into 100. So what we will get? A percentage of tax, rate of tax, considering this 5 lakhs. And now this rate or this percentage should be applied on 10 lakhs. That is his tax liability. So actually, if we are not considering 5 lakhs and only 10 lakhs we are taking, the rate of tax will be low. Tax amount will be low. But here, by doing the progression, the rate of tax will be more. So you have to pay some tax in addition to the normal tax. So that's the idea. This is not an exemption with the progression. Only one time they asked this question for CA final. Recently they are asking tax credit method or exemption method in a combination manner, right? Even tax credit and 91 they are asking simultaneously. So they are not asking this area. But once they asked this exemption with the progression. So remember, exemption with the progression means that foreign income will be added to total income only for finding out the rate of tax, and that rate of tax will be applied only on Indian income. Foreign income is not taxing here, but for rate of tax purpose it is considering. That's the meaning. The most popular method is tax credit method, which is mentioned in Article 23B of the DTAA agreement, which says income taxable in both the country. Income earned in source country and income earned in residence country. That income will be taxed in residence country, right? So in both country it will be taxable, but tax paid in source country will be allowed as credit in residence country. That will not change, because always the first event of taxation, the point of time, first event is happened source, taxation in source country, because source country will deduct TDS. Residence country taxation happens only in assessment year. So the second event happens in residence country. So always first you have to pay tax in source country, and then that tax will be allowed as credit in residence country. Now this is the method of tax credit method. Either for tax credit method or for next section 91, we must follow foreign tax credit rule. That is rule 128 of income tax rules. That we will study. Only after studying that we can solve the problems. So what is section 91? Okay. This is what we discussed is bilateral relief, double taxation relief through agreements. So if there is no agreement, DT agreement, how the relief will be given? So that is 91. Countries with which India has no double taxation avoidance agreement. Remember, this benefit available only to residents. That is why it is known as unilateral relief. This benefit cannot be taken by a non-resident. So only Indian residents earning income from a foreign country, and with that country India has no DTAA, that foreign country tax that income by applying the source principle. Here he is resident, India applied the global rule and tax that in India also, double taxation arises. No need to worry about that as there is no agreement. Come to section 91. If the condition satisfied, claim relief. This is absolutely tax credit method. 91 is absolutely tax credit method. So both are actually same. So section 91 says assessee must be a resident and he income must have accrued and arisen outside India. Remember, an income accrued in India and received in a foreign country, because of first receipt happened there, that country taxed. You won't get relief. Because who told you to receive that income in a foreign country? This income is accrued in India, right? Then you should receive here also. That is Indian income. So why you received in foreign country? That is why that country is taxed. You are not eligible for relief. So income must have accrued or arisen outside India. So accrued and receipt outside India. Such income not deemed to accrue or arise in India. India has no DT agreement. Tax must have been paid in that country. See, if that income is exempted, similar to section 10 of the income tax law, in the foreign country, there is a section 10, similar to section 10. So that income is exempted in that country. But in India, it is taxed. There is no double taxation. You won't get the relief. To get the relief, income should be doubly taxed. So doubly taxed means it is taxed in India and foreign country. So tax must have been paid in that country by TDS or maybe direct payment there, or they deducted TDS, whatever may be. But tax should be paid there. So how the relief will be computed? That is Indian rate of tax on that foreign income, or foreign rate of tax, or tax paid on that foreign income in the foreign country, whichever is lower. So what is tax payable for such income in India, or what is the actual tax paid in that foreign country, whichever is lower, you can be claimed as a relief. Or in other words, Indian rate or foreign rate applied on doubly tax income, so that we can claim it as a relief. This is section 91 if there is no double taxation avoidance agreement. So this relief available only for residents. Remember, that's very important. This is available only to residents. Non-residents, this relief is not available. And foreign tax credit rule 128. So to get the relief for a tax paid in a foreign country, either under section 90 through agreement foreign tax credit method or through 91 credit, in both cases, remember, the tax must be covered in DTA agreement if there is a DTA agreement exists. So if there is no DTA agreement, that tax paid in foreign country should be equivalent income tax in India. So if you paid GST in foreign country, you cannot claim credit here. So equivalent to Indian income tax, what is the tax there? Only those taxes are eligible. If there is a double taxation avoidance agreement, there is a problem. We cannot say like that. For a DTA agreement, what are the taxes covered in that DTA agreement will be mentioned in the article, which says, okay, in India, income tax means the income tax, surcharge, cess, they will say. For Australia, taxes here means the taxes in Australia, they will make the list. So taxes mentioned in DTA agreement only will be eligible for relief. So if a tax, even though it is in the nature of an income tax, but it is not mentioned in the DTA agreement, you won't get the relief. For example, in United States, income tax is collected by both the federal government and states. Both are collecting income tax. But DTA agreement is signed between India and US federal government, or we can say Trump government. So Trump government has the authority to give credit only in respect of federal tax. They cannot give credit for state tax. So India-US DTA agreement says, for the purpose of USA, income tax means federal tax. They are not mentioning state tax. But actually a person paying, for example, 100 rupees you are paying income tax in US means 50 will be taken by federal government and 50 rupees will be taken by state government, just like GST in India. They are levying income tax. So in that situation, India-US DTA agreement says only federal tax. You won't get relief for state tax even though it is income tax. So that is why in case of a DTA agreement exists, only the covered taxes in DTA agreement eligible for relief under section 128 or foreign tax credit. If no DTA, tax equal to income tax. So the tax in foreign country, either you can pay in direct payment or TDS in such country, both will be accepted. And when the foreign tax credit will be available in India, in which year the tax paid in foreign country will be allowed in credit in India? See, you are paying a foreign tax on a particular foreign income. Okay, that foreign income, when it is chargeable to tax in India, in which year that income is offered to tax in India, only in that year you can claim a credit in India. So if the foreign income is 10 lakhs and you paid a tax of 1 lakh on that 10 lakhs, that is 10% tax you paid, but that 10 lakhs, when it is come to India, it is taxed in 2 different years. 5 lakhs in current year and 5 lakhs in next year, or 5 lakhs in last year and 5 lakhs in current year, only in India it is taxing. In that situation, that tax should also be splitted. Only 50,000 this year and 50,000 last year. Because income is offered tax in more than 1 year. So credit should also be apportioned. This will happen when there is a difference in accounting year, right? India is following April to March. There may be January to December. In that situation, there will be mismatch. So proportionate income. In our financial year, how much income is taking? Proportional tax only will be allowed. If both are same year, this issue does not arise. So year of availability of FTC, years in which such a foreign income offered to tax or assessed to tax in India. And a foreign tax credit can be adjusted against tax, surcharge, cess, or even minimum alternate tax or AMD. That means foreign tax cannot be adjusted against tax, against interest on tax in India, penalty on tax in India, or late fees or something like that. Only tax can be adjusted against tax, but there is no one-to-one relation. There may be cess, here may be income tax. That cess can be used for income tax. That's not a problem. One-to-one correlation not required, but it cannot be utilized for payment of interest, fee or penalty, or credit is not available against interest, fee, penalty. If there is a foreign tax under dispute, you cannot claim now. Only after the dispute is settled and you provide the proof of that settlement, then only you can take credit. Up to that time, you have to defer. And mode of credit. So this is the main area we have to keep in mind in problem. So aggregate of foreign tax credit computed separately for each source of income from a country. So country separate we have to. If you have three different foreign tax credit and all these three are taxed in India, then credit should be computed separately. So country 1 credit, country 2, country 3. So how that will be compared? Tax payable on such income under the Income Tax Act. So what is the rate of tax for such a foreign income in India? Or foreign tax paid on such income. What is actual tax paid on such a foreign income outside India? So whichever is lower must be taken. So foreign tax will be paid in dollar or pound, etc. So that should be converted into INR. For that we have to use telegraphic transfer buying rate. As on the last day of the month preceding the month in which tax is paid or TDS is deducted. So if the tax is deducted in March in the foreign country, you have to consider 28th February what is the telegraphic transfer rate. Similarly, if the tax is paid there in January, we have to consider December 31st. So foreign tax will be paid in foreign currency. So definitely we have to convert into INR. So for that purpose, they are saying we have to take the exchange rate as on the last day of the preceding month in which tax is paid or deducted. Because if the foreign tax paid is not given in percentage, if the foreign tax is paid in foreign currency, then we have to use this calculation because we have to convert that foreign tax paid in foreign currency into INR. For that, we have to use this telegraphic transfer buying rate of SBI as on the last day of the preceding month in which tax paid or deducted. And further procedural complaints, you have to submit the, in case of TDS certificate and tax payment CHELAT, all those details and declaration should be given, then only we can claim relief. Specific form is there. If you are practically filing, you can know that form 67 should be filed, then only we will get the relief. But anyway, for computation purpose, remember what is the rate of tax or tax payable, actual tax payable on such a doubly tax income in India, or what is actual tax paid in that foreign country, whichever is lower should be taken. But if everything is given in percentage, then compare with the percentage. Rate of tax for such a foreign income in India or rate of tax in such a foreign country, whichever is lower, applied on doubly tax income, we will get the relief. So both way they are asking, but recent trend of the institute, figures, everything is given in foreign currency. So practice such a type of questions. If everything is given in Indian rupees, very easy. Proper application of FTC, that is everything will be given. Even foreign income will be given in dollar. Foreign tax actual paid, it will be given in the dollar because that is pakka practical. So there won't be a practical situation where tax paid in foreign country in INR. Only for academic purpose, such questions are given in the material. When it is come to practicals, everything in foreign currency, right? Because it's foreign country, they won't accept Indian rupee. And these are the main point you have to keep in foreign tax credits rule. And now we are going to find out how the relief will be calculated. Okay, we can go to the question. So first we are taking question number 12. Question number 12. So I am giving only 2 questions. All those 2 questions are containing everything in foreign currency, right? If you need simple questions, INR, go through your study material, right? Study material, all the questions are in INR. Very easy. But in exam, they will ask this like this type of pattern, right? And student will prepare study material and will expect for such type of problem. Yeah, they will give foreign currency. At least they can give one illustration, right? They won't do that. So Mahesh, age 50, is the CEO of Silver India Limited. So naturally we can assume it is an Indian company, Silver India Limited, obviously Indian company. So he is a CEO in India. Okay, so his status will be resident, definitely resident because he is a CEO. So all the time he should be here, he will be resident. 1/4 since 1/4/2020. So it's very clear. 1/4/2020. So he will be a resident and ordinarily resident. All the conditions will be satisfied. From 2020 onwards, he is in India. His income in India consists of salary before standard deduction. So we have to reduce the standard deduction. See the last paragraph. Assume Mahesh pays tax under 115 BAC default tax regime. So we have to reduce standard deduction up to 75,000 rupees. 75,000 default. So 22 lakh, 25,000 rupees will be his salary income. Interest in respect of self-occupied property, not available. Why? Because default tax regime people won't get self-occupied. They won't get self-occupied. So self-occupied we cannot take because default tax regime. One more issue in house property regarding default tax regime you should keep in mind. They cannot claim loss from left-out property under default. If they have loss and if they have positive income from another property, they can set off. But remaining loss, they have to lapse. They cannot carry forward or set off with other bets. Self-occupied not at all available. So that we can leave, not available. Now, interest on bank fixed deposit. Bank FD, that is income from other source. He won't get any chapter 6 reduction. First of all, FD chapter 6 is available only for senior citizen. And default tax regime, that is not available. Chapter 6 is not available. So chapter 6 is not available. IFO is 160. He has the following income for the year under 31st March 2025 in country A. It's a foreign country. Income from business in country A, US dollar 25,000. Rent from house property in country A, US dollar 4,500. Municipal tax in respect of the above house. This municipal tax not allowed in that country, but we know in India, municipal tax, we can claim it as a reduction. US dollar 450. Dividend from shares held in country A, where dividend are declared and paid in March 2025, USD 10,000 IFOS. Short-term capital gain on USD 5,000 on sale of shares of companies registered in country A, and sale proceeds were credited in bank account outside India on 28th March 2025. So that is short-term capital gain. It will be taxable at a normal rate of tax because it is short-term capital gain, normal income, slab rate. It is not an Indian listed share or something like that. Foreign company share transferred, and he is a resident, so taxable in India, normal income. So we have to convert foreign income into INR, right? So for that we have to apply the exchange rate, right? So how we will apply the exchange rate? So this you should be keep in mind. So if it is a salary income you are getting from a foreign country, we have to apply telegraphic transfer buying rate of SBI as on the last day of the month preceding the month in which salary due or paid in advance or arrears. So in which month you are getting salary due or credit receipt? Preceding month, last day, telegraph transfer buying rate. In this question, there is no foreign salary, only Indian salary, right? So no problem, no foreign salary. Capital gain. In this question, there is capital gain, foreign capital gain. Capital gain, same, but small difference. That is, they are saying transfer takes place in which year, which month? Preceding month, the last day. Last day of the preceding month in which capital asset is transferred. And then interest on securities, that is also in which month the income is due, preceding month, the last day. Dividend, last day of the month preceding the month in which declared or distributed or paid. So in this question, I think foreign dividend is there, foreign capital gain is there. Next, PGBP, last day of the previous year. And HP, house property also, last day of the previous year. All other income other than dividend and interest on securities in IFOS, last day of the previous year. What is it? TTBR, that should be taken. So in this question, that is required. Because here the income given, some income is in foreign country given in foreign currency. Okay. So short-term capital gain should be converted by using preceding, the exchange rate is given in the last part, right? So first step, so what is our question we didn't complete? Okay, India has DTAA agreement with the country A. So which section? 90. See, whether 90 or 91, remember, foreign tax calculation is as per rule 128 of FTC rules or income tax rule 128. No change. But we have to, while claiming the relief, we have to put the section number. This relief is from regarding country A, section 90 relief, because DTA agreement is there. And they are clearly saying the provision, and the tax paid in country A in this case is source country because he is a resident in India. So that is source country, this is residence country. Tax paid in country A is eligible for tax credit in India. The fiscal year, tax year for income tax is the same both in India and country A, so there is no confusion in that. Rate of tax is 20% in country A in respect of all income. He is getting house property income, he is getting dividend income, he is getting capital gain. 3 income he is getting from foreign company. All these 3 income will be taxed at 20%. They are not saying regarding any expenses possible in that country. That means for all these income, gross basis, he is paying 20% tax. Rent into 20%, dividend into 20%. Short-term capital gain into 20%. That is actual tax paid there. You will get in dollar. That should be converted into INR. That is tax payable in foreign country in equivalent INR. So first we should calculate tax in foreign currency. Simply we can calculate the tax in foreign currency. Rent 4,500 plus. Remember, municipal tax paid in that country not allowed for that country's tax. So 4,500 plus. Dividend 10,000 plus. Short-term capital gain 5,000. So what is the total? 4,500. And again there is another income from business also there, right? 25,000. So 25,000 plus 4,500 plus 10,000 plus 5,000. What is the total? 44,500. So here the tax payable in foreign country will be 44,500, correct? So 44,500 into 20% into 20%. He is paying tax for all income 20%. So we will get tax paid in foreign country in USD. How much? 8,900 US dollar, right? This 8,900 US dollar tax paid in foreign country, how it will be converted into INR? By using, when he paid a tax, given in the question, income tax paid by Mahesh on 25/5/2025. So which date we should consider? 25th May, right? So 30th April. So 30th April, what is exchange rate given in the question? 72 into rupees 72. For relief purpose, we need this. So what is the tax paid in foreign country? Equivalent Indian rupee, how much? 6 lakh. 48. Okay. Now what? For the given income tax paid, okay. Compute the total income and net tax liability of Mahesh. Assume Mahesh pays tax under 115 BSE. Okay. So we are calculating, starting the computation. So first step, compute the income in India. Okay. So we are going to compute the income in India. Salary, 23 lakh minus 75,000. How much? What is the figure? 22 lakh. 25,000 salary. Okay. Now we are going to compute the house property. Always try to keep the order. Salary, HP, PGBP, capital gain, IFOs. For exam, they are looking into that order, right? Try to keep that order. First is salary, 22 lakh 25,000. And second, HP. We are doing HP. So rent from house property in country US dollar 4,500. Regarding house property income in foreign country, to convert that, we have to use the exchange rate as on the last day of the previous year. Last day of the previous year is 31st March 2025. Rupees 71. So rent from house property 4,500 into rupees 71. That is the GAV. That is a GAV, gross annual value, because they are not giving fair rent, not giving standard rent. So this is the GAV, gross annual value, actual rent in Indian rupee. So $4,500 into rupees 71. That you have to put GAV less municipal tax paid. They are saying municipal tax paid is not allowed in that country. So what? As per income tax provision, Indian income tax law, municipal tax paid will be reduced. You will get net annual value, 30% standard deduction, interest you can claim, income from HP. So reduce municipal tax. So that municipal tax not allowed as deduction in country A, but we can claim here. That's also US dollar 450 into 71. Same 71. So 450 into 71. You will reduce that. So you will get net annual value. Reduce 30% standard deduction. Balance you will get income from house property in dollar. Sorry, in INR, right? In INR. Yeah, directly we compute INR. Yeah. That is income from HP. What is income from HP? Yeah. So first income is salary, right? So what is the amount of salary? You see? 25, right? HP. Now PGBP. So PGBP, that is business, country A, US dollar 25,000. Converted into INR by applying 71. So $25,000 into 71. How much? Now capital gain. That is they are saying short-term capital gain 5,000 US dollars. So 5,000 US dollar into transfer takes place in which month? The transfer takes place in March. So we have to consider preceding month, that is February 29. What is the exchange rate? 70. How much? 50,000. And now IFOS. So IFOS dividend, US dollar 10,000. Suppose against this dividend, if they have any interest expense, we can claim. The only expense possible against dividend is interest expense. That is also up to 20% of dividend. No expense, so directly dividend 10,000 into dividend is declared and paid in March. So again same 29 February 2025 70. So 70 into 10,000, how much? 7 lakh. 7 lakh, right? So from India there is another FD deposit 160. FD interest 160. So we take, I think, considered all the income, right? There is no chapter 6A 115 BAC default tax regime. So this is a total income, and all these incomes are incomes taxable at a slab rate. There is no flat rate. So straight away go to 115 BAC and apply the 115 BAC rate. So what is the 115 BAC rate? Up to 3 lakhs nil and 3 to 7, 7 to 10, 10 to 12, 12 to 15, above 50. So nil, 5, 10, 15, 20, 30. So what is the total income? 54 lakh 11,285. Income crosses 50 lakhs, right? There will be surcharge, right? So 10% surcharge will be applied on the tax surcharge. First find out the tax, then add 10% surcharge, add 4% health and education cess. You will get tax liability in India. This is not the final answer, just the tax. See, up to 15 lakhs, what will be the tax? 1 lakh? 1 lakh? 40 or 50? 40. 1 lakh 40. Up to 15 lakhs, 1 lakh 40, right? So out of 54, 11 to 85, balance amount 30%, right? And then 10% surcharge, then 4% cess. So what is the tax? $13 lakhs, 13,385. Is correct? No, you have to take surcharge and cess. Yeah. After surcharge and cess, final answer, final tax. 15 lakhs, 2,000, 5, 1, 3. Find out the rate of tax. 15 lakh 2,513 divided by 54 lakh 11,285 into 100. How much? 27.76% is the rate of tax, average rate of tax in India. So now we are going to find out the double taxation income and the relief we are going to find out. So they are saying first step, what is the tax payable on such income in India? So such income means here what are the income from that foreign country, that is only is HP, and another one is PGBP, capital gain, not the entire IFOs, this 7 lakhs, right? So these are the foreign income which are taxed in India, right? So after claiming standard deduction only this is taxable, right? So the income taxable out of the foreign income in India is this much. So what is the total of this? 30,285 into 27.76, right? 27.76%. That is known as tax payable in India on such a foreign income. So what is that amount? 840, 90, 09. Okay, 8,40,096, right? So 8,40,096 is the tax payable on such a foreign income in India, or rule says tax payable on such income in the foreign country. So in the foreign country, we just calculated what is the tax payable, that is here 6,40,800. 6,40,800. So whichever is lower is 6,40,800. This is the relief under section 98 as per rule 128. Claim the relief. Balance is the tax liability of the assessee. So what is the tax liability? $1,99,000. It round it off, then 300. 199, 300. So this should any doubts? So this should be the computation. If the foreign income and the foreign tax paid, everything is given in foreign currency, then this should be the application, because this is the provision of rule 128. What is the tax payable on such income in India, or tax payable in foreign country for such income, whichever is lower. So only 6,40,800 we can claim the relief. So exam purpose, if they are asking a question on double taxation relief, you must write the reasons for that also. So you must write a theory on this double taxation relief and all those things. You must write the theory. Yeah. Our tax liability. What is the tax payable? No, the tax liability is 15,02,513, right? From that we have to reduce relief 6,40,000. So remaining figure is not correct. Yeah, what's the remaining figure? 8,61,713. So round off to 710. Got it? So I will show you the printed solution. So what is the name of that SSE? Mahesh. Yeah, Mahesh. So salary, then due to 75. So property, country business income, then short-term capital gain 350, 54,11,285. So final answer 8,61,713, which will be rounded up to 710. So if the foreign income given in INR, and foreign tax paid is given in percentage, this is not the mother. So in that situation, you can practice the questions in your study material, right? So that won't be asked. And if there is multiple countries, the relief should be computed country wise separately. Indian tax rate applied on country A foreign income, what is the tax? Compared with the actual tax paid in country A, whichever is lower, country A relief. If there is country B, what is the rate of tax for in India for the income applied on country B? Then compared with the tax payable for such a foreign income in country B, whichever is lower, country B relief, then country 3 relief. So like that we have to do. There may be one country with which India has DTA agreement, another country there is no agreement. Then with the DTA agreement, we will apply section 90 and this relief, and 91 relief for the other country not. Now there is one more question, question number 13. Next question, last question in DT relief. Mr. Ram, a citizen of USA, resides in San Jose in USA since 2006. He is a non-resident since assessment year 2008-9. He works for Exim Corporation, a US-based company. He came to India on 10th January 2024 to visit his aged parents. Actually, he is a foreign citizen. He came in January 2024. He could return back on only 31st January 2025. He was permitted to work from home in India by his employer. The details of his earnings and withholding tax during the said period is as given below. So Ram visited India, is a non-resident since assessment year 2008-9. For the current year 2024-25, he visited in January 2024 and remains in here up to 31st January 2025. That means our previous year starting from April 2024. From April 2024 throughout the year until January 31st, he was in India. So his residential status, if he apply, he will satisfy the universal test. 182. So he is a resident, but he will not satisfy the additional conditions because last years he is not here. Additional condition is out of 2 years, out of the last 10 years, he must be resident in India, and last 7 years he should be in India for at least 730 days. So he will not satisfy those additional conditions. So his residential status will be resident but not ordinarily resident. He will be a resident, but he will be a resident but not ordinarily resident. So that is the first point we have to keep in mind regarding residential status. So if he is resident but not ordinarily resident, every Indian income will be taxed here. Only 2 foreign income will be taxable. What are that 2 foreign income? Foreign business income if the business is controlled in India. Foreign professional income if the profession is set up in India. Any other foreign income cannot be taxed in India. Only these 2 foreign income. But all Indian income will be taxable. He is working here. So since he is rendered services in India, if he is getting salary elsewhere in India, it will be taxable in India because service is rendered in India. This is the issue. He is working here, but his employer is US company. He is getting salary there, but working here. So it's an Indian income. It will be taxed in India. So because service is rendered in India, accrued in India. So months, January 24, we not required. We need to take only from April 24. Salary $6,250. All figures in dollar. April. And the federal tax, tax deducted, or we can say TDS deducted in that country, US. Federal tax 1,600, state tax 420, social security tax 420, and then they are giving the directly the telegraphic transfer buying rate as on the last day of the month, immediately preceding the month in which tax has been paid or deducted. So directly we can take that 70 each column. What is the exchange rate given? That is direct. So as we discussed, only those taxes covered in double taxation avoidance agreement will be covered. So usually in a double taxation avoidance agreement with the US, federal tax only be covered. State tax is not covered. So social security tax is not covered. So we have to consider for double taxation relief purpose, we have to consider only federal tax. Don't consider state tax and social security tax. That is not eligible for relief. And April till January is getting like that. Now he has also earned fixed deposit interest in USA on 30th September 2024, US dollar 200. Tax deducted in US dollar 20, and on 31st March 2025, US dollar 220, tax deducted is US dollar 22. So see, this FD interest cannot be taxed in India because accrued in US, received in US, so it cannot be taxed in India because his status is resident but not ordinarily. If his status was resident and ordinarily resident, then global income is taxable. That can be taxed here. But here his status is resident but not ordinarily. Only 2 foreign income can be taxed, foreign business and foreign profession. But this is FD interest, cannot be taxed here. So that is not at all taxable. You have to put a note on that. As per Article 2 of Double Taxation Avoidance Agreement, Article 2 defines the taxes covered, that is Article 2. So Article 2 of the DTAA between India and USA is the taxes covered for credit card. Federal income taxes imposed by Internal Revenue Code IRC, but excluding say social security taxes. So state tax also won't be available, only federal income tax. Even social security tax also not eligible. Return of income for assessment year 25-26 was filed on 25th August 2025. He is an individual, so the due date for filing ITR is 31st July. So there is a delay in filing ITR. Usually if there is a delay in filing ITR, a person liable for 234A interest. If there is tax liability, he will have to pay 234A interest. You are required to compute tax payable, if any, by Mr. Ram. Assume that tax as per 115 BAC is opted. He is under default. Advise Mr. Ram the procedure involved to claim foreign tax credit. That is that procedure. Form should be filed, proof of challan should be submitted, all those things. First part is computation. So remember, he is resident but not ordinarily. But service is rendered in India. So salary, even though received in foreign country, even though received in foreign currency, if service is rendered in India, salary deemed to accrue or arise in India as per section 9, subsection 1, subclause 2. So his salary is taxable in India, but FD interest is not taxable. So we can compute the salary. Throughout the month, the salary is uniform, 6,250. From April 2024 till March 2024, January 2025, his exchange rate is same 72. So simply apply 6,250 into April to January. How many months? 10 months, right? So 10 months into, so $6,250 into 10 into rupees 72. That is salary in INR. How much should be the salary in INR? 45 lakhs. Round figure 45 lakhs. Standard deduction. It's BAC, right? 75,000 standard deduction. Balance is a salary, taxable salary. On that, find out, apply the tax as per 115 BAC slab rate. You have to apply 115 BAC slab rate. So up to 15 lakhs, you can take 1,40,000, and for the balance 30%. You are calculating relief. For calculating relief, you have to take the total federal taxes paid. Only, no, 6,250 is salary. Tax is, federal tax is 1,600 per month. So 6,250 salary into 10 into 72. So Indian salary income you will get 45 lakhs, right? Yeah, reduce standard deduction 75. So income from salary or total income 44,25,000. So tax that is 10,58,200 including cess, correct? Surcharge not applicable. Simply find out the rate of tax. Again, no other income. This is the tax liability. This is the rate of tax. 10,58,200 divided by 44,25,000 into 100. You will get the rate of tax in India or tax liability. 23.5. Okay. If you apply 23 point that percentage on 44.25 foreign income, again same amount will be good because there is no other Indian income. Usually we are doing rate of tax in India applied on foreign income. So here foreign income also same. So tax payable in India is 10,58,200 compared to tax paid in foreign country. Tax paid in foreign country you should take 6,250 per month multiplied with rupees 70. Whether that rate is uniform? Uniform? 72. 6,250 into, sorry, 6,000, not 6,000, 1,600. 1,600 into 10 into 72. So you will get the tax payable in foreign country or tax paid in foreign country on such income. How much? 11 lakh 52. See, 10 lakh 58,200 or 11 lakh 52,000, whichever is lower. So entire 10 lakh 58,200, which is the lower, you can claim relief. So tax payable is 0. We cannot claim any refund, right? So tax payable will be maximum 0. That is why they are saying whichever is lower. There is no possibility of negative. So 10,58,200 is the relief. So that relief can be claimed. So tax payable will be nil. As his tax payable is nil, 234A interest is not applicable, even though return is belated, right? So no 234A interest. And procedure is he has to give certain documents, that is following statements or documents to be submitted. US tax paid, proof of tax paid in US country, certificate or statement specifying the nature of income and the amount of tax deducted in form number 67 that has to file. So before the end of the relevant assessment year, he has to furnish this form. So this is the solution. Okay. So double taxation relief is also over. Last part of the study material in this chapter, they are putting a BPO taxation. That's only a theory. If a foreign company gives some of their operations into India as a BPO activity, there is no tax liability for that foreign company because BPO work is carried out by Indian entities. So Indian entities has to pay tax as per residence. There is no liability for foreign company. But if the foreign company, instead of making business process outsourcing to India, if they start a subsidiary or branch in India and doing the work it here, if it is a branch in India, that will be treated as permanent establishment. Whatever income is earned through that branch from BPO activity, that will be deemed to accrue resident and taxable in India. So some theory is there regarding BPO. So major area is relief. 91 and 90, and sometimes they may ask some theory. And there is one more area where there is a very rare situations where a person can become resident in both countries simultaneously. Source country is resident, here also resident. India is also resident, he is a resident in foreign country also. Because, say for example, another foreign company have a residential status rule of 182 days stay. India have 182 days stays. Total 365 days. If a person equally divided 182 days he stayed in India, correct 182 days of the remaining year he stayed in another country, he will become resident in both countries. If a person is resident in both countries, we will call it as dual resident persons. Dual residency is very dangerous. We cannot further proceed. We have to break. So we have to decide in which country he is resident. For that purpose, we should go to the double taxation avoidance agreement. In double taxation avoidance agreement, there is a tiebreaker rule. So as per the DTAA agreement, normally the tiebreaker rule is if an individual is resident in both countries, then we should see in which country he has permanent home. So that permanent home country should be treated as resident, other country will be treated as source country. Because both country residents, we cannot apply DTAA agreement for relief. Always there should be one residence country, other one will be source country. So if both resident, find out in which country he has permanent home. Permanent home means it should not be an owned home, some sort of a permanence in residing, right? It may be a rented house also, no problem. Permanency should be there. He should be, when he visit that country, he will stay in that place. So that is permanent home test. If he has permanent home in both country or no permanent home in both country, then this test will not be applied. Go to the second test. So go to the second test they are saying is we have to see the his habitual abode. So habitual abode in both places or there is no habitual abode, then go to the center of vital interest. So that is actually habitual abode. See, that is also not available. Then go to the third test, in which country he is a citizen. Both country he is citizen or not citizen in both countries. So both country citizen is actually illegal. Suppose both countries he is citizen, then there is no other way. Home test failed, habitual abode test failed, citizen failed. Then the last test is only other way is MAP. What is MAP? Mutual Agreement Procedure. Give an application to Indian Ministry of Finance and here their ministry. In between ambassadors talking and finally they will get into the resolution. That is MAP solution. So this is the way a person, if becomes a resident in both country, tie break rule. So they may ask a theory question from that area. Because without breaking this rule, we cannot apply DTAA agreement. Because always one country should be resident, other country should be source. It's a connecting factors. Otherwise, we cannot claim relief, right? Because tax paid in source country allowed us relief in residence country. If both country residents, how relief will be computed, right? So that is a tiebreaker rule. That's a theory area you have to keep in mind. So these are the main areas you have to finish. Okay, you have to see through the last moments, and tomorrow we will go to the domestic taxation area. Morning we will start with capital gains because a lot of amendments and those things are there. So capital gain we will start. Then we will move to the PGBP and set off. Then straight away to assessments, company, firm, LLP, AMT, all those topics. Okay. So morning at 9 o'clock, right?